trust that we had, and the addition of several key components or several roles and responsibilities will also help mitigate some of these risks on a go-forward basis. That concludes remarks on the organizational component. I do have some brief remarks on the implementation with respect to investment decisions. As you're all aware of, the Commission invests on a global basis. A key requirement to this is global custody. Previously, the Commission had used commingled structures as a more efficient implementation. And then when implementing an emerging markets mandate, you'll recall that the group trust issue arose. While statute allowed for the group trust, there had to be a document, I guess, surrounding that, along with the tax ID number. Most things, there is a tax ID number. But PIBA has resolved the group trust issue, so that's been completely resolved. Again, the Commission had historically used commingled structures to implement the global mandates across the global custody issues. And then recently, the Commission utilized the Lighthouse platform to implement the international equity mandate for earnest partners. The next requirement as we continue to move with respect to this decision of commingled funds versus separate accounts is the requirement and the ability to establish global sub-custody arrangements. The Treasurer's Office as custodian must establish the sub-custody networks for us to be able to move from a commingled structure to a separate account structure at the Bank of New York. Once the Treasurer's Office is ready to move forward with this and has everything in place to open up the global accounts, I would be supportive of transitioning assets from commingled structures to separate accounts at Bank of New York, as well as transitioning earnest from the Lighthouse platform to the Bank of New York platform. I would also add that the resolution to the custody search is critical before establishing the global custody network because changes of the custodian could create some additional changes in service level and some additional expenses and costs if you have to re-register those accounts with another custodian in other markets. So we hope that decision comes soon. Other items to note that we'll discuss a little bit later today. Mr. Phillips will be giving a performance update, and then also right after that, Mr. Bernard or Mr. Brady from Hewitt will be giving the Commission an update on the fee analysis and the asset liability study. Later, there will be several staff recommendations from staff on managers with respect to implementation of beta-like strategies. We think we can create some more efficiencies of a less expensive implementation. Also, from an infrastructure build-out, I wanted to make the Commission aware of several RFPs. The first will be looking for risk services or risk management tools. We'll be issuing that RFP here shortly. Also, one for administrator/portfolio accounting services. We're near the end of completing a contract with BNY for implementing Private Eye, which is a private markets tool for tracking and monitoring those specific assets. Mr. Chernick, in his comments from the Audit Committee a little bit later today, will be speaking to this as it relates to the Deloitte assessment. Another key part of the process is funding. We have that as an agenda item a little bit later for more in-depth discussion. I won't really discuss it here at this point in time, other than to say it is critical that we have a formalized set of procedures to mitigate business risk and operational risk and not increase those risks. So those are my comments, and I'll stop there for any questions. If none, then I'll turn it over to Mr. Phillips.
I have a couple questions. We talk a lot about risk, and it appears that most of our risk is standard deviation based. Is that the only measure of our risk? Also,
We're speaking of investment risk. We do think of volatility as measuring investment risk, yes.
do we measure other types of risk,
Such as
operational risk, financial risk, partnership risk, systematic and unsystematic risk, liquidity risk, all those things? And we hear constantly about volatility, but is it wise that that's our only measure?
I think there are multiple risks out there that exist for any investor, that we come across any investment that anyone makes. From an investment perspective, we will focus on the volatility of returns and what that actually looks like. From an operations component, then we do have a Deloitte risk assessment. They pointed out several things that we need to address. The Audit Committee will be giving an update on the Deloitte risk assessment and the progress we've made there.
So in our reports, we should not be looking for something more extensive. Credit risk, default risk, country risk, foreign exchange risk, interest rate risk, operational risk, political risk, a little some overlap there, systematic and unsystematic risk. liquidity risk. We're just gonna stay with the past volatility as our guide. Something other than sharps.
That is the key risk that we look at.
But that doesn't mean, right, I guess I shouldn't interrupt. That doesn't mean we'll look at all these other risks, you know, as we make individual investments. So,
Well, I mean, the Deloitte report says that we don't, and so we're gonna go there, but, well, if that's, now, would the consultant say that this, our measures are sharp and Sortino and standard deviation or the volatility is the sole measure of our investment risk?
I wouldn't say it's your sole measure, and we wouldn't advocate that that be your sole measure. And Ed, can you hear me okay? I hope. We think there's a lot of things you should be looking at. Some lend themselves to ongoing reporting, so volatility is something that's looked at pretty frequently. I think you.
Pardon me.
Pardon?
How often do we get those measurements? How often do we report into the system measures all the data from that? So I'm not exactly sure that.
I'm not sure. We have
How do we
if you
do
want to
How do
celebrate these.
First, you know?
What I'm saying is that Bank of New York generates monthly returns. We would like to see them generate data.
So if we report a lot of our private equities are quarterly, so what does that do to our volatility?
The academic literature says any sort of illiquid assets tend to understate your actual volatility, right? Because you're not marking the market every time the interest rate changes, the value of your real estate and everything else can change.
And so an organization with as large a illiquid portfolio as we do, you might think that Mr. Sharp, the man who invented the Sharp and won the Nobel Prize for something else, when he says he wished they didn't use it, he doesn't want to use it on these type of assets, he thinks it's awful, and then he's joined by Mr. Sortino, who says the same thing. I never meant for it to be named Sharpe ratio. I hate they're using my name. So, I'm not a risk expert, and I obviously am a junior person on this team, and not particularly well thought.
Ms. Bernard, you didn't get to complete your answer.
Thank
Go
you.
ahead and finish up
Thank you,
what
Mr.
you
Chair.
were saying.
It is a complex question and an important one, so I'm glad you asked it. There are a lot of things you should be looking at. So not all of them lend themselves to looking at a quarterly report, for example. Liquidity, as an example, we think is something you should be looking at anytime you consider your asset allocation. You should be looking at your exposure to various markets. So for example, equity beta is something that manifests itself in multiple asset classes. What's your true exposure to that? You should be looking at tracking error from your active managers. We're going to be looking at all of those in May, providing additional analysis once we start to get into implementation. And then it's something you periodically look at once a year. So I think we're on an evolutionary track here to further enhance risk reporting. But I would say that among public funds, the standard deviation is still the #1 metric that people use for volatility and risk, given its pros and cons. There's lots of different ways to look at risk. So I think it's an issue of being comprehensive, looking at a lot of different ways, and at the end of the day, taking all that information into account when making decisions.
And since as former Chairman Gillespie mentioned, our high alternatives suppresses the volatility, and we have more than double the average, then we might suggest that our measurements of volatility may not be as accurate as we'd like. And what I'd like to know is, because we trumpet our risk. We say we're 29% less risky. And of course, I asked for the data points on that, and I never got them.
I'm correct, sorry, you've made that comment several times. I've emailed back to you and your chief of staff multiple times on that topic.
We'll go through the email chain of asked for them and have got it. And
Sorry, sir.
Ms.
Okay.
Mr.
Go ahead.
Treasurer, I'm going to give Marshall the floor to respond to that question.
I apologize, Mr. Chairman.
No, I'm saying you got the floor to respond to that question.
I think there's been accusations about this multiple times about not responding to. Actually, the way this started was a reporter from the New York Times that was interviewing Mr. Loftus sent a list of questions for fact finding and asked about the risk. We ran the standard deviation and compared it across multiple fiscal year ends compared to a global 60-40 mandate. Over those periods, our portfolio had approximately 29% less risk compared on a volatility basis than that global 60-40 portfolio. That was the statement. There's been a remark about sending spreadsheets for that information. These things are not calculated in the spreadsheet. So we downloaded the outcomes of that into a spreadsheet and sent to Mr. Loftus. The same day, Mr. Leidinger responded with a set of questions regarding risk. I responded back to him and let him know how what the indices were, time periods, and how he could actually go back and recreate this if he wanted to do it in an Excel spreadsheet. Also, in addition to that, Mr. Leidinger had put in something he references a chart from NEPC, which was not from their book, so I'm not sure where he came up with that information, and I asked specific questions about that. I've yet to get a response to those questions.
Well, he wasn't the one to make.
Correct me if I'm wrong, Horst, but didn't you copy me with two or three of the responses
I believe
to
I did, yes, sir.
So that the information you gave us includes the frequency by which we gather the data, so that we could replicate it.
That was, I believe, the first question to Mr. Leidinger that was addressed, yes.
And so you're saying that it does?
Yes,
Okay, well, this is one of those in agreement with that.
it absolutely is.
So, but getting back to the more central focus here, is that, and I just wanted to get from, especially from the consultants, that y'all are comfortable with the way we do risk.
Mr. Loftus, right now, the consultants aren't making their presentation.
Well, okay,
So
that's fine.
correct.
Yeah. I'm
This
going
is
to
a question period
Yes,
for
sir.
Mr. Harper, and I
Mr.
believe he can answer one more question, but then we move on to some other commissioners might have a question.
Can I ask a question?
Yeah, let's let the treasurer get his in, and then I'll promise I'll recognize you.
Mr. Harper, you're comfortable with the way we manage and the way we measure and manage our risk as of today?
I don't think one will ever be comfortable because the risk and risk metrics continually change. The common standard for measuring the plan level volatility would be standard deviation. There are multiple ways to look at calculating the downside measure as well, which gets back to your comment about Sortino. So there are multiple ways to look at risk. If there's a specific risk that the commission would like for us to identify and report on, we're happy to try to capture those risks and report on them. With respect to the risk management systems, we are issuing that RFP so that there can be a more comprehensive approach to risk management. So that would be my response to the question.
Okay, Mr. Gillespie, I'll recognize you.
Yeah, my question, the risk question, rather than parsing this and that, any financial professional knows there's a lot of risk. My question is, why can't we keep the two risk officers? We've had two, we've lost one, right? What's it gonna take from a budget? Because a lot of this is about reporting, and in respect to the treasurer's question, it's an important question. There are a lot of different types of risk, many of which you listed, right? How are we gonna report it? What budget's it gonna take, and why can't we keep it? I mean, that's the nature of my questions that I think are germane for this board on a go-forward basis.
So the first one, personnel, we have hired two. The first was a double PhD who went to a hedge fund. So compensation-wise, would be a guess is why he left. I was not given a specific reason other than he was leaving to go to work in hedge fund. The second went out for medical purposes. So we have an opening now, and we have a job posting to recruit for the director of risk management. I think the other part that makes the job more challenging from that perspective is there is a build-out of systems and tools that will be required. So if you're hiring someone who comes from the private sector who has full access, budgets aren't limiting to ability to access software and data, and they come from that environment, it's going to be very challenging for that person to come into this environment where it's a build-out from an infrastructure perspective.
I think the second part of your report, you wanted to recognize Mr. Phillips has been standing there patiently.
Yes, sir.
Okay, take away that.
Thank you, Mr. Chairman. I will start with high-level performance numbers referenced in the flash report that's on the screen. Please interject with any questions as I go. Total plan as presented here, and all of the periods that I'll be referencing here are ending as of December 31, 2012. For calendar year 2012, the plan produced 12.6% return. Fiscal year as of December, fiscal year to date, 6 months ending in December was 7.3%. And then for the second fiscal quarter, also ending in December, was 2.8%. All of the performance numbers exceeded the policy benchmark for all periods. few notes on page 2 from the flash report on specific asset class level performance. For the calendar year 2012, equities and GAA categories were the primary contributors. We had both high allocations and high returns for those categories. All asset classes had positive contributions for the calendar year period. For the fiscal year to date, 6 months ending in December, all asset classes again produced positive results for the period. Emerging market equity, emerging market debt, and GAA again had the highest allocations and the highest returns during that period. So they were the most positive contributors to the fund. For the second fiscal quarter, October through December last year, commodities were the only negative category. The non-U.S. equity category was the most positive contributor. Step back to page 1 here in the flash report. Just a recent reference point for the commissioners, given that we'll be rolling into asset class recommendations here later in the meeting. The pie chart here references our ending December asset allocation. Fixed income was at 23%. Equity category was 29%. It includes the hedge funds associated with the Affordable Alpha Program. GAA at 10%. Hedge funds that were not in the Affordable Alpha Program at 3%. Commodities at 3%. Private equity and private debt combined, with real estate at 16% and cash and short duration at 12%. Latest performance estimate, it's not on the screen, not in your materials. Latest performance estimate fiscal year to date through this week, Wednesday, February 25th. Estimate of fund performance of 8.75% versus the policy benchmark of 7.4%. Pause there, see if there's any questions on the flash report.
I have a quick question on the pie chart. Can you explain that a bit to me more? Because the numbers seem, just different from before, and I'm sure they're right. Like the hedge fund exposure is 2.9%. What has to happen for those type of numbers? I mean, it's a what, $4.5 billion? No, what's our total hedge funds? 4.73. 17% of the plan, and that shrinks it pretty to the portfolio exposure. So how does that get swallowed up?
So the slice of the pie that you're referencing is the non-Affordable Alpha hedge fund component that I designated in the higher level asset allocation. So the other of the 17-point-something% that you referenced, the rest of those hedge funds are in the equity category.
So there's two things being picked up. There's an exposure, which is the pie chart in the very bottom right, versus an asset allocation that we're allocating towards managers. So the bottom right pie chart is an exposure basis. So those hedge funds that are part of Affordable Alpha are being picked up on the equity exposure since they're overlaid today. We can go through, I think, to your point.
Yeah, GA,
Go through, which page is this? To the flash report. It's page 6 of 9 on the flash report. You'll see that the market value, as you pointed out, is $4.7 billion and close to 18% for total hedge fund allocation. So approximately 15% of that is being overlaid with Affordable Alpha. So the exposure makes that adjustment for that 15% overlay with respect to the LIBOR plus return overlaid on top of the S&P 500 MSCI.
Any other questions before I switch over?
Okay.
So I just have some high-level review and outlook comments. Slide 2 of this presentation is a 3-year chart of the S&P 500 representing the equity markets. The blue bracket here will note a 28% increase over the last 3 years. I've bracketed this because specifically I wanted to reference the round trip that you see with the jagged line here in the path of the S&P 500. From mid-2010 through late 2011, and just basically highlighting the risk of the equity exposure that we face with this allocation. 2012 started with a very strong first quarter, as you recall, but the first half of the year was basically characterized as a very nervous period as the market market and global markets really were dealing with the debt crisis and the Eurozone issues. But in the red bracket here, you'll see 15% move in the third quarter. This, we noted internally, was a period of very weak conviction by investors, and particularly our data points were in talking to our hedge fund managers where they were carrying low net exposure to the market and moving their books around quite actively during this period. Regardless, the markets rolled over into the U.S. elections and a fiscal cliff, if you recall, last year, and we had a relief rally at the end of the year. So moving forward, the first few weeks of 2013, the green bracket here had a 7.3% move through February 20, which was the end of last week, I believe. And I think the pertinent characterization here is that we're noting higher conviction levels by investors in the market with respect to risk assets. Portfolio activity during this time focused on the equity category. First, in mid-2012, the nervous period that I mentioned, we took action to first reduce and then reversed the reduction in our equity exposure, in specifically the EMPA and the U.S. Equity categories. And again, that was during that time where we felt like the market was basically in a never land type of environment. Secondarily, more recently, over the last couple of weeks, with the green move that you see here, the 7.3% from the end of last year, really encompassing the rally at the end of the year, 2012, we took some action to hedge our downside risk linked to the equity markets. Slide number 3 here is fixed income markets. This is a 10-year perspective on 10-year Treasury. The recent years, you note here, are a continuation of essentially a mega cycle into the very low interest rate environment that we've been in for some time. The red bracket here over the last 8 years, the yield has declined 3.2 percentage points. The current yield on 10-year Treasury is just under 2%. I highlight this because for several reasons. One, it's very difficult to match the long-dated liabilities that we have to fund with safe but very low long-term yields, as evidenced here. Secondarily, duration risk is an increasingly more significant risk consideration now at the extreme low yields. And thirdly, the low Treasury yields make the earnings yields on equities much more attractive on a relative basis in this type of environment. So all these comments basically I bring out to reference the feed into the recommended asset allocation policy targets that we'll be going through with the consultants later today. Credit markets, this is a chart of the generic 5-year high yield spread over the last 8 years. Spreads are below average. We and much of the market suspect the spreads are too low and therefore insufficient to compensate for credit risk. The average over this period was 582. It is 5.82% or 582 basis points. It is a bit distorted by the 2008 and 9 period. Nevertheless, the current level is 441, below the long-term average as presented here. Recall that the fund in 2009 invested in dislocated credit categories, basically the big hump that's partially obscured by the key here. Those decisions proved out very well for us. Fund benefited quite significantly from the emphasis on the distressed credit market over the similar period. Currently, we're more cautious on the credit categories, also reflected in recommended asset policy targets that come up later today. What we are doing in this space is we're seeing more value in complex credit strategies, which are requiring higher degrees of specialization and longer investment periods. Slide number 5 here, this is a 12-year chart of monthly dollar volume of M&A activity. The average over this period is $189 billion per month. It is not, I did not note it on the slide, but it basically cuts through just below the $200 billion line right here. So, as you'll note on the far right of the chart, there have been some recent breakouts above that level, but it has been very much a stop and go type of environment over the past 18 months or so. This is, from our perspective, a fundamentally healthy dynamic in the market, particularly for commerce and for the markets overall, but it does require a stable economic environment, if not a growth environment. So this is a contingency that we look for continued improvement in this particular dynamic. Regardless of the economic backdrop, there are several points here. One, there is lots of cash on the corporate balance sheets. Profitability is stable to improving in the corporate world. The low growth environment, if we do stay in or around that environment, will force rationalization. So this dynamic will continue regardless of the growth dynamic, growth trend. And then we also note the recent industry consolidation, the headlines that we've been seeing in financial news and press lately. And those have all been good. Highlight this for the simple reason that we have significant equity exposure and we have significant private equity exposure. And this type of dynamic is pretty much a requirement for us to benefit in a big way from those allocations. So summary observations. I'm not going to go through every point here, but all in kind of at the highest level, tail risk has subsided from the previous couple of years. Low rate environment is very problematic for us and for investors in general. The global growth factor is a swing factor for us in making our investment decisions. We in the U.S. are currently kind of the 2.5% range. Where that goes up and continues to improve is a significant dynamic for us. And then overall, we would note that investors are refocused on equity fundamentals and the rate risk that I mentioned before. So jumping to slide 8 here, in the interest of time, combining our market assessment and comments and analysis with a quick review of implementation in the fund. This is a breakout of the value added by asset class for the fund for calendar year 2012. If you go back to the flash report, there's a waterfall chart there. This is an expansion of one of our 3 of those bars into the individual asset class categories. So the circle part here is the 3 categories that represent over half of our asset allocation, capital allocation. These 3 categories in calendar year 2012 added $1.7 billion collectively to the fund. So one perspective that we, among many that we go through internally, is basically a post-mortem, a debrief, a review, if you will, of what went right, what we did well, versus what needs improvement. So one perspective that we can look at in that category is active versus passive decisions that produce these results. I want to share our progress so far with you on this particular perspective. Before I go into the actual observations from this slide, there's several caveats here. One, this is a very naive approach. It assumes a static allocation to the index to our allocations, to our actual allocations. It is applied to the asset class levels, not at this time, not yet to the sub-asset class or to the individual investment levels. And I would just note that in general, additional work is ongoing, and we will continue to break these out in more granular detail. But regardless, comparing the returns and the risk from active fund allocations to passive alternatives with the goal of better returns and or lower risk, these observations are coming to the fore. One, on the equities, there are clear cases where we would have benefited from passive implementation. On the fixed income line, the decisions here have been good. Overall, there's some room for improvement in the risk side of the equation here. In the hedge fund category, we are very pleased with some very good active manager selection here. and I think you'll show it for you in the reasons I'll bring up. In the table here, green represents better return or lower risk versus the passive option, and red represents lower return or higher risk versus passive option. The visual representations of these are as follows. Slide number 10 here, the equities collectively, our active managers in the blue have underperformed the blended benchmark that we applied to this category. Slide 11, the fixed income active managers in orange are outperforming, have outperformed, and we note here that this is applied to a very high bar, or high standard, if you will, in the Barclays Global Ag Bond Index. This is the benchmark policy recommendation that has come forward from our consultants' work. And then lastly, in the hedge fund category, collectively, again, our managers in blue, manager selection has been very good, avoided significant drawdowns in the market, and have overall produced good value for us. So as a result, one of the obvious implications from, particularly for the equity category, is we expect the overlay component of our toolbox, which we've referenced a number of times in this room, and we use on a day-to-day basis, to be utilized more going forward. So here on slide 13, just want to provide a snapshot of the performance contribution from those overlay decisions for calendar year of 2012. Again, we expect this component to be more significant going forward, and we'll be tracking results very closely. So conclusions are across slides 14 and 15, sum them up for you here. One is we're pleased with results that we have been producing, especially of late. However, we are always acknowledging that there's room for improvement, and we've identified several of those areas here that I've discussed. The market and investment opportunities are better of late. Tail risk on a global basis is diminished, and that's a good thing. We believe that we can improve results by the directional shift in implementation toward enhanced / passive types of strategies and units with the intent of using the overlay more. I'd also note that with respect to the hedge fund component, that our intellectual capital at the staff level is growing. It's good now, and it's improving, and I think we've made tremendous progress in our abilities and our knowledge base there over the last couple of years. Staff overall is focused on simplification, rationalization, risk-adjusted performance, and personal, professional, and organizational improvement, as always. That concludes my remarks. I'll be glad to take any questions.
I noticed that we are using the December unaudited statement for our flash reports. We should have December audited by now. Should we have the unaudited for January?
No, that's, let's see, so for January, we'll actually get those probably in about 2 weeks because the bank will keep their.
Well, that would get the audit, but like we have the unaudited here.
So,
We can get the unaudited for January now, we can get the audited for December. We're using unaudited numbers for December, which has been closed since February 4th. And we're not using the, so I mean, we're just way behind.
Right. I can answer, demystify a lot of this, having done the reporting for a while. I'll just describe the process. We'll take December as the benchmark here. So December, obviously, we are concerned about what the state of the accounts at December 31st. We delivered to Bank of New York on or about the 28th. They have everything that they need in order to produce the performance report. We receive that typically on, and I'm going back several years here, on about the 8th of the following month. So we would receive the December 31st performance from the custody bank on or about March 8th. So right now, I have not seen the January report. So I can't answer anything about January. But December is not audited. There was no auditor auditing. So non-audited means it's not the once a year, the June 30th report, it does get audited.
I understand that, but I'm not gonna get an answer, I can tell. The bank has what they call is an audit. It's not the CPA's gonna look, but it's, they reconcile their books, their custody versus their accounting, and that's what we do our performance on.
By that
And
standard,
so
this
since,
is the
well, just let me
audit.
say this, in December and in January, we put out press releases based on numbers, and now we can't even get the unaudited numbers a month late, or a month and a half late.
Okay. If the standard is audited by BNY Mellon, then this would be the audited returns. They're not audited by us and by people, so we don't
But
want
we
to
use them for press
represent
releases.
anything as.
But we
audit.
use them for press releases.
I'm sorry?
We use them for press releases, though.
I'm not talking
Yes.
about that. I'm talking about whether or not it's audited.
Okay.
That's the extent of,
I will only say that we used to have, anybody, we used to get these on a regular basis. They were unaudited and listed that way for a reason, but it gave us a better snapshot, because this is way behind. The December numbers are audited and out, and we've issued 2 press releases on them.
Is there a question in here?
Yeah, well, I just want to know why we changed our reporting. We now get, this is very old information.
Is that all the answer we have? Is that the full answer?
I believe so.
Mr. Chairman, may I add
Go
a
ahead.
comment? I just want to make it clear that both what's in our performance report and I believe what staff has reported here are the final numbers from BNY.
Oh, it says here.
I think the audit issue may be an external, whether there was an external audit versus BNY's internal audit. So I believe that has been performed on all of this data. So
Which, I'm sorry.
on both what we use for our performance report, which is also contained in your materials, as well as what staff issues. What
An
I
external
use.
audit?
No.
From
That's why I got confused, an external audit?
So as opposed to Deloitte.
Yeah. Yeah, well,
This is BNY's final data, so it's
Okay.
not preliminary in any way, shape, or
So
Yes.
we don't call them audited figures until they've been independently audited by.
form. I think it might
As
be
a
a
result of
nomenclature
these
confusion here.
no, well, there's not, actually. We have always gotten an unaudited report within a few days after the month. And that's why it says at the top. Nobody's ever thought that Deloitte looked at these every month. Now, if I'm wrong, Travis, please tell me. Let's speak up here. I need a little backup. I see where Alan shaking his hand. Nobody says a word.
The questions are here should be directed to the
Yes.
person who's making the report.
Well, okay, so, when would we get the January unaudited report? Because I can get them in 5 minutes. I mean, if we're gonna use an unaudited report for December, and we've got all our audited reports, we've done our big 200-page quarterly report, we've issued press releases. If we're gonna use that numbers as unaudited, why can't we have the numbers now? Just a simple question. You just say you don't wanna give them to us. That's
All right, the
fine.
question, as I understand it, is when will we get the January 31 unaudited figures? And who's got an answer to
I can give you an estimate of March 8th.
that? March 8th.
That would be the audit.
All right, that's the answer to that question.
Audit.
I don't know.
We may not like the
I
answer,
don't
or it may not
know.
be, we may like to hear something different, but that's the answer.
That's the audited numbers.
Mr. Chairman, if it would help, I'd be glad to work with Derry to put together a timeline of when we receive data from the bank, how we characterize and classify it, and the timeline associated with it internally, and send that to the commissioners. That would help address this issue.
Subject, you and Nick confer on that.
Yeah.
We'd love to entertain it if y'all can do that.
May I make a suggestion on all this performance stuff, because this gets really nitty-picky, and I did talk with Dan and Barry about this morning, that we ought to bring all the reporting in compliance with AIMR, gives standards with all the disclosures. There's a whole list of disclosures, everything will have attached behind it, about 4 pages of disclosures. Put them in there, right? Just a suggestion.
I think they should take that as a suggestion. I think one thing we do have to bear in mind, the reason we do unaudited preliminary, et cetera, figures is to give the public a chance to know what we're doing. And we have to balance all the gobbledygook about federal, state, local requirements with getting usable information from the retirees and participants. Both. all of
I
that
don't
has to be
think it would,
considered.
I don't
And
think
if
the
you'll-
additional disclosures would frustrate that effort.
Well, I don't know, but I would like for you to kind of
I'll work with
delegate,
Danny on it.
work with
Okay.
Danny and come up with something
Yes,
that meets both objectives.
If I may, that also
Chairman, may I ask a question?
from,
Sure.
Yeah, I want to make sure, I had a little trouble hearing all of the conversation. I want to make sure that Mr. Walton's question and concerns have been fully answered to his satisfaction. Mr. Treasurer, are you satisfied with the responses that you had concerning?
No, because I'm just not gonna get an answer. the answer to my question is not all this about audited and unaudited. I was very clear to start with, but it got confusing.
Well, wait a minute, I want to make sure.
Yes, sir. I'll
You are
do it.
not, if you are not satisfied, or you say that you are not receiving it, can we please have
Yes, sir.
a response?
In days gone by, the good old days, when we came in here, say, in February, we got a January unaudited report. It's as simple as that. The Reynolds, I guess you don't remember that, but you were vice chairman and chairman before, and you always had this report for us, the unaudited report for us. This is now almost 3 months old. And my question is, if we're gonna change reporting, just tell us, otherwise, we shouldn't be dealing with information this old. I realize it's not audited, I never thought the lawyer had anything to do with it. It's just, I'm wondering why we changed from one way to the other. And if there's no answer, there's no answer. But to me, it's important, so I thought I'd ask the question.
Person, you wanted to say something, let me ask, has there been a change, a material change?
I was actually looking around the room for John Reichner, who was actually head of the
Actually,
But before I turn it over to John, there's a couple of things with respect to the time period. There's a comment made saying this was 3 months old. Well, it's January, February, so it'll be 2 months old. The Bank of New York will not close their books until 30 days after the month ends. They then, the staff for December gets, in February, information to be able to create this report. So there will be a lag on the reporting. Also, from a statutory perspective, there's a requirement for quarterly reporting. This is in the quarter end. That's why 1231 is here. If the commission wishes for staff to report something differently or see it in a different format, we're happy to take that feedback and do something. As Mr. Gillespie said, he'd like to see additional disclosures. I would be supportive of that, adding this additional disclosures to performance reports. But as far as the comment of someone not wanting to provide information, I would take offense to that.
Well, once again, we can have this information. The audited information stops 30 days late. Bank of New York works its magic, and on the 6th or 7th day of the month, they send us the audits. I understand this. I'm a custodian. I've not asked for auditing stuff. I've asked for the information that we can get the day of the close. It will not be 100%, but we've always had it in the past. We check. Is it fair that we have changed and they refuse to admit we changed? I don't really care. I'm just trying to find out what I can expect, because I can run the report myself, and I will. If anybody wants it, just let me know. Now, one more question is about the on page.
Just one further comment. I want to make it absolutely clear, and I want to be clear, and I want to understand. Is there any dispute here whatsoever between Mr. Loftus's request and what we are providing, or what we intend to provide? I want to make absolutely sure that we don't leave anything in limbo here. Mr. Loftus, are you satisfied with the response that you've received?
Thank you for the concern, Mr. Vice Chairman, but I'll take this one on the chin. It's never going to happen. I can print the report myself. If anybody else would like it, I'll be more than happy to give it to them. We will mirror the ones we used to have. Now, I do have a question about on page 9, Mr. Phillips, about the index for hedge funds. I think we use the HRFX Global Hedge Fund Index. Now, if you look over history, we have clobbered that. I mean, we have clobbered it. If we could beat the S&P by those figures, we would all be retired, living in the Bahamas, all 520,000 of us. Does that point to a benchmarking problem? I mean, because if I read this correctly, is negative 0.8 is the index return, and we made 23%. So is that just like 23 times? And then if you go back over the history, you see where that's not all that far off. So is that, am I reading that incorrectly, or is that a benchmarking problem?
So, first comments on benchmark. HFRX Global is our policy benchmark. It was designated as such by the recommendation of our consultants and our staff. And it's what we use as the most appropriate passive alternative of the broader hedge fund market. There are others that could serve the same purpose. I did run the similar analysis on those others, Mr. Treasurer, and that does not change the outcome material. With respect to the numbers, 23% is a cumulative return over 3 years from our active allocation. Again, with the caveats that I mentioned, it is a static, high-level back-of-the-envelope type of analysis. And that is correct. The benchmark actually over 3 years falls about.
So you're comfortable with this index as a measure of our benchmark? You would be personally comfortable?
I am personally comfortable. It's the best choice we have by the input and the recommendation of a number of experts, some of which are in the room.
Mr. Phillips, one last question, and then we'll move on. Has any commissioner ever suggested to you that we should use a different benchmark?
No, sir, not to me personally.
Or are you aware of a suggestion to any other staff member that a benchmark for hedge funds be selected?
I am not aware.
Let's move on.
I have discussed it with a consultant, and I mentioned it in public here.
You know, I don't know if the consultant had it, but I think.
She's going to address benchmarks in her report.
I was just going to say, if we could see, our hedge fund portfolio relative to the strategies, just like,
Well,
Sal benchmark
can I-
type of report.
Just to add a little bit more depth to what we do internally at the staff level here. This is a high level, the highest level policy benchmark, and it obscures a lot of things. When I first joined the commission in January of 2011, I went through the process of categorizing our hedge fund exposures by strategy according to the sub-categories of our global benchmark, of our policy benchmark. So internally, we are cognizant of and we do manage toward the guidelines that we've established policy-wise internally to those subcategories, which as you go down in granularity, become more and more appropriate, if you will, in your terms of treasury. So again, this is rolled up at the highest level. This issue that we're talking about is not specific or not applicable only to hedge funds. It actually applies to all of our asset classes. So we can have the same discussion on any of these. But we, as staff internally, have taken more active control of the actual implementation decisions as we go down to the portfolio manager level.
Thank you, Mr. We'll move on to the next agenda item, portfolio fee analysis.
Thank you, Mr. Chair.
We'll recognize Hewitt Ennis.
Great. So we have a memorandum that we prepared on this. It's rather lengthy. So we thought that for the purposes of discussion here today, that we'd speak from a PowerPoint. It is containing the exact same information that was in the memo, but a little more simplified, big picture. So please ask any questions you have, regardless of whether it's on the PowerPoint or on the memo. We just thought this would be easier for group discussion. So, in my view, my humble opinion, I think the most important thing that we're going to be discussing here today is your asset liability study, which is coming up next. What is the right asset allocation for the system going forward to meet the needs of your beneficiaries? But fees are kind of inextricably linked to asset allocation. That I could tell you in a heartbeat how to come up with a very low fee structure. Index it, use nothing but traditional asset classes. And that's probably something you could do. We can talk about the pros and cons of that. But that's what would create a low fee structure. What you've chosen over time to do is to have a lot in alternatives, and it has created a higher fee structure. So the question is your fee structure too high for that asset allocation or not? And so we're trying to provide some information and backdrop there. The difficult thing is that I can't give you a simple answer, yes or no. There's a lot of muddiness out there in terms of fee comparisons. I want to give you some information today to help you kind of navigate that. And then we have some next steps that we think will help further reduce the system's fees and also give you a little bit more clarity, hopefully, on where there may be pockets of things that aren't performing as strongly as you'd like them to. So I wanted to start with the big picture. What are best practices in fee oversight? So you're doing all of these, but we just wanted to go over the basics. But at the end of the day, net of fee performance is what matters. How are you performing after all your fees are deducted? You're doing that. 5 years ago, there were public funds out there that were still showing gross of fee performance, unfortunately, or partial gross of fee performance. But it's become more commonplace that everyone is looking at fees. on performance on a net fee basis. Negotiating fees, when you make a new investment, that's the best time to do it, particularly for private partnerships. You're not going to get a lot of traction after you've been an investor in a fund. But before you're looking to make your investment, considering those fees, those terms, and making sure that they're reasonable for what you're trying to achieve. And if they are higher, that you feel really confident in that manager and that you're going to be looking at them that much more closely. And then periodically evaluating your fees against your peers. At the end of the day, what we're looking at is reasonable fees, not necessarily making it the lowest absolute number of all your peers. It's a nice thing to have the low fees, but if you don't have performance to go with it. Now, in our discussion here, we focus solely on fees. Performance goes hand in hand with that, and I would say that's very important. You are looking at performance net of all fees. That's what we just looked at. What we're going to recommend, for those of you who've read ahead in the memorandum, is there are external fee assessment providers out there that will look at your fees per unit of value added. And we think that's probably a really good metric for you to use. There is not enough publicly available information for us out there to get you that sort of statistic. So we would suggest having an external group come in and do that. And I know you've done that in the past, so that's something that we would suggest doing periodically. So let's jump on in. So levels of fees. We talked about this a little bit at the November meeting. And you'll hear me referring to these as level 1, 2, and 3 fees. Level 1 fees are the ones that most people think about when they think about fees, asset-based fees. And if you invest in nothing but traditional long-only stock and bond managers, that'll get you about 99% of the way there in terms of understanding what your fees are. That is that somebody's charging 30 basis points on your assets, and that's their fee. End of story. So that's easy. They're easy to absorb. They're consistent. You see them over time not changing a lot. So if you look at 1 year versus another, you're going to see a very similar number. And most plans do report that level of fees. Now we get down to the second level of fees, performance-based fees. And you see those come up a lot with hedge funds, with private equity managers. Sometimes you might choose to negotiate that with a traditional long-only manager, but it's less common there. But hedge funds and private equity and some real estate funds, you see performance-based fees being a pretty good chunk of your fees overall. If they're doing well for you, your fees are going to be higher in that year. And the theory is that it aligns good performers with you paying more, that you're paying for that good performance. And that when they don't perform as well, that you don't pay much, or as much, I guess. These are still relatively high fee structures. So performance-based fees are something that obviously comes through in terms of performance, and they can vary quite widely year by year, depending on how your managers are doing, of course. And then the third level of fees, and that's one that's kind of a hidden thing within the world. Not a lot of people pay attention to that, and I think it's great that you are looking at that level of fees because it's something we think is important. Within hedge funds and private equity funds in particular, real estate funds, they pass through the expenses of the fund. And that could be administrative fees such as legal, audit, things like that. Quite frankly, they're not very well regulated. And it's something that you should understand before you're making an investment. What are they passing through in those expenses, and asking about it after the fact. Unfortunately, I think a lot of plan sponsors out there don't look at that. So I know when we're doing our due diligence and looking at potential private markets investments, we're always trying to understand what they are passing through, what it's been historically, and making sure they're not one of those groups that takes advantage of that situation and passes through high fees. Now, again, whenever we're looking at fees here, these, of course, are manifest in your returns. So if one of these levels is high, it should reduce your returns. So that's something that's important to keep in mind as we're looking at it. Now, this is what you had, and I think that probably should say fiscal year 2012, so apologies for that. But this is what was reported in June 30th, 2012, for your fees for the prior year. And we have those three levels of fees: the asset-based fees, performance-based fees, pass-through expenses, what they were in terms of dollars, and what they were in terms of percentage of assets. So you can see the asset-based fees were about 77 basis points, about 25 in performance-based fees, and I would expect that number to go up or down. Could be zero some years, could be even negative if you have clawbacks with your private equity managers. And then pass-through expenses, and that totals 1.17. Now, when we sat down and said, let's look at this compared to your peers, I would love to tell you that everybody out there reports the same way. They don't. For most, in fact, I would say the vast majority of public funds out there, they only report on that first level. That we're not getting that level 2 and level 3. We did some digging. We talked to some funds, see if they were interested in joining us and creating a small database. not a lot of interest out there in additional disclosure of fees. So I think it is a good thing that you're showing this level of transparency, but it's something to keep in mind as we look at it. So when we're going through peer comparisons, I'm going to focus on just that first level. And it's not because I'm ignoring the other two, I just don't have data on them. We're going to go into the asset classes in a couple minutes, and we will look at those other two. Okay, so just bear with me for a minute as we go through, because peer comparisons, I just want to get them as close to apples as we're going to get. Peer universes, some caveats. There are not comprehensive peer universes out there. I can't say this peer universe captures every public fund out there. There are some good ones. NASRA is one we're going to be looking at, which is data from financial statements of about 100 different state and large municipal plans out there. So that's a pretty good database. Greenwich does a pretty good job, but none of them are comprehensive. So anytime you're looking at peer universes, keep in mind it's in the eye of the beholder what is considered peer. And you guys may disagree with what I've used as peer. You may want me to focus on larger plans or folks that you think are sophisticated or whoever you think is a well-run plan. We can do that, but for sake of discussion here, I've just focused on these kind of broader comparisons. Different plans have different goals. You have specific statutes that you operate within. You have a specific mandate to meet your liabilities over time. That's going to be different than the state next to you or the state across the country. So keep in mind we're looking at what's right for you. And then, of course, some have different restrictions. On fees, your number one factor is going to be asset allocation. You guys have a lot of private market investments. That ups your fees are going to be higher. So that's the bottom line. We'll be looking at that in a minute. Index funds lower fees. You don't have a whole lot of index funds. That's going to be a factor. Something that I know is being considered for change and something we would support. And then internal management costs. Those are often kind of classified in a different bucket. When we look at financial statements, a lot of folks will put it in their administrative costs. Some do capture it in investment fees, but sometimes they slip through the cracks. And then we have seen plans that only report invoiced fees, and those are fees that you get an actual bill for. So if you're in a partnership, if you're in a fund, those are just taken out of the assets of those funds, so they may be under-reporting their total fees. So at the end of the day, please, big caveat on the data. But this is the best data we've got. Your asset-based fees are about 77 basis points. We did some other comparisons in the memo. These are the two that I thought were the most important, but I'm happy to talk about any of them. NASRA, they're all fund average, so that we highlight that below here. That's a 2010 survey. They did not do a 2011 survey on fees that I'm aware of or could find. On 99 state and large municipal funds, and that was taken from the financial report, so what everybody else reported. So if somebody was reporting more fees, that's captured in that number too. If somebody was reporting less because maybe they just looked at invoice fees, they would be reporting obviously a lower number. That's about 36 basis points compared to what you have. The Greenwich public fund average, and we looked at funds greater than $5 billion here, and that left us with about 67 funds. So that's a 2011. That was self-reported, focusing on external management fees, and that is 47 basis points. There's no question it's bigger. Your fee number is bigger. So, why do we think that is? When we sat and looked down at the asset classes, we ran into a slightly different picture. But you know what? Let me just stop there because I suspect there's some questions on that. So why don't I pause and ask for questions?
I have a couple questions. I
course.
spent a lot of time on this, and I appreciate your work.
Thank you.
Especially as you're traveling around to get all this done. A couple things. We only report on our audited financials, invoice fees. So we're like everybody else. We report in our capital, which is unaudited, the other ones do.
Yes.
As far as the investment expense, we're the same as everybody else. We do have a state law that requires us to report these other fees, and we do, and I think it's a wise state law, and I sent that out. I'm on the pension committee now, National Association of State Treasurers, and we sent out a copy of that so other folks can see it.
I hope more people choose.
Because you're right, nobody wants to report fees. And second thing is you mentioned fees in the tables, and if I'm jumping ahead, let me know, but I thought we would ask it now. In the tables, you exclude some fees, like emerging market equity, you exclude fees from capital and Schroeder and things like that.
Where there's some pass-through expenses, right? Is that what you're thinking about?
Well, they didn't show up anywhere.
Okay. So what we were trying to focus on is where you had any sort of material fee. So in a couple cases, it's an important point. You do have pass-through expenses for some of your commingled managers that are in the traditional long-only space that are relatively small. So we did not include that for discussion here because quite frankly, there's no data on it. And we did look at the numbers, and they struck us as reasonable. So I'd be happy to
But
give
you
some
didn't
additional
include them in our
analysis.
total fee, right?
It is in the total numbers, yes.
I mean, the total number, but when you go asset by asset, like, say, emerging market, if you add in the pass-through fees, we go from 67 basis points to 73 basis points.
Right.
Which puts us, instead of below, we're above the average. If you go to some of these others, there are even more substantial changes. So I'll leave that like it is now, just, and
Okay.
as we go through them, we'll, and then the other thing is, I just don't know how to think about, and not being a CPA, clawback. We have very significant clawbacks, and I would have thought that's a liability from the previous year. But what we've done here is we've canceled out fees for this year. So, I don't know how to look at that, and it seems to me that you ought to include whatever the fees were this year, because otherwise you've got a 2-year surge instead of a 1-year surge.
Right, right, until the assets are recognized at the end of the day, of course, particularly if you're talking about private markets, they're just setting a value. And if the manager doesn't meet its hurdle rate, but it earned a performance-based fee in the prior year, there's something called a clawback, where basically they credit back to you a portion of that excess fee that they'd already earned, because it hasn't been recognized yet. It's very common in private equity. It is confusing when you start putting it into performance-based fees because you start to see negative numbers. But it's something that's very common in the industry. So it again gets back to hopefully aligning the manager's goals with yours.
No, I understand clawbacks, that wasn't the point.
Oh, okay.
The point is, say like for opportunistic credit, we had over $9 million in clawbacks, which gave us a minus $6,400,000 fee. So how do we reconcile that as we do a fee study? I mean, we may never see a clawback again, but what we've done is, for the purposes of a 1-year study, we cancel out a whole set of fees. I mean, what do the CPAs think? I mean, wouldn't you want to match your expenses with your income, and you deal with that from the year before?
I'll turn that over to staff from a mechanics, how they handle that internally.
I think the issue that's coming up is the accrued versus paid. And I think that's, I'm not looking specifically what you're talking about there, but I think that may be the issue.
Let me name the firm, and that way you may remember. We had significant callbacks with Angelo Gordon, Avno Europe, Celine, and Torchlight. So, I mean, I assume they're just standard fee. Y'all did a good job of making sure we got paid, and I'm happy with it, don't get me wrong. But how does that help us in determining what our fees are for this year?
Well, in effect, the way we look at it is that those fees are allocated to this year, because based on their performance, they lost the fees. The performance was related to this period. So therefore,
It was related to this year.
the performance was related to this year. Yes.
So in one calendar year, we had the clawbacks from the same calendar year to make it into the fee structure.
Yes, sir. We asked the managers to report to us what they would have accrued during that period. What we were really trying to isolate was the change in our NAV.
Wait a minute, that's different. I thought I'm sorry. And I won't belabor the point. I just want to raise the objection now. So this callback is for the calendar, fiscal year 2013.
Yes, sir.
I mean,
That's
for the activity of the year.
2012.
Okay. Yeah, thank you.
Yeah.
But it was for the activity or the performance of that calendar
12.
fiscal year, not the year before.
Correct. Now, they would have accrued it in a prior period. So say they would have earned it in fiscal year 11, we would have reported it in fiscal year 11. But the performance in fiscal year 12 was negative. And so, in effect, that amount should have gone back into our NAV. That's how we were trying to capture it. Those are the directions that we gave the manager, were to report to us the net effect on our NAV.
I thought I don't have this information in front of me, but I thought I looked up these managers and they all made money. And it seemed to me, especially like the Celine, they had a 10 or 12 or $15 million other fees expense in 2011. I just assume that was.
I don't know if I can speak about the managers off the top of my head. If you'd like to meet about it, I'm happy to meet with you. You know, we had a team of people looking at the fee reviews, and one thing they certainly did was in any negative accruals, they tried to look at the performance and make sure that it was reasonable. But, you know, I would like to take this opportunity to go back to our budget request, and that the team of people that we have reviewing these fees are primarily temporaries. And they are temporaries with the caveat of, one, that only one person had prior investment experience. So we are asking a group of people, you know, without a good bit of experience in private equity and hedge funds to do an analysis of fees. Now, we're getting the investment team to look at that as well, but when we say we need more staff, I think this is one of the things that we need more staff for. Or when we think about an administrator, if we could get the budget to hire an administrator, I think this is something that an administrator could do for us. And they could be very skilled in looking at fee arrangements with private equity companies. I think that we've made a very good faith effort to try to report all the fees that are there. But I don't think we're perfect. And I want everybody to know that.
So as long as that reflects the trading activity of fiscal year 12, and I think that's fair. I thought it was a clawback from the year before, some bids.
Yeah, they would have accrued it the year before, but based on their performance in the current fiscal year, we took it out based on the performance in fiscal year 12.
Thank all y'all for clearing that up.
Yeah, and
It's a
just a copy of
cumulative,
the,
it's a cumulative
annual report.
concept as opposed to a restart every year. I think that's one of the key issues is that we're looking at this on, at the end of the day, how much did you end up paying them for performance-based fees? So it's kind of a record-keeping issue until we actually find it. This is looking at everything from a peer comparison. So what do other plan sponsors report? We wanted to dig into a little bit further to better understand, we think a lot of it is due to your higher alternatives allocation, but we can't quantify that really precisely. So what we decided to do was to look at it on an asset class by asset class basis and see if there was anything in there that struck us as off. Anything looked high, not only at the aggregate level, but also on the manager by manager level. So we did do some peer comparisons against other managers. So let me explain how we did that. So what we start out with is the traditional asset classes, and we're just here looking at your asset-based fees. And that's because what we've got for universe averages is all asset-based fees. What we used is eVestment Alliance primarily. We also got some data from Greenwich and some data from cost effectiveness measurement that do show some basic averages. But we relied primarily on the eVestment Alliance. Let me explain what that is. That's a database of several thousand managers, and they report in their fee structures as well as all sorts of other information on what they offer. So what we can do is say something like, we know you have a large cap equity manager that's active that has $250 million, and if you pay them X basis points. What's the average out there of other large cap active equity managers for a $250 million portfolio? Run that. Get a very large sampling of well over 100 managers in most all the categories. As you start getting nichier, it starts to get, a little bit, a little smaller universe. But particularly in public stocks, you get good data here. So, universe averages here are basically everything. We've got the Greenwich in there, we've got eVestment, we've got CEM. And here's what your fees were on average. These are active fees, so we're not looking at index funds at all here, for your traditional asset classes. And I'll get into the non-traditional in a minute. They're a little bit more complex. But I just wanted to summarize where you stood. So here's where you're paying for your fee. The universe averages, apologies, I think I've got an extra zero there, but I think you know where I'm going with it, 31 to 67 in U.S. stock. Emerging market stock, fixed income, and UTAA. Methodology note for fixed income, you have a combination of core, high yield, bank loans, emerging markets, debt. We have a lot of things in there. What we did is took your actual weightings and weighted the underlying averages to get an average for this. So it's reflective of your structure. If we were to look just at core, just core fixed income, it would be a lower number. But this includes things like high yield and some of the more esoteric elements that are more costly in fixed income as well. So that reflects your structure. And then GTAA, which is also a broad category. And by the way, your GTAA fee does include performance-based fees. We have the statistics in the memo of what it is without performance-based fees, which is obviously lower. So overall, we found that you were on the average to, in some cases, low side in the traditional asset classes. Does that mean that we're satisfied with that? No. We are going to go back to all of the managers along with staff and push them a little bit harder because there are good reasons. Traditional managers, this is an area where you should keep going back to your managers every couple of years and making sure you're getting their best possible deal for your fund size and your mandate, because the terms change over time, and because these are liquid asset classes, it is appropriate to go back and ask for that. In some cases, I suspect we'll get some fee savings. So that's the easy one. But any questions on the traditional asset classes before I move on to the non-traditional? Okay, so non-traditional you have to look at in its totality, and that's difficult. There isn't one metric out there that gives you the average for hedge fund fees, because we have asset-based, performance-based, and other fees. And what we've done here is use Preqin, our own observations, so apologies, but it's just necessarily a little subjective, and some data from Greenwich. And where you're getting our subjective is mostly in that other fees category. We could find no data on what is normal out there, but we can tell you what we consider reasonable and what we've seen out there from leading providers and what we push on. So for asset-based fees in the hedge fund area, you're a little on the high side. So we dug into that and said, well, who is higher and are they earning their keep? And the bottom line is, I'm not going to go into manager names here unless there's a desire to. That would be more appropriate for executive session. But the bottom line is that the managers that have done some of the best performance for you are some of your higher fee players there. And they don't negotiate fees very often. So I'm okay with that asset-based fee. We'll still go back to the managers and ask for better. We're going to do that with everybody. I don't expect a lot of traction in the hedge fund, private equity, or other private market space. But it's worth asking. So your fee's a little higher there. We also have a performance-based fee, and let me explain the math on this. So you pay about 1.09 for the folks that have a performance-based fee. You can see here in the footnote, the average performance-based fee out there is 19% of excess performance. So you a lot of times will hear 2 and 20 for hedge funds. So that's the 20 part. The average out there is about 19. Unfortunately, it hasn't come down much in the last couple of years. It's gone down a little bit. But what we did is we took the performance-based average and applied it to your excess return to get a 1.4. So that would be kind of what the average manager would charge for that excess performance. And so you're a little bit lower there. And then other fees, we find about 10 basis points to 50 basis points typical of what good hedge funds are offering out there, not the folks that are taking advantage of the situation. And there are some prominent funds that do, by the way. And you've got about 13. So in its totality, we're fine with the hedge fund fees. Asset-based fees we'll continue to look at, make sure those managers are earning their keep.
Could I ask one more question?
Please.
On your total hedge funds, you had about a quarter of those were at runoff or being terminated.
Yep.
So there was no performance, and there were no performance fees. In fact, these guys had like minus 22%, minus 5%, minus 7%.
Yep.
And so, doesn't that skew that 1.09? I mean, if you've got a quarter of your assets that are
Yeah.
prohibited,
So,
if you will, from making any money. But of course, then the important part of that is that you still had to pay $4.4 million in management fees to have them sitting there making no money or
Right.
losing money.
Right.
So, yeah, how do you match your income with your performance? I mean, your fees with your performance on non-performing assets. So if you take those out, that drastically changes that 1.9 or 1.09.
Definitely the managers that underperformed, you're not paying any performance-based fee to that year. And they have something similar to that to the clawback provision in hedge funds called high watermark, which some of you may be familiar with. The managers have to earn back their underperformance before they start getting paid performance-based fees again. It complicates the analysis a little bit. But those managers, in theory, if they did badly this year and they do great next year, you don't pay them next year until they get back to where they are. But you're right, the analysis, it doesn't take into account all of that. It honestly makes it too difficult to get the numbers.
Yeah,
But what you're comparing us to is, you're using the same standard?
Yeah, I'm saying for the folks that earned a performance-based fee, was their performance-based fee reasonable given industry averages? And the short answer is yes. I think the treasurer's questions on those that underperformed, what are we getting for that? And the answer is, well, you get basically a credit to next year's outperformance.
Well, not just underperform, but they're terminated managers and they're runoff.
Yep.
They can't. And so you end up with a substantial amount of fees out. And also we had, I think, GAM, isn't that a fund of funds? GAM, Gotex, fund of funds? So that we have them in the direct case funds. So those are misclassified.
Other questions on the hedge fund?
Suzanne, I just have a question. This is Giovi. That the 2 and 20 traditional compensation to hedge funds, everything I've read seems to indicate that fee structure has been is under pressure. Do you see that as something that will be, that will come into effect over the near term, where that structure will be reduced at any great extent?
That was a great hope after the 2007-8 markets, is that hedge fund fees were going to be, really pushed down. And we saw a little bit of movement. The asset-based fees have come down somewhat, because 2 and 20 was really the norm back then. We have not seen performance-based fees come down much. Where we have seen some flexibility is where you decide to lock up your assets longer. So if you go to hedge fund manager Y and you say, I want to be in your share class that has a 3-year upfront lock and 1-year notification, they'll give you a full rate for that. But if you want to be in the relatively liquid share class, you're going to be paying full freight. So it really depends on whether you want to view your hedge funds as a portion of your illiquid assets and you're willing to lock up. You can get some fee breaks. I wish, Ed, that we'd seen more movement in that area. I think where we did see the greatest movement was in terms of consistency of terms and transparency improvements. Those are areas that hedge funds have definitely improved and become more institutional because they know the new money coming to the market is pension funds, and both on the corporate and the public fund side, not their traditional buyers who haven't been so much in need of transparency. But yeah, they haven't come down a lot, unfortunately.
Yeah. So I guess what you're saying is that structure is pretty much cast for the time being. I guess the other question I have is that there's been a lot of pushes recently, I think Blackstone being one of them, or a couple of them, where they have taken the initiative in reducing fees on ETFs and so forth. What effect do you think that will have on indexing and the fees in that whole area?
In hedge fund indexing or in traditional indexing?
Well, I guess what I've been reading is about the fact that some of these people will be reducing or have reduced their fees in ETFs. How will that influence fees generally in indexing and well, we know it will happen in ETFs, but how do you think that's going to have any further effect on fees in indexing?
I think it will, and that's been an area that's continuously come down. It's already quite low in the traditional long-only area, stocks and bonds, and to a lesser extent in non-U.S. U.S. and core bonds are the two areas that you can get very, very low fees for indexing there. And ETFs are, in some cases, a more cost-effective solution. Just depends on what you're trying to achieve and how much dollars you have. At your size, going out to the market on any indexing, you should be able to get it for a basis point or 2 or 3. You should be looking at very low fees there in terms of indexing. So that's something that we'll discuss if we look further at indexing. ETFs also can be quite cost effective. It just really is, I think you should always look at both when considering an index allocation.
On hedge funds, I see that you've got management fees, the percentage is based on the RSIC assets. But then in opportunistic credit, the management fee is based on the commitment. Is that just
yes.
How those work? Is that
yeah,
private equity?
That's how private equity works. You pay on.
What if you look at that part of this, and I understand there's a static amount of fees at the bottom. You total up the management fees for opportunistic credit is $16.2 million. But how do you look at that part where you're not fully invested? And you're committed, and we've had that problem with the hedge funds up here. We're paying the management fee, and we're in runoff, and some of these things are run off forever. So it's like say like a children or something, termination. How do you look at that? Because if you're paying, you could be paying 4%, which is the management fees, because it's a commitment if you're half invested. So when you book a 2 and 20, you really can't book a 2 and 20. You have to think, out. You see what I'm saying? I mean, it would be perfectly fine if you had $100 million in a 2 and 20, and you're paying $2 million a year. But in many of these, we're half invested. Still paying the 2% on the bigger amount. So you doubled your fee.
You can. On hedge funds, it's generally on the market value, and if you have a runoff that has, say, a liquid piece that's sitting around for a year or two, you're generally just paying on that little illiquid piece, and oftentimes they'll reduce fees. It depends. On private markets, it's very common in the industry, so we're talking here private equity, private debt, some opportunistic credit, oftentimes the value-added opportunistic real estate. You pay on commitment, often. There are some exceptions out there. And that's one of the reasons you often earn negative returns in the first couple of years of a private equity investment. The theory is that over time, as they draw down assets, they're going to earn better returns, make up those fees, and produce good returns for you. Oftentimes in the latter years, you will see a reduction in fees as they're winding things down. So it depends on how the terms are set up. Again, this goes back to negotiating this stuff up front, getting the most favorable terms you can, making sure that the folks that are negotiating those have a good ear to what is current practice out there, because current practice changes. And if you know current practice is a little bit of pressure on fees, you want to apply that. You want to know which terms to apply it to. So it's a long-winded answer, apologies for that. But generally in illiquid stuff, you're going to get it on commitment. Not every case, that's where they charge, and oftentimes it phases out at the end.
And I see what that's an industry. Oh, go ahead.
Because I think that's actually a very good point you're bringing up, because the treasurer was saying, I think Mr. Powell brought up the last time we first approved the private equity manager, paying on commitment versus investing.
Right.
And I think it's important that you understand that maybe early on while you're doing that, and research is going on, is that there's not a liquid market to go buy assets immediately. There's research, you have to go through and close on the deal, just like if you're buying a building. You just don't do it, buy a building first day. So there's this call down structure of this timing. So there's this feeling of overpaying a little bit up front. But I think what you have to...
Are they earning the fee?
What are they earning the fee? But I think the other thing you need to realize is that with the private market structure is waterfall. So as they're closing down the fund, and at the very end, what you typically find in private market investments will be you get your capital back, you get your investment fee and expenses back, then you get your preferred return, then the GP starts participating with their 20%. So that's typically what you'll see.
And importantly, you still have money invested while they're waiting to call it down.
Right, so it's in the markets,
So
it's not just sitting in cash. Usually in the markets would be the common
And
place.
as a relatively youthful investor in these markets, would be naturally not getting the benefit of the waterfall yet. It's still up the bad part of the ticket.
So I think we're coming out of it, but I think that's exactly right, is especially early when you start these programs, that you do have that J curve, and that's where you're paying out fees before the money gets invested, so you see that capital account balance going down before they actually get invested, and then the individual investments start to produce returns, they begin to realize it.
Yeah, everything you say, of course, is true. And being industry standard doesn't mean it's good, necessarily good for us, it's good for them. But a lot of these are 2008 vintages, 2009, 2008, 2008. So we've got a pretty mature opportunistic credit portfolio. And by looking at this, it didn't make a ton of money last year, but some. And I'll have some. Thank you.
So we've been talking about this, so let's just shift to the slide here. We've got the private markets fee, your total fee, and then what component of it is asset-based, performance-based, and other. So you've got your total fees, which are all under 2%, and in some cases that's because your performance-based component, private debt in particular, had a clawback. We talked about that earlier. What your asset-based fees are very much at the lower range of asset-based fees that we've seen. Performance-based, I wish I could give you some great statistic here. We can tell you we did look at each of the managers. We think they're reasonable. But keep in mind, when you've got a private equity manager, it's a complex fee calculation. Different managers have different performance hurdles that they've set, and the degree to which they participate in any upside over that. So these numbers strike us. We looked at the underlying terms and said, were there any big outliers, folks, that we thought that you were taken advantage of, or that the fees are bad? We did not see. So we think your performance-based fees are reasonable. Other fees, again, this is our kind of view on the markets, that you're looking at probably 5 basis points to 50 basis points in this space. And the one area of maybe a little attention is the other fees in real assets, to see what we could maybe get those down, or to understand better why a manager might have been charging more there. For example, they might have been charging a little bit more richly there, but not as much in asset-based fees, but we want to blend it into that. Strategic partnerships. So strategic partnerships are an amalgamation of different asset classes. We have some detail in the appendix of the memorandum. This is showing, if you took them all together, what do they shake out like? And you can see that they're dominated by hedge funds predominantly, about 45%, because it's the main way that you invest in your hedge funds. And then opportunistic credit and private equity are the two other big pieces. brings about 83% of this portfolio as alternatives. This is one of the main ways that you invest in the alternative space. The fees overall did strike us as reasonable. We just do not have peer averages. We're working with staff to dig into each of the strategic partnerships, really understand the fee structures. I know there's been some additional negotiation they're doing with folks to try and further reduce these fees. So this is where you stood as of June of 2012.
So on the 44% state funds, those are almost always fund-of-funds in our strategic partnerships?
No, many of them are, so you have some fund-of-funds like Grosvenor is structured as a fund-of-fund, and then you have some like Lighthouse where it's a direct platform and the managers are held on the Lighthouse platform. So both of those would be included in those.
What's the percentages of direct and fund-of-fund on Lighthouse?
So if you take Earnest out of the equation, because they're, sorry.
It's 3 fund-of-funds on Lighthouse, which is about 175 of the 1.23 billion that are used.
Yeah, it's around 12 to, right, about 12, 15% of that hedge fund component of Lighthouse is fund-of-funds versus directs that you're holding at Lighthouse. So you also have that one non-U.S. stock manager that's there as a separate account, right?
And do we have an idea about the hedge funds and the strategic half and half? Do we have a hedge fund versus fund of funds?
I don't have that statistic for you off the top of my head. I can get it easily, so happy to provide it, but I just don't have it right now.
Well, should we, because, I mean, it is a significant number, a lot, 20%, 50% of the hedge fund.
Depends on what strategic partnership you're looking at.
Well, as the group.
So as a Grosvenor or an Entrust has a fund-of-fund structure to them. If you're looking at an Apollo or Goldman Sachs, it's not a fund-of-fund, so it's direct investments in those funds.
Mariner has fund of funds.
The Mariner Group has fund-of-funds of our strategic partnership was invested in their direct funds.
And keep in mind, we're striking this as of June 2012, so lots of changes have occurred since then. So some of these strategic partnerships have been subdivided into their component pieces. Some managers obviously aren't with us anymore, so there have been changes, but this is where we were then.
And was there an effort to fund of funds to modify the fees we pay?
So this was, I think I'll turn that over to staff to talk about since they did the data gathering. So if I may.
Well, and then one last question. And what were the parameters of this study? I mean, what were the instructions?
I cheerily volunteered for it at the November meeting. I'm rethinking that. No, we're happy to do this. So I know there was a lot of debate and discussion about fees at the November meeting. So we offered to come up with an analysis that gave you a little bit more comparison against peers. There was not in my view, there wasn't a really specific definition of that. I would need to go back to the minutes and see if there was a more specific mandate.
And could we get these numbers if you added back in the other fees that you took out?
Yes,
So
so it
like
should all
what?
add back up to your totals. Everything we have in that appendix of the memorandum should add back up.
Let's say like at Bridgewater, we've got them at one fees, and Subic or more. I mean, you took out these fees here. I mean, you say it. You're very honest about it. Did you add those back in?
Sure, they're in the appendix, everything's together, and they're in the memo. I was just trying to keep it simple so where I had peer comparisons, that's where I had to kind of carve out some stuff. We just don't have peer comparisons on some of these.
Curtis, or Mr. Chairman, may I ask a question, sir?
Please.
I'm sorry, I had to step away for a moment, but get my cough out of here. But in any event, Curtis, I want to make absolutely sure that this whole discussion on what Suzanne has given us here in terms of fees and so forth, I want to make sure that we all understand it, A and B, that you are satisfied that you are getting us some deep and accurate information, and if there is anything that you don't feel that you are getting, I would like to hear that. My own satisfaction, and we'll address it right here now. Do you feel confident that you are comfortable with what you've been told?
Well, not totally, and I'll get with Ms. Bernard afterwards, because, you know, I spent 10 hours in this chart. Anybody else spend 10 hours in this chart?
Not quite 10, but it's
Yeah,
been a
I
lot.
did, we
A
went
lot-
through it
lot
backwards and
you
forwards,
did.
and I think the other fees have to be accounted for someplace, and I realize they might not fit perfectly with peers, but that's the burden we bear because we have more alternative investments. And so we've got to, we can't exclude portions of these fees out of here. When you put the fees in, some of these that are below average go above average, and some of them move significantly, like the global asset allocation. That's a significant move there. So I'd like to see those, and that's it. And then the original charts, and I'm not sure that this reflects all this, because when we first started talking about this, we had a chart here, so strategic partnerships, and it had very low amounts of alternatives. The first chart had like Apollo at 35% alternatives, and I think Goldman Sachs was at 50 or whatever they were. So things had been taken out of them, and it just didn't tell us, well, it kind of did tell us, but it didn't really tell us what it was. So that's important to me, because we have, on June the 30th, 2012, we have 3 different sources. We have the external auditor says, we have 4 sources. External auditor says we have 58% alternatives. NEPC says, I think 50. I've been asking for information for months. I can't get it. The Bank of New York says 58%. And then y'all say 43%. So we have a 15% swing on one quantification on one day by 4 competent folks.
Ms. Bernard, I'm going to give you a chance to answer that statement / question to say, but I want to add one thing. First, have you furnished the NEPC figures and report that Mr. Faulkner just referred to him or not? Ask for it, have you furnished it?
I'm trying to think of all the requests for NEPC of what's been furnished. And there was a request for the letter for verification, which is all the extranet and presented.
Whatever it was he just said he asked for and couldn't get it.
Yeah, which one was that, Mr. Chairman?
It's the one I have right here. It says, I've been asking since, I think, August. Can I have the NEPC compliance letter and the underlying mathematics? And I got a response back from you yesterday that says, oh, here's the letter, which I've had since we got.
What I've seen is a January 21, 2013.
Well, that's just what you
request
sent.
In a February response to that.
Yeah,
Is there something else we're talking about?
Yeah, a month later, he provided what's on the internet. So I asked for the math months ago, and I've got it here. And so, and it was very clear, and it says, and you finally said, I'll be more than happy to reach out to NEPC. But that's what I asked even in this last one, a month ago, and it hadn't been done yet. I'd like to talk about compliance, but of course I can't.
Okay, all right, I think everybody
There was a
understands
question
the
about-
issue here. Go ahead, first.
There was a question about NEPC's information that comes from Bank of New York and feeds Investor Force, their performance analytics system, calculates these numbers. So when you're asking for spreadsheets and things like that, it's a dump that comes in from Bank of New York that feeds a system that calculates these numbers. And so I'm not sure what you're going to get other than the reports NEPC's already provided.
Well,
Is that the same Bank in New York that we earlier heard we could just match a button and get it installed?
Yeah, now here we go. Okay, so let's be careful. The AIP compliance, which I believe that our alternative allocation was 50%. Am I right? I could be wrong about that. I haven't looked at it in a while. Last year's AIP. Anybody know?
53, I believe.
53, okay. So we have 58 from the bank, 58 from the auditor. And he doesn't give a number, but evidently it's 53, which it might be. I just like, if I could get the math. Now, we asked, because he has to certify something, and he'll have a number, it'll be hedge funds, or private equity, he's got numbers. And when I can see those numbers, then I can figure this myself. Now, this is the outrageous types of information I asked for, but on that, by the way, is set or bonuses and compensation, which leads into my central stuff we talked about. And so that's why I've asked these questions. They're important.
All right, let's return to the agenda. What we're talking about now is HEK's fee analysis and report. Ms. Bernard, turn to that, please, and
Last
also
slide.
state whether or not you have been open and candid with the treasurer on all the questions you've been asking. You know.
Tried to be.
Give us an idea of the number of those questions and the number of
Sure,
answers.
yeah, the treasurer's obviously been very interested in this memo, and we spent some time talking on the phone as well as sharing some information, and honestly, he caught a mistake of mine. So in the appendix, we originally did not have opportunistic credit included for the strategic partnerships as the count for alternatives. We had a column that says alternatives. There wasn't any intent behind it, it was just a mathematical error. So we corrected that, that's the version you all have in front of you. So originally, there was a lower number for some of these folks.
We all originally had a draft version
Yep.
of this report available to all of us.
Right, that's the big thing that
To ask
changed.
questions.
So, but yeah, I think we had good dialogue and made some good points, and hopefully we incorporated it in the memo. So, we're trying to make this responsive. It just,
Can we pass a definitional rule of what we consider an alternative, please? Right? Because I know of no SEC requirement or other requirement that defines an alternative,
That's
right?
good.
I know what it's generally considered, right? But for God's sake, can we just define it?
Yeah. But
We
we
have a
should, whatever it
suggestion.
is, we should stick with it. We did
Right.
define it. It's in our AIP, it's in our audited financials. The bank does its accounting by the information that the commission
Let's
gives it.
return to the agenda. We're on a fee analysis now, and as I understand it, a suggestion for redefinition of alternatives may or may not come up here.
yes,
in
we'll
your
bring that up
report.
in the asset liability
Okay,
study.
we'll get
And
to that.
it's just our best thinking on how they're commonly defined out there. So you can do, at the end of the day, whatever you want, but yes, I would think that's a very healthy practice to have a common definition in one group. So these are rather obvious, I've been talking about them, but we're going to revisit all the existing manager fees. Just because some of these look like they're average to low doesn't mean you should be satisfied. Let's make sure they're the best possible fees we can get. Don't want to strong arm managers to the point where they're not earning a living, but I think we've got a little room. And then to continue to aggressively negotiate whenever a new investment's being made. We've worked with staff on this, on the few investments that have occurred since we were hired, and we have found that they've been very good about pushing on terms and all the things that we would suggest doing as well. So we're in dialogue with them on that, and we found that that's been something they're already doing. Can't speak to past practices, but all the new stuff has been done very well. And then annually, it's smart to look at this. Even with all its thorns and its shortcomings, it's still good to know where you stand. We do recommend that because your asset allocation is different from the average fund out there, that it's smart to periodically employ an external firm that specializes in that. So I don't want to get into names of firms here in open session, but there are a few firms out there that focus on looking at alpha per unit of costs. And they will neutralize your asset allocation effect to see really, have you been paying a little bit more or a little bit less than average. So we found that that's used very successfully with many large public funds and helps cut through some of these issues and help you understand really, are these fees on the high side or on the low side. And we think that that data is gathered through them being hired by lots of groups to do that over time. So it's one of the reasons it's not the public domain. So we just don't have access to that sort of data. So we think that would give you some additional insight and maybe address some of these question marks as to the total fund fee versus your clears. Any other questions?
One last one. Do you think we'll do a fee study in comparison to performance?
Yes, that's exactly what they're looking at. So one of the key
Oh, that's the
things.
CM. Thank you.
Yes, firm not to be named. One of the things they look at is alpha per unit of cost. So that's a very important thing to be looking at. You could have a lot of stuff going on, but it's not producing alpha. You know, so as I said before, we didn't even look at performance here. That's something you want to look at separately, though, as it relates to your cost effectiveness.
Okay, thank you.
Okay.
Are you going to handle the next time?
Actually, I'm bringing up one of my colleagues so I can get my voice back. So
Okay.
I'd like to introduce Phil Kavarkas. Phil is and his team worked very hard on the asset liability piece of this study. Brady and others obviously worked quite a bit on the asset allocation piece. We work as a team, but I wanted to just let you know what Phil's background is before we got too far into this. Phil is an FSA, an enrolled actuary, and a CFA. And for those of you not familiar with the actuarial world, FSA is very difficult to attain designation in the actuarial world. He's has about 20 years of experience. About half of that was spent as an actuary. He's currently our Director of Investment Policy Service and Asset Liability Modeling for Hewitt Ennis Knapp. And you oversee a group of, pretty big group of people.
35 people.
35 folks that do this. And all we do really are asset liability studies. We're not doing actuarial valuations like your folks at GRS within our group. There is another area of our company that does that, but not the public fund. And he works with Gabriel Roeder Smith and whoever else the actuaries happen to be for our clients to make sure we're using their data and modeling it correctly to reflect your liability circumstances going forward. So we're not trying to replace GRS in any way, shape, or form. We're just taking their data and marrying it with how assets behave. So we can give you a better picture of what asset allocations will help you best meet your liabilities over time. And you guys conduct about 300 studies a year, is that correct? So we do that for a wide range of clients, lots of big state public funds, just like yourself, and I can speak to many that I've done in the past with them, so it's very helpful. So what we're going to do today is talk about a very important form of risk. There was a discussion earlier about how are we looking at risk. I would say one of your biggest forms of risk is having an asset allocation that doesn't meet your liabilities over time. And a lot of people will point to that 7.5% and say, well, we just need something that'll produce that. It's not that simple. You've got to have something that's going to move with your liabilities over time. And when we have exogenous factors that affect the market, how does this hit you and what are those worst case scenarios in terms of funding status? So these are various forms of risk that we'll look at from the asset liability perspective. And then we're also going to look at some things like liquidity risk. We're going to look at how everything fits together in terms of your asset allocation exposure, and basically set forth a framework to move forward with. So with that, I was going to spend just a minute or two on the executive summary, and then I'm going to hand it over to Phil to talk about the important world of actuarial science. I need to switch presentation, or is it just?
You have another one, or?
Yeah, it's the asset liability.
No, that's right.
Okay. Technical issues, we're going to pull this up. You should all have it. It's just a matter of whether it was on the PowerPoint or not. So the book we're going to be speaking to is the Asset Allocation Review, rather lengthy document.
Try red 274.
274?
Yeah, try that.
Okay.
That it?
There we go. Great. So we're going to talk about each of these issues in depth. But I just want to give you the big picture view, and then let's go into the details. So unless there are huge questions, could we maybe hold off until we get to the detail on it? Because I want to make sure we move along and give you the, certainly questions are welcome, but I'm going to dig into each of these independently a little bit later. So as we discussed, we use the data from GRS. We're trying to create a risk-efficient portfolio that focuses on helping you meet your goals over time, making sure that we're maximizing your funded status while minimizing the downside risk associated with that. If you just assume that markets are going to earn their average over time, we know that's not true. So you have to model in shocks to the system, bad years, good years. We do a lot of modeling there that Phil's going to discuss and how that all fits together. Not unlike other state plans out there, your funded status isn't great right now. It's something that you have a plan for moving forward, however. Legislature's put in place some contribution rules that'll help you get there over the next 25 to 30 years. And so we're going to be seeing additional contributions get you there. So the question becomes, how much do you want to be reliant on investment return as your lever? There are many levers that we're pulling here. One is contributions and the policy associated with that. One is investment risk and return. Another is beneficiaries. What are they getting in terms of benefits? So all of those fit together, obviously, to get us to truth here on our funded status. We would suggest that it's not worth trying to aim for the fences, take a lot of risk just to try and make up a shortfall. That is imprudent and will, over time, get you to a worse funded situation if we have bad markets. So what we're suggesting here is balancing risk and return, making some small changes overall to the plan. We did, however, look at this with a clean slate perspective. I'll talk later about what it takes to be successful with alternatives and why we were comfortable recommending the mix that we did. But this is basically how it breaks out. So we're recommending that you slightly increase your overall exposure to global equity, a little less to diversified credit, a little bit more to real assets, a little bit more to opportunistic type strategies, a little less in the conservative fixed income area. And if you break that down into big asset categories, stocks, bonds, and alternatives, okay, and I'll stop here. Alternatives we defined as real estate, private equity, private debt, opportunistic credit, commodities, hedge funds. We did not include GTAA, but to the extent you do use a GTAA manager that happens to be a hedge fund, they would be counted toward this. So we'll talk about that more in just a minute. So what that shakes out to is a roughly equal split between stocks, bonds, and alternatives within the proposed. And the current, it might look like we're increasing your alternatives. We're really not, though. What we are recommending, remember you've had in place this portable alpha overlay. So as a reminder to everyone, that's basically a low-risk hedge fund component that doesn't have a lot of beta exposure. That's the risk I'm referring to there. It doesn't have a lot of beta. That was overlaid with equity futures, basically, to keep it simple. There's more behind it, but that's a simple explanation. We're recommending removing that, not having that, and I'll go into why that is. But when you had the full portable alpha overlay, that gave you about 43% in alts, using the definition that we just provided here. We are recommending that you be allowed to use hedge funds to a small extent in other asset classes. Again, I'll talk about that in a minute. If you fully use all of those, that'll still only bring you to 39% in alts using this definition. So that would be your maximum allocation, effectively, given these targets. So let me show how this breaks out. I'm sorry. Let me talk about some other things that relate to this first, sorry. We are recommending a couple of other constraints. One, that you restrict private market investments, those that, and we define that as those that have an initial lockup of 5 years or more. Doesn't matter if you're in year 1 of it or year 10, year last, they would still be considered illiquids, so just keep it simple. That not be more than 21% of assets. We put a little bit of a range around there, plus or minus 3. So that's one way of controlling risk. Another is we have a relatively low allocation in terms of targets to hedge funds. We are suggesting that you be allowed to use them in some other asset classes, but that they have a maximum constraint of no more than 15% of your total fund assets. This is something we've been seeing at sophisticated funds around the country, where they recognize that hedge funds aren't the easiest to define asset class. If you think of something like equity long short, that often could be used in a global equity portfolio as a substitute for a long-only manager. The key things that we'll be getting at later is it's still benchmarked against a long-only benchmark. So if staff chooses to use a long-short equity manager, they'll be held accountable to how it rolls up in terms of total performance. So it's truly a question whether they're additive or not. And then as you'll see, we're collapsing all of your public equity into global. So this is how it shakes out in terms of your current targets versus your proposed targets. Keep in mind that your current U.S. equity does incorporate that portable alpha. You can see where we're collapsing it into global equity. You can see where the changes are. I'd highlight a couple of things. We are recommending a slight reduction in private debt. We're expanding the mixed credit category to include loans a little bit, CLOs. We are expanding the targeted allocation to hedge funds, but removing that portable alpha overlay. So net-net, it actually reduces your overall hedge fund component. And then if you look down among core fixed income at the bottom here, you do see a mix of increases and changes there. You also notice there are asterisks on some of these asset classes. Those are intended to be a marker for where staff could choose to recommend a hedge fund structure for a manager if they feel that it's going to be additive to the overall asset class and do well in aggregate against its benchmark. So that's a discretionary choice, not a mandated one. So not a part of the target. And then we also have suggested changes in rebalancing ranges. This is a very important form of risk control and a meaningful change that we're recommending here. Again, getting back to this discussion of risk. How close are you to your targets? We're recommending a very material reduction in the ranges. Now, I know staff had a little bit of concern about this, particularly as it related to illiquid markets. What if we have another 2008, God forbid? If we do have that sort of a market, we suggested that those are very, hopefully, unusual events, and that you would come to the commission and basically say to the commission, we are unable to rebalance without meaningful cost to the fund, and that it would be granted an exception. So we don't see that as an impediment here. This would be assuming normal markets. And then we've summarized the asset class benchmarks. Again, I'll be going to each of these in depth, so please don't worry that we're kind of zipping through this. I just wanted to summarize the big picture stuff. You'll see some changes across here, but I would characterize the changes as de minimis. We're comfortable with all your current benchmarks. None of them are wacky, not common. In fact, they're some of the most common benchmarks used out there by public funds. We are recommending some evolutionary changes and things that we think will improve the measurement. So with that,
I can't help but interject and ask one question.
Of course.
What you just said about the benchmark, did you all discover any evidence or indication of an effort or a deliberate attempt or anything to structure the benchmarks in such a way that it would maximize the vote hours and pay time?
In our opinion, we did not.
Did not?
No.
And exactly, who said that there would be that laying around Reynolds? Pardon? That was not my comment. You have
I'm just
business-
asking a
No,
question.
you're not just asking her anything.
Mr. Loftus,
Yeah.
if you want to get the floor, you seek the floor, and I'll let you ask the question.
I'd like to stick to business. Quit asking questions as a veiled way to attack me. You had your ambush. It's over. Let's be done with it, okay? Somebody else step on.
So we're going to move on into asset liability analysis. Some of this gets a little dense, I'll warn you, but stay with us. It's very important stuff. What we're trying to do is look at your asset liability circumstances and model them out to say, how could we perform in a variety of different markets? I think this is important for the commission to be comfortable with, because you'll know in advance, if we do have some unfortunate markets, how it's going to affect the fund. And hopefully you'll be that much more comfortable in your decision and staying with the course when we run into that. So I think it's important to look at the downside as well as the upside of these asset allocations. With that, I'll pass it over to Phil.
Thank you. So we
Can I
started.
ask a question, Suzanne?
Of course.
When you,
Go
just a
ahead.
little earlier, you alluded to so-called normal markets and what you project and so forth for normal markets as opposed to something on the outline of 2008. Would you regard normal as defined by up or down? 10% or 20%, or how would you define it?
I hesitate to even use the phrase normal markets. I've been in the industry for 25 years now, and I've yet to see a normal market, honestly. So I don't think there is one. It's I think you'll find we have a pretty wide range of what we would consider in our asset allocation modeling to be normal these days. So I'll if you don't mind, I'll leave that to Phil to maybe talk a little bit about the different markets. We do have a slide later that's probably worth spending a minute on, which summarizes kind of our outlooks for the markets. We don't say we have a crystal ball, but you know, what are the likelihoods of various scenarios, and how does that all shake out together? So that's probably our best characterization of what would be considered normal. But it is generally going up, is what we consider normal, but not in terms of double digit.
Thanks.
Thank you.
All right. So just for framing the discussion purposes, we started with a collaboration with the plan actuaries. We wanted to make sure that we, as of their latest actuarial valuation date, were in sync with their actuarial results. Now, as of July 1 of 2012, the plan was in an underfunded state. As you know, the actuarial value of assets funded ratio was about 66%. And the funded ratio using the market value of assets was about 56%. Now, as Suzanne mentioned, we're going to talk about these 5 broad categorizations of asset classes: global equity, real assets, opportunistic, diversified credit, and conservative fixed income. So we'll be talking about a study of this asset allocation as it compares to several others. Now, frankly, this study is the perfect opportunity to study a wide variety of potential portfolio allocations across the risk spectrum, from the low end of the risk spectrum to the high end of the risk spectrum. And that's exactly what we did as part of this study. Now, just an observation, and that's that the plan is underfunded. So because the plan is underfunded, there is a need for upside. There's a question, though, as to how much does the plan shoot for upside, how much can the plan tolerate on the downside. So we're evaluating kind of both tails of the risk spectrum on a projected go-forward basis and presenting those projected pension financials to this group for consideration. So when we think about a pension fund, if you think about the perfect balance would be to have assets equal to the liabilities. And if you think about how liabilities behave over time, there are benefits that are accrued by your participant base, and then the liability, which is increasing every year based on the actuarial interest rate used. That's the actuarial expectation for the return on assets. Your assets are growing each year because of contributions into the fund,
and because of asset returns. Now, if your assets and liabilities are equal, and your contributions equal the new benefit accruals, and the asset returns equal the actuarial assumed interest rate, the liability return, then you have a program which is perfectly in sync. Now, in this case, we know that the assets are less than the liabilities, which suggests that the assets need to play a bit of catch-up over the next several years. And how will the assets play catch-up? They'll need to play catch-up via some combination of contributions and investment performance. If we look at the performance of the plan between June 30 of 2011 and June 30 of 2012, these are the actuarial valuation points. We saw that as of June 30, 2011, on an actuarial value of assets basis, the funded ratio was 68%. And we see that by 2012, that was similar, 66%. On a market value basis, the funded ratio had moved from 59% to 56% between 2011 and 2012. So that's an important backdrop, because that June 30 of 2012 represents the starting point for all of our forward-looking analysis. When we look at your pensions funded status relative to a broad swath of your peers, that funded ratio, 66%. If we look at the upper left-hand corner, you can see the distribution of public funds in a NASRA survey. The plan's funded ratio was below the average, but it's starting to get into that hump of the distribution. So you'll notice quite a few other publics in that 60 to 70% funded ratio range.
Phil, can we just take a minute on that, because I did want to point this out. Your expected return that you got of 7.5% is on the lower side compared to at least where most public funds were at 2012. About 83% of funds are using a higher return expectation than you are. So that feeds in obviously into your fund status as well.
Okay. So just to kind of frame the discussion, for starting point, market value of assets, you see in the upper left-hand corner of the page, about $25 billion. Actuarial value of assets, now this is a smooth value of assets, and that number was about $30 billion. The actuarial liability, as determined by the plan actuary, about $45 billion. So if we think about the funded ratios then on both a market value basis and an actuarial value basis, 56% on the market value basis, 66% on the actuarial value basis. The other thing I wanted to point out on this page was the bottom left-hand corner, the expected benefit payments for the program on a going forward basis. And you'll see that it's a very long-dated obligation, a very long-term obligation with long-term horizons for investment purposes as well. You can see it spans several decades with a hump that's several years out, several decades out in fact, with a hump around 2042 or so. So just reinforcing the point that this is a long-term proposition. Okay. Now, this page covers the toolkit that we have to manage pension plan financials. 4 main levers for managing pension plan financials: investment strategy, funding strategy, plan design, and the actuarial methods. Now, you can manage your plan using all of these levers. For purposes of this discussion, we're focusing on the investment strategy. So that's really the top. And here we're focusing primarily on the construction, the portfolio allocation, and specifically, how do we allocate our assets which are deemed return-seeking, and how do we allocate our assets which are deemed risk-reducing, or safety assets. Now, page 21 shows the variety of investment portfolios that we've studied for this purpose. You can see across the top of the page the current target policy, which is what we call an 80% return-seeking portfolio. Suzanne alluded to this portfolio earlier. You can also see 4 alternatives mapped across the page. The first alternative was what we call the proposed solution. And this portfolio strategy, again, as Suzanne alluded, 85% return seeking. You can see the mix is similar to the current target with subtle changes to 5 broad asset classes as we discussed earlier. Just to illustrate the other 3 alternatives, there is an alternative 2, which is a higher return portfolio strategy. Alternative 3 and 4 are limiting the exposures to alternatives. Alternative 3 essentially half limiting it, and alternative 4 entirely limiting the exposure to alternatives.
Why do you recommend alternative 1 if alternative 2 has the same risk but a higher return? What's behind that difference?
Same risk as your existing portfolio. But pointed that out.
But less than alternative 1?
Yes, so
I
we've
mean,
got,
more than alternative 1.
we've got expected risk here on the measure, and I wanted to spend a minute on that because there was discussion earlier about alternatives and the shortcomings of using standard deviation for that. I'm sure you all read with great interest the appendix where we had our capital markets assumptions. We completely recognize that shortcoming. So we actually use market volatility as a proxy, and Phil, if you want to talk about that, so private equity is an example of what we do there.
Yeah, absolutely. So I'm going to share some statistics about the return expectations and the expected risks for the variety of portfolios. But just to explain for a minute the capital market assumptions which are used for purposes of these analyses. We have a variety of, it's in the appendix, a variety of capital market assumptions for a variety of asset classes in the market. It's something on the order of 25 or so asset class assumptions. So we have expected returns, expected risk, and expected correlations of all of these 25 classes with each other. So those are representative of our views, forward-looking views, both on a 10-year basis as well as a 30-year basis, which were used in these analyses. For what those asset class return and risk characteristics look like, we then incorporated statistical analysis to kind of blend these asset classes, and correlations here are important because what we're trying to do is build asset classes which are uncorrelated with each other. So if the bottom falls out of one asset class, you're protected with the others. Now, a couple additional points. Equities and fixed income, those tend to be easy to model. The alternatives tend to be less easy for reasons that they're not publicly traded, and so there are difficulties if you're looking at historicals. We make adjustments for some of the lag effects. We make adjustments for some of the artificial smoothness of the historicals when we look at forward-looking. So as an example, private equity has a volatility which is representative, we think, of the true value of private equity rather than the reported value of private equity. We view private equity as an example as having very high risk relative to public equity. So in any case, those were the bases for these risk and return statistics. Just to highlight some of the comparative results, you can see that the current target policy, if you look at the 10-year forecast period, the current policy has an expected return of 7% and an expected risk of 12.5%. Okay. If we compare that to the proposed solution, you can see that the expected return for the proposed solution is slightly higher, 7.14% rather than 7%, with slightly lower risk, 12.5% as compared to 11.5%. Right, so from both a return and a risk perspective, the proposed solution, we feel, has advantages relative to the current policy. Now, just to kind of move across the page, you can see that alternative 2 has a higher expected return, 7.57% over the 10-year period, with the same risk exposure as the current target, but higher risk than the proposed. And then you can also see the effect of removing or limiting or removing private market investments. You can see that the return expectation is decreased relative to the proposed, and the expected risk is higher.
So if this group decided that the alternatives recommendations that we're making are too aggressive, and you say, no, we want to mitigate that a little bit, we'd like to pull it in a bit. Alternative 3 would be what we'd be looking at as a very viable alternative. We think alternative 4 is probably not a good fit for you, but it's often raised as kind of, here's what do we look like versus a 60-40 simple portfolio. So that cheap portfolio I talked about earlier, we could do very simply. That's what we've got here in alternative 4. I do want to point out something that probably struck all of you as you looked at these numbers. These aren't, for the 10-year numbers, they aren't 7.5. They aren't higher than 7.5. So that may alarm you. You may say, oh no, we're not going to meet our actuarial assumptions. Keep in mind, actuarial assumptions are very long-term projections. And your actuary uses a 2.75 inflation number. Right now, we're using a 2.3. That's just what we observe in the market. There's no right or wrong projection here. That's just our best thinking. We think it's important for us to give you our best thinking. 30-year, which is really what you should be caring about and what we're eventually moving toward fully funded status over the next 30 years, we do believe that most any of these portfolios will achieve at least, on average, a 7.5 return or better. So I just wanted to get that out of the way right up front to see if there were any material concerns about that.
I apologize for, go ahead and ask your question.
By the 30th year, are you suggesting that the average will be 7.55? Is that what, so that's taken into account that the first 10 years are going to be somewhat suppressed?
That's right.
What I was going to say is I hesitate to interrupt because we're right in the middle of this, but this is sort of an okay stopping point. We did have lunch scheduled at 12:30. So what I would like to suggest is we take a kind of a short break, about 10 minutes. For everybody who ordered lunch is in the break room right now, and we're way behind schedule, so maybe we could reconvene and we could lunch while y'all talk.
Quite all right.
Or we can take a longer break.
Keep it short because I got to get back.
Okay.
Say 10 minutes?
10 minutes. Reconvene at 1 o'clock. But I can eat kind of any other thing.
So just to kind of recap where we were, we left off when we were covering the risk-reward characteristics of a variety of different portfolios that were studied in our asset liability analysis. So this is a tabular representation of the asset mixes and also the risk-reward characteristics over both a 10-year and a 30-year investment horizon. Now, the next page is simply the same information but broken down into the subclasses of those 5 broad asset categorizations. I'm not going to spend time here. It's just more detail on what those asset classes entail. And page 23 is a graphical representation of the efficient frontier, essentially the graphical representation of the risk-reward trade-offs of a variety of portfolio strategies. Now, just to illustrate the points, the current target policy is a blue triangle, kind of in the middle of the page. It has that expected return of 7%. As you'll recall from the previous page, again, here we're using our 10-year capital market assumptions for this purpose. And risk characteristic of about 12.5%. And when we compare that to the proposed solution, you'll see movement kind of to the north and west. Now, if you look at the axes, the vertical axis is the expected return of each of these portfolios, and the horizontal axis is the risk. So this is essentially the risk-reward trade-off. The ideal is to move to the north and west. You want as much return for as little risk as possible. And the blue triangle is improved by the red circle, our proposed strategy, because of a slightly higher expected return and a reduced risk characteristic.
Can I ask a question? Because my assumption is y'all obviously have more modeling capabilities, but spend a lot of time with we talk with our different hedge funds at different times, right? Correlations can go through regime shifts and actually switch time, right? For long periods of time, right? Stocks and bonds have a negative correlation, whereas the whole history has a positive correlation. Do y'all model for that stochastic property or the changes in the correlation? I mean, or is it just a point estimate, or is it updated? I mean, how's that handled from our perspective in the modeling?
Absolutely, great points. And the short answer to your question is yes, the model reflects all of those things. Just to elaborate on that for a minute, capital markets perform in ways that aren't well represented by, you know, your normal distribution bell curve. And so capital markets have exhibited things like fat tails in the distributions. And also in times of stress, the correlations of a variety of asset classes tends to increase, right? Because in times of stress, asset classes tend to move in tandem. We call that regime shifts, because you have different correlation coefficients based on different market environments. Our stochastic modeling incorporates all of those things. Just to talk about our stochastic model, 5,000 economic trials over a 10 to 30 year projection period, and 5,000 economic trials captures the best of times, the worst of times, and everything in between.
With changing correlation.
With changing correlation, changing regimes, the fat tail. That's an important point, because frankly, the models of old didn't incorporate those enhancements. Okay. So if we're examining these efficient frontiers, you'll notice two curves on the page. There's a blue curve and a red curve. The blue curve represents the risk-reward trade-offs of the portfolio strategies that include alternatives as we've modeled them. The red curve represents the risk-reward trade-offs for portfolio strategies without alternatives. So you'll notice the blue curve kind of lies to the north and west of the red curve, suggesting that from a risk-reward quantitative standpoint, advantageous properties there of portfolios with those alternative strategies. The next page is simply a tabular representation of the things that we described on the previous page. Page 25 shows the return distribution over a 10-year period, cumulative compound, for each of the strategies in question. Starting with the current policy, and you can see that red triangle represents the expectation. And you can see that it's 7% expected return for that current target policy. With a distribution around that red triangle, the distribution,
Hold on one second.
Call Ed back.
I couldn't hear you over there. But
So the blue bar represents the different percentiles within the distribution. The bottom of the blue range represents the 25th percentile of our projected outcomes. The top of the blue bar represents the 75th percentile. Think of the bottom of the blue range as a pessimistic case over the next 10 years, and the top of the blue bar as an optimistic case. Now you'll notice that the distribution spans even further with a couple of lines. The very top of the line represents the 95th percentile trial, and the bottom of the line represents the 5th percentile. So you can see now what the tail events lead to. Think of the top of the top line representing a very optimistic case, and the bottom representing a very pessimistic case. So quite a range of outcomes. You can see that for the current policy, expecting 7% return over the next 10 years, but quite a span of potential outcomes to the tune of anything between 0% cumulative versus 14% cumulative compound. So there's quite a span of outcomes. Now, how does the proposed solution compare relative to the current target? Well, the expectation, which is again the red triangle, is slightly higher, 7.1% instead of 7%. And the distribution of results is slightly narrowed. What does that tell us? That tells us that there's less volatility in the proposed solution, i.e. more predictability. Now, these are all on the margin, right? These aren't fundamental shifts, but they are subtle improvements to the risk-reward characteristics as we see. Alternative 2, as we described earlier, has a higher expected return, but the span of outcomes is wider than the proposed. And then you can see what happens with 3 and 4, where we start restricting the allocations to the alternative classes of private investments. There you can see that the distributions start moving south relative to the proposed. Now this is important because it will implicate the asset liability projection analysis, as we'll see in a couple minutes. So this, the following page.
Good timing here.
Hello? All right, we're back.
Okay, thank you.
All right, so the following page shows the 30-year outlooks. Similar analysis, similar outcomes. I won't belabor the point, but similar characteristics here across the investment policies that we've modeled. All right, so on to the asset liability projection analysis now. And just to say it, I've alluded to this already. We performed a stochastic Monte Carlo simulation analysis, 5,000 economic trials over the 10 to 30-year projection periods. The 5,000 trials are intended to represent the span of potential economic outcomes from the best of times to the worst of times and everything in between. We utilize these simulations in the projection analysis for the assets, and we marry that with the liabilities in order to determine a variety of things like funded ratio projections, contribution rate projections, liquidity need projections, and economic costs, which we'll define in a minute. And we studied all of the portfolio strategies that we've highlighted thus far. We're going to focus, for purposes of the body of this discussion, on the two in question, the current target and our proposed solution. There's additional information in the appendix if desired. We can talk about those as well. All right. So page 28 shows the projected funded ratios on a market value of assets basis. Now, you can see on the top of the page, we show the projected funded ratios for the current target policy, and on the bottom of the page, the proposed solution. Now, we call this projection analysis, by the way, this is a 10-year projection analysis, and we call this the funnel of doubt. So there's a funnel of outcomes, right, as we project forward over the next 10 years. Each of these lines represents a different percentile in the distribution of the 5,000 trials that we projected. Now, the dotted line in the middle represents the central expectation. So in our central expectation, we're expecting the funded ratio to improve from 55% to 62% for the current target policy over the next 10 years. Now, in the most optimistic of cases, is shown here, the 95th percentile, that funded ratio can eclipse 100%. It can eclipse 100% in 2019, and all the way up to 115% at the end of the 10-year period. Right, that's the best case scenario, or the very optimistic case. Very pessimistic case on the flip side, 32% funded ratio. So you can move south of 50%. There's not, it's to the tune of a 25% likelihood of being below 50% by 2014 on a market value of assets basis. Now, if we look at the proposed solution, very similar results. Slight improvement to the central expectation. You can see that it ends at 62% just as the current target ends. There's actually some rounding there. It's actually slightly better. And you can see that at the intermediate points, slightly better funded ratios to the tune of 1% better. Really not substantially improved, subtly improved. What you'll also notice is the tails have come in a little bit. Again, not substantial changes, but the tails have come in a little bit, suggesting less dispersion of outcomes, higher certainty of outcomes, more predictable outcomes. So this is the projected funded ratio on a market value of assets basis. If we flip the page, we can now see what happens on an actuarial value of assets basis. And recall that we started at the 65% funded ratio level. And you can see that the central expectation kind of trends sideways. It trends sideways over the next 10 years because you're spending some of the projection period kind of amortizing away those unrecognized losses. You haven't fully recognized all those losses because the market value of assets is lower than the actuarial value of assets. The actuarial value of assets will be pulled down artificially over the next 10 years. You'll also notice a tighter dispersion of outcomes. That's by its design. The actuarial value of assets smooths the value of assets. And in essence, these results are going to be less volatile than the market value of assets. So it's important to understand that the actuarial value of assets funded ratio calculation, because that's what the actuary uses for funding purposes. But it's also important to understand that based on the true market value, you're going to have a slightly wider dispersion of these outcomes. Similar characteristics if you compare the proposed solution to the target, whether you're talking about actuarial value or market value of assets, very similar properties across the projection period.
Can I ask another question? What's the rebalancing assumption, like how a portfolio is rebalanced and the impact that has, like if you find yourself above, a band within a period of time? And what sort of the assumptions on rebalancing features?
Sure. So for purposes of this modeling analysis, we've assumed annual rebalancing target.
In Herschel, when y'all rebalance, y'all are rebalancing typically what frequency?
If there's not a set frequency, I guess it's probably 6 to 8 times a year. But it's more on where the allocation actually is within those bands.
We would not recommend annual rebalancing, but for purposes of making the model work correctly, having it operate in bands is very difficult.
Yeah, that's right. So the model essentially works in annual periods, which is why we assume that the rebalancing is annual. Okay. Other questions? All right. Next slide shows the projected contribution rate. Projected contribution rate has a funnel as well. For the current target policy, you'll see 19% contribution rate for starters, trending to about 21% over the 10-year period. You would expect this contribution rate to trend sideways, slightly higher as you're working through some recent amortizations of unrecognized losses in your actuarial value of assets. And if you look at the comparison between the current target and the proposed solution, again, very similar results. Slight improvements in the central expectation, slight improvements in the tails. Page 31 is interesting. This is the liquidity need analysis. Now, I mentioned earlier that you had assets which had to play catch up given the underfunded nature of the plan. So this liquidity need analysis is trying to determine whether there's a net inflow or outflow of your assets, and we've determined that essentially there's a net outflow. Now, what's this calculation? It's essentially comparing the contributions in versus the benefit payments out. And we find that the benefit payments out exceed the contributions in to the tune of about $1 billion per year. Now, that was actually the case for the past year. We're actually expecting that relationship to moderate a little bit, 4% trending down to about 3% in the central expectation. But you'll see the 3 to 4% band for the net outflows there. Given the net outflow nature, this is going to mean that the assets are going to be fighting an uphill battle to play catch up. It's just an additional complication as you're having the assets try to catch up to the liabilities over time. And there's a range of outcomes here as well. You'll notice that outflows could be as high as 5.5% of the asset base, and that's going to be dependent on capital market performance. So it'll be largely a function of the asset value at the beginning of the year. So that was a stochastic analysis looking at year-by-year projections. Now what I'd like to do is work through some scenario analysis. Okay, so we often hear from our clients, well, okay, so the 5,000 trials, that's great, we get it, there's best case scenario, worst case scenario, everything in between. What happens in the real world? So this analysis is trying to capture kind of a what if scenario. What if markets are about as we expect? What if we have difficult markets? What if we have rosy markets? How does that implicate our pension plan's funded status? And so we've analyzed a variety of equity return levels, a variety of interest rate and inflation levels, and you can kind of see that there's several different periods over time have kind of landed in a variety of places in this spectrum. So let's see what these different economic scenarios mean for pension funds. By the way, so some scenario probabilities, just to gain our bearings in terms of what's the relative likelihood of these different scenarios. And you'll see it's on the average 5 to 15% in each of these buckets. You'll see that on the or the vertical axis, you've got the level of return on equities, generally high, moderate, or low. And across the top of the page, inflation. And here we're using interest rates as our guide. Low interest rates, moderate, and high. And generally speaking, they're roughly equally split across the spectrum. We see that there's, for example, a 40% chance of moderate equity returns over the next 10 years, a 30% chance of high, and a 30% chance of low. So that's kind of how the model works. So if we look at our scenario analysis, I'm going to focus on the ending funded ratio under a variety of different economic scenarios. And we have this red, yellow, green display methodology. So let's start with the moderate, kind of the base case. What if markets are smooth and steady, and not overly fantastic results, but smooth and steady upward movement of markets. And we see that the expected funded ratio at the end of the 10-year period, about 70%. Now there's a range of outcomes. Again, we're using the stochastic analysis, but the expected ending funded ratio, 70% in the smooth and steady economic scenario. Now you'll notice the next two, the low growth scenarios, whether it's high inflation or low inflation, the low growth scenarios have funded ratios of around 45%. So that tells us that if the equity markets don't cooperate, the plan's going to have difficult financials. And the corollary is in the high growth scenarios, the plan is doing nicely, over 100% in the expected case at the end of the 10-year period. What does this tell us? This tells us that the financial health of the plan will be largely contingent on how equity markets treat us over the next 10 years. If equity markets are good to us, we could see funded ratios north of 100. If equity markets are sour, we can see funded ratios south of 50. And if we have the smooth and steady, kind of dull, but motoring along equity markets, we can see funded ratios around 70%. Now, we've also done a historical scenario analysis, kind of repeats of what's happened throughout history. Frankly, very similar story to what we saw earlier. I'm not going to belabor the point. Okay. And then finally, just to get into some risk-reward trade-offs over the 10-year period, we've done some analysis on economic cost. We're defining economic cost as the present value of contributions plus the present value of the ending shortfall over the 10-year projection period. Just to give you an example, let's say you funded $20 billion over the next 10 years. And then at the end of that, your plan is still $5 billion short. We call that economic cost $25 billion, right? Because you funded 20, but you still have $5 billion to go. So that's how we're defining economic cost. And we have a broad distribution of economic cost outcomes for a variety of different investment strategies. And we've constructed kind of an efficient frontier within the context of your pension plan finance. So just to explain, the vertical axis is the 50th percentile expected case. The horizontal axis is the risk, the 95th percentile of the distribution. And a variety of different strategies were studied. You can see ranging from 40% return seeking all the way up to 100% return seeking. And the current target has an expected economic cost, by the way, the table on the right shows the numbers, $26.6 billion in the expected case for the current target, with an expected risk of about $42 billion. So in the expected case, we think the plan costs about $26.5 billion. But if we had a worst case scenario, we're looking more like $42 billion.
And Bill, to be clear, that's present value cost,
Present
correct?
value,
So
correct.
we want to maybe just explain how that's calculated?
Yeah, so we present value things using the expected rate of return that the actuary sees. And so notice, again, the ideal state is to move to the northwest. And you can see how the proposed solution subtly improves things relative to the current target. Not substantial improvements, but subtle improvements nonetheless. You can see that the proposed solution has an expected economic cost of $26.3 billion, a $300 million expected savings over the next 10 years. And a risk savings as well, the risk savings to the tune of about $1 billion over the 10-year period. So you're moving in that north and west direction, albeit subtle.
Now, I just want to point out, this is where this became compelling to us. When we were looking at the cone charts, quite frankly, we were looking at very, very modest improvements by moving your asset allocation. So the question is, why move at all? This is where we started to see some more compelling arguments. I would point out that we had a lot of discussion of whether that alternative two made more sense. If we'll look through there, you'll see that in some cases that's a more compelling alternative, but it is a much more aggressive stance and one that we felt was just probably going a little too far. So we sought instead to work more with your current risk level and to try and diversify it a little bit more. So thus why alternative one was recommended. But these are the graphs where we really kind of saw the benefits coming together in terms of cost and ultimate funding status when you combine the two.
So this is economic cost, and again, this is using our 5,000 economic trials. Now, the next slide illustrates a couple things. The stagflationary scenario. So you'll recall there was about a 10% probability of a stagflationary environment over the next 10 years. Two important points here. In the stagflationary environment, I take that back, three important points. In the stagflationary environment, the proposed solution still moves north and west. It still appears to be a robust solution because it's reducing the expected economic cost and the risk. But notice that the curve of outcomes isn't so vertical anymore. It starts becoming horizontal. That tells us that in the stagflationary environment, risk isn't rewarded. You're taking risk without getting a commensurate reward. And if that's the case, it's not a slam dunk. So let's understand that risk won't necessarily be rewarded. It might be expected to be rewarded, but it won't necessarily be rewarded. One final point on this page, if we look at the expected economic cost for the current target policy, it's about $36 billion in these stagflationary scenarios. That's important as well because you'll recall on the prior page, kind of the central expectation, including all the economic scenarios, about $26 billion. The stagflationary scenario has an economic cost of $36 billion, a $10 billion increase. So again, subject to the market movements, your costs can be increased, perhaps substantially. So understand kind of the sensitivity of your pension costs over time to those market movements. Page 40 is an analysis of the present value of contributions over the 10-year period. Again, I'm not going to belabor the point, a similar picture here as well. Expecting contributions over the next 10 years of about $16 billion, and the proposed solution, subtle improvements there as well. And then finally, on the ending funded ratio, again, the same type of story. The proposed solution, slight improvement on the current target. You'll see that the current target is expected to end at 62%. The proposed solution also expected to end at 62%, albeit slightly higher. There's some rounding there, with slightly less risk, downside risk. So, kind of to wrap it all up, the alternative one, that's our proposed solution, provides a higher level of expected return and slightly lower risk relative to the current target. The differences are modest. If you look at the 10-year projection period in terms of funded ratios, they both increase to about 62% over the next 10 years on a market value of assets basis. The basic portfolio, which is alternative 4 with no alternatives, essentially didn't improve the funded ratio central expectation over the 10-year period. And then in looking at 30-year periods, we saw kind of trends upward. By the way, we have some 30-year analyses in the appendix. Trending of the funded ratio towards 100% over the 30-year period. With that, I'll pause and ask for questions.
We're going to shift into some more issues on the actual asset allocation range and such in just a second.
No questions, good.
Great.
Thank you.
Keep it moving. So, I'm going to make you stand up all this time. So I will move through this. We've talked about several of these items, but I just wanted to, we're going to see an increase in alternatives, but let me show you where we're seeing it. In hedge funds, going from 5 to 8, and keep in mind, in this current target, it doesn't show your portable alpha overlay, so that would have been another 13% hedge funds, so it's not showing up in the targets necessarily. And then in real estate. I'm sorry, real estate I mentioned, and then hedge funds. So where we're recommending increase in alternatives are in the lower volatility, generally lower risk asset classes. Again, risk is sometimes a subjective concept, but we believe that it can, any risks associated with the hedge funds can be mitigated, managed. But these are things that are diversifying in nature. We're not trying to continue to punch the accelerator to reach for higher and higher and higher returns. You'll see actually in some of your most aggressive asset classes, private equity kept it basically the same, but private debt actually reduced it somewhat. So we are looking at kind of shifting around where you're taking a little bit of your alternative risk. Summarized all the key differences here. I think we've talked about all of these. I'm just doing a little quick. So in emerging markets debt, we do have the latitude. We're suggesting the latitude to mix it between the dollar and local. That's just more of a strategy implementation sort of concept. The structured credit concept, we want to include in mixed credit, so CLOs, ABS. So giving, for return-seeking fixed income, to give a little bit of latitude in terms of the types of securities there, while keeping a very conservative fixed income component as well, so separating out those issues. And then we're increasing the global fixed income slightly and changing some of the short duration cash allocations. So let me spend a minute on alternatives, and we'll keep going along in asset allocation. But this is what we're characterizing as alternatives here. And smart people can disagree on this concept, but we're suggesting this would be the way to be looking at it. So it's very similar to what you're using currently. Perhaps some of your tactical asset allocation managers might be considered alternative. But what we've suggested here are private equity, hedge funds, commodities, private debt and opportunistic credit, and real estate. Now, very importantly here, if you choose to use hedge funds in any of these other asset classes, let's say you hire an equity long short manager and they happen to be in the equity category, you're still counted toward the hedge fund allocation. So keep in mind that those things still roll up. We're trying to make it very clear where you're holding alternatives. Right now, that's about, if you use that categorization, it's about 20% of your target assets, but that excludes portable alpha. If you include the portable alpha, that's about 43%. That's where we're getting that number. We're recommending that the target be 32 with a latitude to go as high as 39 if you choose to use hedge funds and some of these other asset classes. So it is a lower overall possible allocation to alternatives in what you have currently, but not by a lot. It goes from 43 to 39. I don't want to act like it's a big change. So we're not including GTA managers or any of these other categories in alternatives unless you're using a hedge fund manager within those categories. So you may choose to use a hedge fund manager in several of these categories. So we're seeing alternatives continue to grow, not as much as they were maybe 5 years ago, as a percentage of all public funds. We'll look at some peer statistics in a minute. But we are seeing folks continue to use more and more alternatives. So I think a lot of plans are actually moving more toward where you are than away from it. So on average, we're seeing increases there, particularly among the largest public funds.
Is this classification of alternative, of what is or is not an alternative, is that unique to South Carolina, or is that what y'all?
This is what
Is
we're
that what you're
suggesting.
using throughout?
So what we're suggesting is what we've used consistently throughout this book, just to try and keep it as apples to apples as possible.
Is that what you suggest for other public funds? Or
It is.
Is this suggestion unique to us?
No, that's what we suggest for other public funding.
Can I ask another question, and this may be more personal, right? Port of has the effect of leveraging the portfolio.
Yes.
But we never report a gross, you know, we never see gross exposure listed anywhere, right? You know, in the nature of that, right, because we effectively have leveraged it, we got more assets out there, we're gonna have higher fees, you know, for different things. I mean, what is the effective, you know, deleveraging, right, of this, right? I mean, is that one of the reasons why we look different and we're not really talking about it? Because effectively, we have a higher gross exposure than other plans.
So your hedge funds would be collateral behind the overlay component.
That's right.
So that's the offset, if you will, of the collateral. If you didn't want to do it that way, the other way you would do it is you would fully cash fund it, if you will. So you'd securitize, if you will.
But this is a fully cash funded program, right? Or do we still overlay some?
Still over.
What?
We're suggesting that you eliminate the portable
Yes.
envelope program entirely.
So the total allocation to hedge funds is 20%. 15 is for portable alpha, leaving a net of 5, which is being picked up on the other page. That's what you see.
So effectively, our gross has been about 115, roughly. Not quite.
Probably a little less, yeah, from a beta perspective, yeah, exposure to the market. So that goes away.
It's a good point. Hedge funds have betas, and,
Well, I'll say too, on that point,
yes.
the implementation of portable alpha is beta adjusted. So you have $5 billion of hedge funds, you're not putting on $5 billion of equity market exposure, you're adjusting it. And there's roughly a 0.2 beta, so you put on $4 billion of exposure versus the $5 billion of hedge funds.
Got it. And you do have a low beta exposure overall in that overlay to start out with, but it is still, you get credit beta, you get other pieces that hedge funds demonstrate. So you do have two pieces working both in the capital markets. And that's one of the reasons that we're not huge fans of portable alpha. We don't think it's inappropriate or anything like that, but it's something that we've not been fans of overall. We think the approach that we're suggesting here, and I'll go into in just a minute, of using hedge funds where they have a heavy beta exposure within the asset classes that they are supposed to be in is a smarter contemporary practice.
I do have one question based on the definition of alternatives. Point number 3, over 3 years, that's material use of derivatives. As we think about Bridgewater all-weather risk parity strategies, how would we go ahead and categorize that as a hedge fund, or do you consider that still part of the GAA?
Right. Most people do not consider Bridgewater all-weather to be a hedge fund. What we're going to suggest for the next meeting is where you have these fuzzy, the hedge funds are at best a fuzzy definition. If you ask Bridgewater whether they're a hedge fund or not, you're not going to get a clear yes or no from them. So, and they're not alone in that. I don't want to pick on our friends at Bridgewater. But what we suggest and what other funds have done is to have a framework for what is a hedge fund that this group agrees on and that we apply. So if you do have anybody that's in that fuzzy turf, because quite frankly, there are commodity structures that aren't technically hedge funds, that quite frankly are hedge funds in operation as far as we're concerned. So I think a consistent definition is important, that there's no confusion within this group. So we would suggest that for the next meeting we'll come back with a recommendation on that. So for example, I work with State of Maryland, and we have, I think it's 8 or 9 criteria that we developed with the staff and the board, and if they meet, I think 7 of those criteria as a hedge fund. So it includes things such as fee structure, liquidity.
We let them self-define.
So based on the policies, we've just lumped in GAA and risk parity as alternatives, but they haven't necessarily been categorized as a hedge fund. Now, pure alpha, for the macro, that's considered. But the all-weather, the risk parity strategy has not been classified as a hedge fund, but it has previously, in that 53%, been categorized as alternatives.
So it is a muddy issue, so I don't want to gloss over that at all. I think we need to have a specific definition so everybody's on the same wavelength, and we'll provide that for the next meeting.
So the global asset was 10.3% or something like that?
Roughly.
And so the balance of, how much was the portable alcohol? What was that
About
percentage?
13%? No, it's about 15%.
Was that one manager or who managed that? That only Russell.
It's all the hedge funds rolled up into that 20%, and there's a 15% allocation.
You can't Russell in that crowd as well, or is that different?
Russell would be the overlay part of that
Part of that
15%.
trade.
Just want to go over why we think you actually are well positioned to continue to be successful in alternatives. This is looking at the system today. We think some of the qualities for success with alternative investing are having a long-term commitment to the asset class. This isn't something you move in and out of easily. I think you all are aware of that. Access to top-tier managers, and that can be either through your consultant helping you, your staff, your prominence in the industry. All of those things will potentially give you access to folks that want to partner with you and that you have sufficient assets to partner with. Having appropriate staffing or external support processes in due diligence, ongoing monitoring, legal and term negotiation, operational due diligence. And then the ability and willingness to take advantage of market opportunities, either by allowing your managers to do that, such as a global asset allocation structure might, or a macro manager might, or through doing that within this group or through staff, and then liquidity, obviously. We do look at alternatives, even those that are liquid, as something that you should look at with a little bit of an eye for your liquidity. So we talked about this a little bit. Let me just point out that hedge funds, we don't think fit the definition of an asset class. They've become one in public funds, but honestly, they're more a series of strategies that have some common qualities. So the risk levels in a hedge fund can range from extremely conservative to extremely aggressive. And it's more, how do you use those hedge funds, and what does the structure look like within your program? Increasingly, we're seeing large corporate and public funds moving to a framework where they make use of hedge funds occasionally as kind of substitutes for active management. So you might have a long-short equity manager instead of holding a traditional long-only stock manager. You'll see how we're going to deal with that in just a minute, but what we're suggesting here is that you recognize, you allow that latitude. So we have the dedicated allocation to hedge funds of about 8%, and those would be funds that have a relatively low beta, that are truly diversifying, that aren't going to be moving in lockstep with the stock or credit markets. And then where you do want to hire managers that move more like the stock and the credit markets, that they be allocated to those asset classes. And at the end of the day, be measured with the rest of their brethren within that asset class against a long-only benchmark. That's a tougher benchmark, and it's something that we think is the right way to be looking at that. But let's limit it. Let's make sure that there's no more than 15%, and that includes both the 8% targeted allocation to hedge funds plus that additional 7% latitude if it's used. We do not suggest that that be something that you have to use. It's just if you choose to use. So risk. We had a lot of discussion about risk today. So what we tried to do here is say, is this decreasing or increasing your risk? Somebody may say, well, we got a little bit more alternatives. I think that increases our risk. We would suggest that actually this is overall decreasing your risk. That we're removing the overlays that could cause the fund's effective markets exposure to be in excess of 100%. We talked about standard deviation returns. We're talking here the expected risk is lower, and we do include market proxies to try and mitigate the concerns with modeling alternatives, but we recognize that nothing's going to be perfect there. We've removed some of your explicit overweights to more aggressive asset classes, such as emerging markets, and made it more of a broad-based global stock exposure that can be used. We've allowed hedging or not in the emerging markets debt, so that's one way of potentially controlling some currency and ultimately political risk. We do see some slight improvement in your liquidity profile, so we're taking a little bit off the table in your long-term, really illiquid stuff, particularly private debt. And as you'll see in a second, we've got much tighter rebalancing ranges, and I don't want that to go unaddressed. We see that as a key form of risk control. What increases it? We got a little bit less in cash. So what we're looking at here, and we'll look at in a second for targets, is a lower cash allocation and short duration. We suggested staff continue to have the latitude to have a little bit more than that and choose to equitize it or put in place some other sort of overlay to get the market's exposure they want, put on the cash. And we're collapsing all of your stock effectively into global equity. So that does give some latitude to be a little overweight in emerging or a little overweight in US or non-US. And that is effectively for staff to do. And you could say, well, maybe they're wrong occasionally, so we need to be aware of that. So we think overall that it's decreasing your overall risk. We've already talked about peer comparisons a lot today, so I'll just go through this quickly. But what we're showing here is, again, those big buckets, a couple of different universes. The first two are public funds. So here's, we stole one of our competitors' universe here. RB Coons has a public fund universe in excess of 20 billion, so the very large funds like yourself. Thought that would be interesting. That the alternatives exposure here is about, and we're showing our proposed, by the way, not your current. So proposed asset mix versus some other folks out there. So you're still a little higher in alternatives and a lot lower in public equity as opposed to that. And my apologies, that global fixed income line there should be 25%, not 2. Just those of you with a keen eye for math probably figured that one out already. And then we also show a broader universe that includes a lot of smaller plans. So this is Bank of New York Mellon's universe, one we use internally. And these are public funds greater than $1 billion. So a lot smaller group in terms of their asset size, but larger numbers of them. And their alternatives allocations even lower. Just for reference, not that you should be comparing yourself ever against an endowment or foundation, but I've heard that comment used before as it relates to this fund, that it has more of an endowment foundation structure. And I'd say you don't, but I just wanted you to see where those types of investors are positioned in terms of alternatives. And most of that's hedge funds and private equity. Liquidity. So I just wanted to show you how we were looking at liquidity quickly. And we looked at it, there's a lot of different ways one can look at liquidity. This is a simple matrix that we've defined that I think works well when you're trying to look at all sorts of different asset classes with different qualities. So we've got liquidity here on the top, and then market sensitivity. So how much could it move in any one quarter? So if you got something that's illiquid but it just marches along in terms of value, that's a little different than something that's illiquid and can vary widely quarter by quarter in terms of its value. Those are things you should treat differently. And if we were to look at your proposed allocation and how it shakes out, and we added medium here just because there was a lot of stuff you had that has some limited liquidity, such as hedge funds, your high yield, global tactical asset allocation. Those are things that in normal markets are pretty liquid, but they have potentials for lockups or potentials for markets being challenged and you not wanting to move out of them. And then we have, of course, the low area here. So what we see is that overall in the high liquidity area, you have quite a lot. 31% overall in public equities. Commodities are quite liquid generally. Core fixed income, global bonds that are hedged. The big countries, and then of course cash. A lot, and when you pull all those together, I think it's about 49%. So roughly half of your assets are things that we would consider to be highly liquid. With that caveat, we've certainly seen markets where even highly liquid things have frozen up. Cash markets were frozen briefly during the 2008 crisis. You couldn't get out of a commingled index fund. So I don't want to make this the end-all be-all, but this is more saying, what are we generally looking at in terms of liquidity? Benchmarking, not going to go into this. This is why we think benchmarking should be used and what are qualities of a good benchmark. There's no question that as you get into the alternatives area, it gets tougher and tougher to benchmark success. They don't have investable alternatives that I can go out and readily price. You have to ask yourself, what are we trying to accomplish in this area? What's a good way to be benchmarking it? What we've summarized here is your current benchmark and your recommended benchmark. You'll see some changes, but I'd like to emphasize that the changes are really quite minor at the margin. I'll have a slide that goes through them in detail, actually. Please.
Well, you have a primary, what I call primary benchmark, and then you make secondary and
yes.
How do you use the secondary?
Yeah, so where we use that in two different places, and they both are the highly illiquid, difficult to benchmark areas, private equity and private debt. Private equity is probably the easiest one to talk about on that. So what we've used here is your primary benchmark, so what you would see in your flash reports, your performance reports on a quarterly basis. So things that you can get pretty quickly and observe how the manager's doing. is basically your opportunity cost. So I expect some premium for bearing illiquidity in this market, and the commonly cited liquidity number is about 300 basis points over a broad-based stock portfolio. So we've used, like your former consultant used, a combination of U.S. and non-U.S. stocks. So that's an opportunity cost, if you will. I chose to be illiquid, and I could have invested in the stock markets cheaply, so I need to be producing some sort of higher return. However, we think that you also need to evaluate them against other private equity managers, and there aren't quarter-by-quarter peer comparisons in that world. We think you have to look at it on a vintage year basis. So if something was funded in 2007, how to do against other 2007 funds. That's something that comes on a horrible lag, like almost a year, quite frankly, and you probably only want to look at once a year. So just how are we doing? And so that's what are we doing against other private equity managers? I'm just not satisfied with the fact that we happen to have outperformed or didn't outperform this public markets opportunity cost. So we try not to use a lot of secondary benchmarks because it muddies the waters. Are they doing well or are they not doing well? But in private equity and debt, we think it's important to have, basically a little bit more of a picture there. Here's where we cover what changed, and I would be happy to go through all of these if you'd like. Let me maybe just highlight those that are meaningful. So I'm going to focus, if everyone's all right with that, we recommended a slightly broader global public equity. We suggested that you use vintage years in the private equity, which we just talked about. High yield debt, it's a little broader benchmark, and we think more representative of an institutional portfolio. So broad real estate was one place that we recommended change. We're recommending something called the ODCE, the ODCE, which is basically open-end funds from NCREIF. So it's core real estate, it's net of fees, it includes a little bit of leverage. We think it's a much better peer benchmark than the NPI. ODCE is pretty new. It hasn't been out that long. So we're just changing our clients in the last year or so over to ODCE from NPI. NPI, just for those of you not familiar with what you had been using, is a property level index. It doesn't include leverage, and it's gross of fees. So it's actually harder for folks to beat that are being measured net of fees. We did add a 75 basis point increment on top of the ODCE. So we're saying NCREIF ODCE plus 75 basis points. And you may say, well, why do you have that? We anticipate, although we haven't finalized at all with staff, where we're going with real estate. So we may come back to you with a slightly tweaked recommendation. For example, if they come up with a more aggressive structure in real estate, I'm going to up that number from 75 to maybe 100. If they say, no, 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 we're just going to invest in core, then we might go with that. But basically that's saying if you choose to invest in riskier portions of the real estate component, we expect more return. So we're using ODCE as a base, but it's mostly core. So if we add any more aggressive components, we want to have a return threshold over that. Hedge funds. We did actually recommend a slight change here. I wanted to chime in earlier, but I didn't want to kill the momentum of the discussion. Basically, we're moving from HFRX to, we're suggesting including HFRI. So let's just look at those real quick. So what we have right here is you're currently using the HFRX. We're suggesting the HFRI. So what is that? So these are all hedge fund research. HFR is hedge fund research, and we're suggesting continuing to use them. There is no perfect benchmark out there for hedge funds. The HFRX, I think very smartly, excludes funds that are no longer open to new monies or funds that are no longer exist. We're using the HFRI. We think it's a little tougher because it does include those that are close to new monies, sometimes for good reasons, sometimes not. I'd be happy to show you performance comparison. I didn't bring it with me, but they aren't materially different over time. So I don't want to make it sound like one is massively outperforming the other. We just, this is our best thinking on hedge fund benchmarking.
Well, one question. So we'll have one hedge fund benchmark for all our hedge funds?
So that would be for the hedge fund component. When you are using, let's say, that hypothetical long-short equity manager within your global equity component. If you may have a benchmark for that manager, measuring them against equity long-short managers, let's say, but ultimately they fold up into the global equity component, which will be measured against global equity benchmark. So We're not, you only have 7% of your total fund to be measured against the hedge fund returns. Okay, so you're holding those folks to a little higher standard, and we're keeping a low beta overall exposure in the hedge fund.
One thing I just noticed,
Yes.
on the private equity, the current benchmark allows the 3-month lag from the reporting.
Right. So we would want to do it on the same quarter which you're getting data. So if your private equity data, which is often reported on a quarter lag, that's very common, we would be using the prior quarters.
Okay, so
Equity.
you're referencing would lag.
It would be concurrent with the data received. So if it was our fourth quarter report and private equity data is 3Q, we'd have the benchmark be 3Q too. Other questions? And then we have some very small changes down here you'll see in the short duration, but those are just minor changes in the indices. Rebalancing. We're recommending set targets. This is the last topic. Thank you for your patience. We're recommending set targets and much narrower targets than you have currently. We think this is an important form of risk control. We want to allow a little bit of tactical latitude for your staff to add value there, but we don't want it so wide as to make the asset classes targets meaningless. So we think there's a real balance there. You could say one approach to rebalancing is, hey, we're going to constantly stay on these policy benchmarks, but that's a very costly endeavor requiring a lot of trading, a lot of activity. So we think there's kind of a give and take there between having rational rebalancing ranges that are wide enough to add a little bit of latitude for value added, but not so wide that we can get way out of whack. We have an analysis here. I'm not going to go through it for sake of time, but it's basically saying tighter rebalancing ranges are generally better. And so what we're recommending here, and I'll just go through it in terms of real term funds, is a couple of interesting things. Global equity, we're recommending macro overall rebalancing range for that. And keep in mind, global equity is global private equity plus, global public equity plus private equity. The reason that we're setting a macro rebalancing range here is to make sure that we're not operating at the highest end of this range, so that we don't pull this all up to 49% of the fund. The reason that we felt that was important is because as you get down to overall conservative fixed income at 15%, that's a pretty low allocation. So we don't want to have a really wide downside rebalancing range. We actually created an asymmetric range here. So you can only be 5% underweight there, but you could be 10% overweight because it's a conservative asset class. In the more aggressive asset class, we're only allowing a 5% overweight, but a 10% potential underweight. Does that make sense why we're recommending that? Because if we had symmetrical ranges here, this would be down to 5%, and I'm just not comfortable that that's appropriate. Not that staff would do that, but we're just trying to create a good risk structure here. For most of the other asset classes, you'll notice they're relatively narrow. So for most of these, say private equity, we're looking at plus or minus 3%. For mixed credit, plus or minus 3%, et cetera, et cetera. A little wider here for public equity because it's a larger asset class in terms of total assets. So overall, these are what we think is smart, and then we have that additional 15% maximum on hedge funds. Questions on that? So those are our recommendations, yes?
Thank you. You were given two options. If you were suggesting to us, and we delivered this over a 10-year period, and the choices were to either actively manage U.S. equities listed, foreign equities listed, core fixed income, and domestic high yield, we actively manage that, or we could index that. And because everybody at this table knows I have the attention span of a 3-year-old, and because no consultant I've ever dealt with has given me a one-word answer, what would your answer be? You got to live with it for 10 years, you got to index it, or you got to actively manage it.
Index it.
Thank you.
Do I win an award?
You made this word.
Okay, now I got to give you the rest of the consultant answer. There are areas that are more attractive, active management, and that
well, that's
list.
why I left out emerging markets, because I think there are some opportunities.
Yeah, and high yield. So there's some areas that lend themselves a little bit more toward active management. But I think you're hitting on a key issue,
you're
which
ruining
is
your record here.
yeah, active U.S. stock management has a lot of smart people all trying to do the same thing with headwinds and limited information. It's just tough. And so one of the reasons that we're recommending this broader global public equity framework is to give you some latitude to use active management where you want to. Rather than having a lot of buckets that you've got to now structure stuff within, you know, you can index that entire component. We've seen clients do it. It's not the common structure. We think if you're going to have active public equity managers, give them as much latitude as possible and show some patience. That's the key to success.
I got that.
But it's tough. And you know, you do have, we think alternatives are a more ripe area for alpha. So you know, hedge funds, you give a lot more latitude to those managers. You pay them more, but all the studies have been done out there, you are earning extra alpha there.
Thanks.
So that concludes our study. Thank you for your patience. Any more questions?
Suzanne, that again, you gave us a lot of information, very helpful, and I thank you very much. But could you just sort of summarize the whole thing in terms of everything you said, and put a little sense of perspective in terms of, well, the areas of what you discussed, risk, liquidity, alternatives, that spectrum that you discussed, and again, just in a summary, just tell us perhaps where you think we need to focus our attention, plus or minus?
Whew. Okay. So we have some slides in here that summarize all of that. So our recommendations are on the targets, the rebalancing ranges, and the benchmarks today. But so so the next discussion is, so how do you implement all this, right? We're working with staff on that currently. Our broad thoughts are, and I'm just going to be very, very big picture here, a little bit more indexing in the global equity area, smart use of your hedge funds, making the lower beta ones in the hedge fund component, and then using them where they're adding value in some of these other areas, simplifying the program overall in terms of numbers of managers, using strategic partnerships where they're truly needed and where the manager's truly working with you in a partnering and opportunistic manner. So a lot of themes, by the way, that I know staff shares. Keeping the core fixed income simple. Now, this is not the area to take risk. This is the area that we say is conservative. It's something that is not going to earn great returns over the next 5 years probably, but it serves an important diversifying function. So take your active manager risk where you know you have the best potential for value added, simplify a little bit, use indexing to get exposure to some of these areas a little bit more simply, and you know, let's just keep moving forward. That's the big picture. Does that address your question, Ed, or did I go too far?
Just to amplify that a little bit, is there any one area, Suzanne, that you feel that really needs to come in terms of where we are too far extended, that you feel that needs to be shortened or shortened in terms of exposures?
From where you are now, no. When we first started working with you, and we communicated this to you in our initial discussion, talked with Herschel about this, talked with many of you about it as we had our one-on-one meetings with everyone, is the strategic partnerships. We thought had gotten to be a very large percentage of the fund potentially, and that narrowing that down to where they were truly needed was good practice. And Steph done that over the last 6 months. And we're continuing to work with them on evaluating these partnerships. But we think they're a good tool to have. They just maybe got a little outsized. So they're coming back, pulling those in. That was our number one concern when we first started working with all.
Our mission statement says that we seek strong levels of return with acceptable levels of risk. Are your recommendations geared towards the achievement of our mission statement? Very
much so. And as we get into implementation, I mean, you could create a crazy structure with those asset targets, you know, so implementation is essential. That's the next piece. How are we going to get there? You have a lot of great managers in this program, and it's focusing on those folks that are really going to add value, giving them enough money that they can affect the bottom line instead of having a lot of pools of assets. And, you know, just focusing active management where it's going to add the most value. Those are the kind of key messages that we want to bring to the implementation, and we'll be talking about that more.
And I haven't heard anything in what you said that implies that we're not currently structured so as to achieve high levels of return with acceptable risk.
Not in our opinion.
I think you are structured with that goal. But, yeah, we think it
But
can be
this
a
is a
pretty
year
fun
later
and
and
this is
a
evolutionary, right?
different future ahead of us.
Mr. Chairman?
Yes, sir.
Okay, thanks. Staff has worked with, on this as well, and we have had a lot of dialogue with respect to global equity, and I don't know if I'm standing there. As to his comment as well, we too would be supportive of moving to passive enhanced type strategies in areas where we don't believe there's a consistency of output delivered by managers. We do have some of those recommendations, Commissioner, a little bit later today. And the asset allocation framework and structure that has been presented, staff would be supportive of as well.
Is any of that thinking incorporated in your draft AIP or recommendation?
Yes, sir, it is. These numbers are. And some of the comments that I would say is that, well, it's on the agenda.
Okay. Just want a little teaser on what's coming up. Thank you very much, and I know that was hard work being on your feet that long.
It's okay.
But you did a fine job, and I think anyway, you validated the wisdom of our selection and the hard work of our search committee, Commissioner Office and Commissioner. I appreciate it. Okay, what's the next thing? Okay, report from the Governance Policy Ad hoc Committee. Travis, you're up. With such a system as unique.
Commercial to move over, and we want to be sure Ed hears us. So we get up there next to him.
I'm here.
I'm just standing up for a while.
I can tell.
Okay.
Are we being asked to vote on these?
On the governance? Yeah.
Well, today we're looking at updates and revisions to a set of 8 governance policies. They were adopted originally at various states, the latest one being sometime in 2010. And there have been some updates here and there since then, including some statutory updates as recent as November 8th. Let us give you a little background on governance policies as I see them at least. And that is that fiduciaries are often judged by their processes, while they must be engaged in decision making. They also need to find balance between micromanaging and delegating too much to staff. Governance policies help in this balancing act by serving the purpose of providing organized governance. They add value by helping a commission such as this one operate more effectively by defining guides and appropriate relationships between the commission and its executive staff. Good policies indicate prudence on the part of the commission. Now, to my knowledge, Hewitt Ennis Knupp is the only investment consultant in the public area, at least, with a dedicated department that provides fiduciary services to clients. As the November 8th motion made by the treasurer, creating this committee required our committee, it required our committee to obtain input on industry practices from the HEK fiduciary team. Dory and I in particular, and Ed also, benefited greatly from advice through 3 teleconferences with Nancy Williams over here to our right. Let me tell you just a little about Nancy. Those of us on the search team had exposure to her during the search in Chicago. She is co-leader of the fiduciary services practice at Hewitt Ennis Knupp. Prior to joining HEK around 2005, she held top fiduciary positions with Mercer. Some of us remember being with Mercer for a while. She was Deputy Director and General Counsel for the Colorado Public Plans, which you hear a lot about. Before that, she was a General Counsel for the State Teachers Retirement System of Ohio. She served as a trustee on several public plans through her work with the Ohio Attorney General. She holds a host of honors, I call them, various past presidents of organizations and so on. And I'm not going to take time to go into all those, but Nancy, I want to welcome you to South Carolina and to this commission meeting, and we appreciate any initial observations you might want to share.
Sure. Well, first of all, thank you very much for giving me the opportunity to look over your governance policies and talk about governance issues. I think I saw several versions of the policies, September version, November version, maybe a January version. We had many long hours of discussions and debates, and I want everybody to know I didn't hold back. I gave my honest opinion on everything, and when we weren't on the phone talking, I was meeting with other members of the Fiduciary Services team going through your policies with them. So I hope what we brought to the table wasn't just my view, but it was a view of others who are on staff back in Chicago. Now, as much as I'd like to hope that I added some value and insight, I have to start off by saying that the original policies I saw, I guess the September version, showed me that there had been a lot of careful study and thought in putting those together. And I just want to compliment you that before we ever touched these policies, you had a good set of policies, far better than what many other funds would have. They weren't the thickest policies I've ever seen, which is, we gave that a real plus, because we've been reviewing governance policies that are like this, which I would never serve on a board that had governance policies like that, because I would probably screw up on page 612 and wouldn't even know it. So the brevity of your policies, we know that took some doing. The other tricky thing, whenever you're writing governance policies, is how much do you include from the statutes, and when do you just refer to the statutes, and when do you try to paraphrase the statutes? And lawyers can get tied up for months on this kind of stuff. And I'm not sure who was tied up for months, but somebody must have really been giving some careful thought to that. We thought it was a very good blend of referencing the statutes, not reiterating them, not incorrectly paraphrasing them, but we want to compliment all the work that was done before we were even brought in. So just want to mention that.
Well, our committee has also been ably assisted by Attorney Dory Diddy, who required no introduction, having worked with the first set of government policies and with various other activities around the commission. But I want to thank both Nancy and Dory for lots of very helpful input on practices and what's reasonable on government policy. Well, at this point, there are a few things we need clarification on before we make an actual recommendation that resulted from our deliberation. And one is, Derek, in our policies, we use the term Chief Operations Officer, COO, but Chief Operations Officer. And we did this because several months ago, our commission adopted officially in the minutes the term DOO. So at some point, we need to switch that to COO. And our idea was we could stick it in here, and when we approve the policy, then it's approved. But it does say the Chief Operations Officer, and a more common term is Chief Operating Officer. So if Chief Operating Officer is referred to Chief Operations Officer, somebody make an amendment to that effect, and we'll.
I'll make that
Right.
motion.
Yeah, and the committee could do it too, so.
Right.
Just incorporate it in your thing. Anybody object to that? Unanimous approval for making that change. Change operations to operating.
Okay, Chief Operating Officer, great. So that'll be changed to direct the policy. That's what we recommend. Okay, so that's in the policy, in our recommendations. Now, we would like some guidance and clarification from the full commission on 4 provisions in the policies regarding the CIO and COO roles and responsibilities. And the first 2 sections, C3, near the top C, and then come down to 3, yeah, we got the hand there. And the suggestion was to add annually present a plan to the commission. So the proposed change is what you see highlighted in blue. And I guess the reason we didn't reach an agreement in our committee on this particular one is because it really does get to this question, in my opinion, of micromanaging versus delegation, and the question is where the balance is. I don't know. We didn't agree, and so the floor is open for debate and any guidance on which way we ought to go. Does the commission need to hear about this? One suggestion that I had along with Dory, and Ed, you chime in because we didn't totally agree on this, was that first, one thing we could do is leave the annual present a plan, but we don't want to present a plan of who's going to be fired. So we delete the word terminate, just there, and then where it says add annually present a plan, or perhaps after that we could say as part of the RSIC budget request that goes to the commission for approval, comma, to approve and so on. In other words, make it part of the budget proposal. That comes to the commission anyway. So in that, the commission would see it annually. But that's just a suggestion.
And what's the decision you're asking input from, on whether annual or
No, it's
frequently, or whether to be part of the
well, as I see it, do we leave the blue highlight annually present a plan to the commission?
Or take it out?
Do we take it out, or do we modify it like I just read, to in effect fold it into the budget process?
Any comments?
We particularly need it this spring up here because you need to see exactly what it's saying.
And this is one of those plans that's not set in stone. It's you're definitely heading down the road. Budget time is always a great time.
I agree. It seems to me that folding it into the budget process makes a lot of sense.
I agree. Okay, makes sense. When it all rolls in together anyway, so.
And okay, determine to delete, terminate.
Yes.
Okay. You want to make an amendment to that?
Yes, sir. I'd be more than happy to. Yeah, we'll accept your wording as there at budget time.
Okay, I'll second it. Okay.
I think I've heard the sentence. All in favor, say aye. All opposed?
Okay, that's and that's both C3 with the CIO, and then F5 with COO, except yeah, same wording, except okay, and then where am I in my stuff here? Next ones of concern are C4 for the CIO and F6 for the COO. And again, the suggestion is to, in blue, in C4, annual present a plan to the commission to set compensation levels for staff. Any comments there? The more we thought about it, first of all, we think you're talking about new full-time equivalent year as opposed to everybody else in the budget making process gets lumped into one line. The question is whether you need a summary of new full-time equivalents, if any, included in the approved final budget, and the estimated salary range for each of those positions.
It doesn't hurt for us to see a census annually. But I said it doesn't hurt for us to see the employee census annually.
Right. So, again, we need an amendment before we move on to final.
And tell me again what would be the nature of the amendment?
What?
What's the amendment?
Well, the amendment we suggested was to say annually present a summary of the new FTEs, if any are included in the approved final budget, and the estimated salary range for each.
You'd like to have that in there?
Right.
Okay. Can I hear a motion to that?
Is it new or all?
And that's in the material that was on the HMN.
Okay. Is it limited to new employees or all employees?
The idea was when the budget came back, the approval came back, we thought what they were trying to get out of this was simply what we would do with the positions, what positions were approved, if any, and what the salary ranges would be for those positions. So while we present something to the commission that would be for a request, when the legislature comes back and says, okay, we give you half of that, what are we going to do with those FTEs, and what would the salary ranges be?
I got a question for you, and I'm not in state government, so I don't know, I'm just kind of curious. Are you limited in head count or by our budget? Right, so if we have 35 people, right, but I can pay 2 people half, am I still limited by 35 people?
We can use temporaries, but they use
Still limited
temporaries.
to 35 days.
You're limited as to full-time equivalent positions,
Okay.
but not as to temporary employees.
How many temporary employees do we have? Lance? 6.
Top of my head.
Yeah, I would think it's standard practice for us to org chart, the budget time, twice a year. We continue to update.
And the memo included the language for that amendment and the previous one. It's on 368, if anybody wanted to see the language written out, that Travis just read out loud.
Oh, okay, yeah. That's at the bottom of the page.
Number 2. That's indented.
Yeah, and that's due to indented, right?
I don't see anything wrong with that. I don't think we should. That's what y'all think, so I think. Well,
Yeah, I would probably just take out the new. I think we ought to see the employee census data for all the employees, or just new employees.
But, yeah, but do you actually get salary ranges and so on?
I think we should. Yeah, it's part of our budget process. I think we should.
And on the front end, because on the front end, I believe you do, but this is talking about on the back end.
Yeah, I mean, presumably people are getting, their salaries changed every time, on their first day of hire.
And we should have that information anyway.
It's just we just summarize it stuff we already have. I don't see
Right.
any motion for them. It's not that onerous a task to do it, is it? Just
We just want to make sure it's not a second task that's being suggested, that it is the budget you already receive. And
Yes.
we don't want to create a second document that's duplicative.
oh, I see.
Somebody
Could
make
I
a
would you?
motion.
Somebody who cares about this issue want to say something or make a suggestion.
In other words, our committee is open for an amendment to include.
I'll propose that, so we'll get all positions instead of new positions.
Okay.
Yes, sir.
I'll second that.
All in favor, say aye.
Aye.
Opposed, by like sign. That's it.
Okay. All right, with those basically three amendments, changing the chief operating officer, changing as we recommended in C3 and F5 and in C4 and F6. Let me, by direction of the Ad hoc Governance Policy Committee, I move that in accordance with the governance policy draft posted to the Extranet for February 28, 2013 Commission meeting, and the clarifications provided in the committee memorandum dated February 25, 2013. That's what was up here a minute ago. The Governance Policy Committee submits the recommendation that governance policies 1 through 8 be amended in conformity with and adopted by the Commission effective today, and direct the staff to finalize the policies by removing editorial notes and red lines and make technical or formatting edits consistent with the amendments approved by the Commission. So that's the motion of the ad hoc committee. I don't think it requires a second. But
Yeah, that being a committee motion, it does not require a second, so we can proceed to talk about it. You want to talk about it, or you said what did you want to talk about? I'll recognize the treasurer.
I'd like to make the motion, to divide the motion for the commission so we can discuss and take action on each section of the governance policies individually. And we've got a couple of changes and I'd like to be able to go through.
The motion on the floor is to accept this one. If you have it'd be in order for you to make a motion to amend in some way, and then if you get a second, we'll talk about that.
Do it that way, but I believe you're supposed to do this way, but we could do it that way, we don't have to. But I think that, well, okay.
I'll second the motion.
Well, I need to know the nature of the amendment.
Well, we're just going to divide the question so that we could go through one at a time and pass them through and get them on the table.
The way to do that would be to vote against the pending motion. And then we'd be up to rewriting.
I don't think we can do all that. We make a motion to divide.
We made the,
Motion to divide.
Oh, can you? Tell me what that means, or the motion to divide.
It means instead of approving it as an entire document, you would divide it into sections, and I assume that your motion would be to divide the question section by section.
That's correct.
And when you say section by section, we go by numbers?
Policy section.
Policies, okay.
And I don't mean to speak for Mr. Loftus, but I'm just.
And I just want to understand the motions I stated, and you've seconded that?
and I'll second it.
Anybody wish to discuss on that motion? I'll call the question. All in favor of the motion to divide, as previously stated, signify by saying aye.
Aye.
Ayes have it.
So does that's mean we take a policy one,
Yes, sir.
vote on policy one, and we take a policy two. So we are on policy one. And notice that on the extranet, and for some people may have it in over some, we have the recommendations of the ad hoc committee, and then we have the explanation first of the suggestion. Remember, we got suggestions from all the commissioners back in December, late December. And these are, at least the things that are included are color-coded on this explanation and on the policies themselves with green, meaning we thought it wasn't a controversial item, but somebody else might think it is. So then we put in blue type or highlight what we thought might be something the commission would be more likely to want to discuss, so you can tend to focus on more controversial things. And then we also have a section on suggestions that were made, and our committee did not accept them for reasons, that we can respond to if anyone wants to, but also itemize on the explanations. But, so with that introduction, back over.
Sir, well, thank y'all for your work. My staff, I helped a little bit, and they worked a lot, and I appreciate everything y'all done. Had an amendment in the first section, which was not significant, but page 4, subsection F6. And that's where RSIC receive and review reports from the audit committee regarding the results of the audits of RSC as appropriate, including the annual fiduciary audit engaged by the State Inspector General pursuant to section 916.38. Y'all have the term as appropriate, and I wanted to strike the word as appropriate. That way we just would, as a matter of course, we would get the audits. That's pretty straightforward and simple.
Okay, I'm gonna let the chairman.
What red page number?
Red page number.
372.
What?
372.
372.
You keep pulling me.
I think the best way to proceed, or we have the suggestion changed and tell the commission, the committee's thinking, either you or Mr. Joe.
This was added from the statute, the changes, and I don't recall exactly, but I would think that we added the word "and approved," and as appropriate first, and review, because we wouldn't want to just receive them, right? We would assume we're going to do something with them. And then as appropriate in the event there was some reason that the commission didn't receive certain information, if it was audit information. I don't know if there's a situation where it would be distributed to a trustee, or if there's some weird one-off situation where the commission wouldn't receive it. But by adding it, it certainly doesn't hurt anything, because it would always be appropriate, arguably, if not.
It seems to me like if we take out the word as appropriate, that would mean we could do it even when inappropriate.
Right, if Monica might be able to shed some more light on.
The audit committee typically, we feed up all reports to them because we report to them. But there are some reports that are not of a significant nature where it would warrant or merit full attention of the full commission. And typically, that discretion is left to the audit committee chair as to what he'd like to share with a full commission. And so saying as appropriate gives him that discretion to be able to say which reports he thinks merits the full attention of the commission.
Well, of course, I just disagree. I think because we received the report doesn't mean it merits full attention or doesn't merit full attention. I just don't understand why you would have audit reports floating around a trustee or commission member wouldn't be able to see them. As appropriate means somebody has the right to give them to us. The statute doesn't mention the word as appropriate either when it comes to things like annual fiduciary reports. So I mean, I feel fairly strongly about this. I don't know why you would have as appropriate. Already, the only way I can get the information is to show up at the meeting and take 2 hours, come over and get the meeting, get the information. I just don't think it's appropriate.
Each and every commissioner is, and we've said this, we typically will provide you the materials if you're at the meeting, but if you are not at the meeting and you want those materials, we are more than happy to provide those, and you are entitled to those materials. So I don't think it's such that the commissioners would not have access or be able to have a report. I was thinking it more appropriately as the full, what would be presented at a full commission meeting versus you actually just getting a copy of it.
Again, I don't understand why a fiduciary has to have an intermediary when they're receiving audit information.
Well, so I understand what she's saying, that if the person is required to review it, that means they have to prepare, and we have to go through a review, even when it's some immaterial matter. But the receipt, it doesn't affect anybody receiving anything, just the review process.
Right, the state law is going to be the state law, where it's not going to change what is required by law, and the law does, as Mr. Loftus mentioned, it doesn't say as appropriate or and review, and so it's not going to trump state law, obviously. You would still receive them. It's just you wouldn't have to, you would review them as appropriate.
Well, can I maybe, I haven't, these were posted very late. I was up in the middle of the night last night trying to read through them. But one of, I understand sort of the nuance on receiving as a full commission versus making available. Do we address the audit committee? It's a standing committee, right, to make available, right, to address the treasurer's concern in that subcommittee language? Do we have it so that the audit committee makes available, the audits, right? Because this is obligating the full commission in a way where we're having to do something more proactively, right, versus the audit committee making those data points available.
That's correct.
Right.
Well, on our extranet, there's already a file. I mean, you guys have it, we just don't have access to it.
Right.
So what again, search for information, come over and sit. It's in 3 committee meetings. I'm not qualified to sit on any committees. I'm not appointed.
So, Mr. Treasurer, is your question, is it the timing of when you receive the reports, or is it just you're guaranteed to receive the reports at all?
Both.
Because I know you had a question earlier. I just
Yeah,
want to clarify whether it's you're asking to receive the reports prior to the audit committee, or you want it verbiage where you always get them after the audit committee, or if you're present at the audit committee.
Well, it's
because I think that's 2 separate issues, and I mean, we could talk about each one obviously. So.
well, one, I want to make sure that I get them. Keep going through this, I have a hard time gathering information, fight for it. And also, there's a timing issue. If the audit committee meets at its schedule, and that's fine, I appreciate that. But their schedule may not be our schedule. So they can have a meeting, I can go out of town for 2 days, but they don't do it, but just pretend I did. And then there's another meeting. I mean, they have a commission meeting. They usually meet the same week or even the day before, right?
They're planned 2 weeks apart.
2 weeks apart. We try and schedule it 2 weeks in advance of this meeting.
And Monica, just correct me. So if Mr. Loftus was traveling and he missed a meeting, we would still be obligated we would still send him upon his request the material.
We would either send it to him, but in the past, when he has not been present, we have provided it to his representative, which he typically does send a representative. I know I've given it to Bill Ledinger in the past, a packet for you. So if you'd like us to give you a packet subsequent or after that, that's not a problem at all. I think this is more or less just saying whether or not, the purpose of having an audit committee typically is to deal with those issues firsthand so that you don't involve and bog down the full commission in those types of matters. And then things get kind of filtered through and what items are more significant and relevant are filtered through so that they could have the full attention of the commission.
Well, exactly. They use the word typical and filtered through and all those things. And I'd just like to see the data. I'd just like to see the reports. I get them after you've looked at them, after Andrew looked at them, everybody sympathized.
So your issue is that you want them before. You've always got them after.
Yeah. I'm time being, still a member of this commission. I don't know why we can't see the information. It's just a simple question.
You get the information, it's just you want it before the meeting. Is that
I want to clarify, under either iteration of this, it doesn't affect the commission's ability to receive a copy of the audit report. It does not. We're only talking about when we were required to have a review by the full commission.
And it's just talking about the Inspector General's report, actually. So the statute says that the commission would receive reports from the audit committee regarding the results of audits of the RSIC, including the annual fiduciary audit engaged by the state. We were just trying to add the state Inspector General.
Well, here it says including, so it gives way that there's other reports other than this.
There could be like just really mundane audits, right? This obligates us, the way this is written, it obligates you on everything from, we're tracking down on a travel on $1,000, right? This captures everything the way this is written, which I think, to the treasurer's point, should be made available. I'm not sure under the full commission's language that's where it is. I didn't know if under the audit committee language would be a better place to put that, to make available, or the appropriate language.
Well, and there's no regulation that a commissioner has to read something.
Right.
Doesn't have to read it. He can hit delete. He can not even file out right away.
The way I interpret
this
is
because of the review part.
If you remove the word as a total, the full commission must review it.
No.
That's what it says. If we take out the word as appropriate, we have to review even the most mundane of them.
Which nullifies your audit committee
Yeah.
This is not, this doesn't command an official action by anybody. It just says the commission can receive it. We're commissioners, we receive it.
And review.
I thought it said we had to.
It's receive and review. It's the and review part.
Receive it.
Right.
Let's just take away and review.
All right.
Feel free to trash it.
Let's, we'll take out and review.
Feel free to trash it. I don't believe the commission has a hard time not reading things. So it's receive reports, and we strike and review and as appropriate. Thank you.
Next.
Well, then we need to get a amendment, a vote.
So that's an amendment, so.
So moved.
Second.
Oh, I guess Jim seconded.
Okay,
Oh,
you
you
move.
moved. I'll second it, I'll second it.
Okay.
Right.
All in favor, signify by saying aye.
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 Okay, so what we're doing is we're striking and review and, that's it, right?
And as appropriate.
And as appropriate.
I know,
Yes, that's what we
Yeah.
Right, okay.
Yeah, you're gonna receive it, but you don't have to
Right,
approve it.
and
We're
review.
keeping it here.
What was the vote on that?
No objection.
Now, it's page 6 and 7, subsection 1(6). I don't know the numbers.
Are we still on the one, policy one?
Yes, sir.
Okay.
In the event that a commission member determines that a business or other relationship or connection does not create a conflict of interest pursuant to state law, but may create the appearance of a conflict or impropriety, he may abstain from deliberations about and voting related to the relationship. This appears to give the commission member the ability to determine whether something is a conflict of interest or not. In state law and ethics, and I think our own policies are pretty clear that that's not the case. They can always opt out for another reason, but this says determines that a business relationship does not create, but may create the appearance. So the commission member has determined that something is or is not. That's the problem with the language.
Section
I don't have the, my computer.
What specifically do you want to change?
Strike that.
Which one is it?
Strike what?
Yeah, the whole thing.
Which whole thing? Yes, sir, I don't have.
Oh,
Go down one
my
more.
computer's not working. I'm having to do this for you.
Somebody tell me which whole thing?
374, page, red line 374, bottom of the page.
Monica's on. Thank you.
Yes.
And, yeah, so,
Everything in red at the bottom of the page?
yes, sir. Subsection 6.
Just number 6, okay.
The question I have, and I don't know the answer, is this statute language we're trying to change, or is this something we put in?
Wouldn't we always have the right to abstain from a vote for any reason?
You can't.
I mean, I don't think we need it, right?
Yeah, that's right. It's additional. What it does is give the commission member the ability to determine whether he has a conflict or not. The commission member wouldn't be able to do that.
I don't know who else would have that.
So can I point out what the purpose of this particular section is? We've had situations in the past where our commissioner does not have a conflict of interest per se under the law. And he has still felt uncomfortable voting because maybe he used to work for the company that somebody else used to work for, and now. So although under state law he would not have to provide a copy of the disclosure and put it with the minutes, we were trying to regulate the process by which that would work, whether someone has a conflict under the law or if they're just saying, I'm uncomfortable and in an abundance of caution, I'm not going to vote, and be able to differentiate when somebody's doing that or not, so that our COO will know whether to expect the disclosure to accompany the minutes. So that was just going a step further than what we have to, saying you can still abstain, we can keep people from abstaining, but if it's not something that requires disclosure under state law, you need to make that clear to us so that we're not expecting the disclosure. Right, Nancy's experience
Something
situation.
Wayne's doing at a time.
It is something that Mr. Ewing did.
Well, In the event that a commission member determines that a business or other relationship or connection does not create a conflict of interest pursuant to state law. So the commission member is the person who decides on the law. I mean, I know that we declare one if we think we have one, but that decision is not a final decision, correct? I mean, hey, my opinion is, I'm voting.
I would think, I'm speculating, but I would think it was written that way because if somebody other than the commission member is making the determination, if there's some other body deciding, then it could involve that commission member either having no possibility of doing anything or having to disclose confidential relationships that he can't disclose, like a husband-wife thing or a doctor-patient thing or a preacher-penitent thing or a lawyer-client thing. If the commission member can't make the decision but another body can, the other body presumably would need adequate information.
In most cases,
And the receipt of adequate information might require
the commission member
disclosure of
himself is going to be the only one that knows the conflict.
Right.
Well, it would be up to that, I mean, it'd be up to that commission member to divulge the conflict and then not vote on it if there's a conflict.
Yeah, I mean, I understand a little bit.
No, I was just gonna say, I mean, that's, I mean, a lot of times it's not, he or she's the only person that knows.
Yeah, but the way it says, he determines, as this is a matter of law here, let's just pretend I have a conflict. It's my job to declare it, to go to the head folks, give them something in writing, they have to read it to the minutes. I have to declare that at the time of the conflict, not months later. So that's the first thing. So we know that the person has to fess up, he has to confess something or make some type of determination. But I don't want to be confused with a legal determination. And the second thing is you can always abstain. You can always just say, well, I remember Blaine Ewing every time the Morgan Stanley came up. And he said, I don't have anything to do with it, but I work for that big company, I'm abstaining. So that was, he had the ability to do that. I just don't want to see us add another layer in here.
If we take out this sentence, so then Blaine would not have had the ability to do it.
Sure he would.
He would have had to let the commission rule, or some third party rule on whether it was an appearance and not an act.
We just didn't necessarily know if we should expect a statement to accompany the minutes if someone discloses the nature of the conflict. Whereas with this in there, it's protecting individuals who feel, commissioners who feel uncomfortable. They have that, that's best practices for fiduciaries to avoid the appearance of impropriety. And so it's just to protect you all, that's all.
Yeah.
It's not to provide any loopholes or anything like that. It doesn't change the state ethics law that's included.
If I remember my reading from the AICPA guys, these other things about ethics, is if you believe that you might have a conflict, you have a conflict.
But under state law, you don't have to disclose that in the minutes, and that's the only distinction we're making here.
What if we reword it this way, just that in the event that a commission member determines that a business or other relationship or connection may create a conflict of interest pursuant to state law, he may abstain from deliberations about voting related to the relationship.
Yeah, and you can actually even have, instead of term, believes.
Would be, I hate to use the word appropriate, but would it be appropriate to put in the word or the appearance of, in other words, if a member stated that he had a conflict of interest and wanted to prove himself, or was abstaining or accusing himself because of the appearance of it. So, I don't know,
I thought that's what y'all already had.
A little more?
Yeah, I thought that's what y'all already had.
You just bring that up a couple of minutes ago.
How about this? So let me reword it a little bit. In the event that a commission member determines that a business or other relationship or connection may create a conflict of interest pursuant to law or may create the appearance of conflict or impropriety, he may abstain from deliberations about and voting related to this relationship.
You changed anything but the but to or?
It changed the but to or, and then on the top part, it may, remove does not, just say may, remove the does not, and change that to may.
Okay.
Dory's question, I believe, is, so if that circumstance arises, does that person have to make a full written disclosure, make it part of the minutes?
I think he would if he chose to abstain under this condition of the policy code.
Here's one of the differences, and I'm gonna, Mr. Chairman, if I may.
Sure, go ahead.
And I'm gonna pick on former Commissioner Ewing. On several occasions, Mr. Ewing said and fully disclosed before a vote or even when a matter came up that he had a relationship, or one particular instance, he had a cousin who knew somebody who was connected to a fund. Clearly under state law, that in and of itself was not a conflict. But he still, out of an abundance of caution, abstained from voting. Now the minutes can capture his reasoning. The difference is if there is a conflict, not even appearance, but if there is a conflict of interest, then a statement pursuant to the state ethics law must be included in the minutes. So I know we're splitting hairs here, but in that instance, without something like this, perhaps Mr. Ewing would have had to do a full-blown, very elaborate statement about what he perceived or his being uncomfortable about this, and add that to the minutes, when in fact there was no conflict of interest. He just didn't feel comfortable about it.
That's fine.
But the distinction is, you just don't feel comfortable about it, are you going to have to then go and do a formal statement about you being uncomfortable to add that to the minutes? Or,
You know, I don't find a problem with it. That happens all the time in the investment world. Yes, your compliance guy can see this, right? I mean, it's
he hadn't done it.
right. I've done it a couple of times on Morgan Stanley. I did it.
You recused,
Right.
but there wasn't a conflict, and so therefore you did not
Right.
do a formal statement.
Right.
Suzanne, which language are you with?
Well, I'm sort of back to the beginning of, anybody can abstain anytime, and what I'm used to seeing is that people say on the record why they're abstaining, whether or not it's a true conflict, or they just feel uncomfortable. So I don't know about your state laws that require an elaborate statement. I'm not used to seeing that. I'm just used to seeing somebody say, I used to work for them.
I thought I read somewhere in here that the policy would require, if I'm wrong about that.
State law requires state.
If it's a conflict under state law, the preceding section covers conflicts that would be related to the State Ethics Act 8-13-700B, it's section 5 right above. And so this was just a step further to say, and even if it's not a violation of state law, but you want to abstain, you can do it. Just state the reason so that we're not expecting basically a statement that's required as well. That's all. I mean, it's simple and it's.
There might be a distinction without it.
Well, is there any problem if we do it, Alan, but they give?
Alan's was genius.
Seems like the same thing.
Yeah. I'll make a motion.
I'll second.
Can you?
Read it one more time?
Sorry.
Okay. In the event that a commission member determines that a business or other relationship or connection may create a conflict of interest pursuant to state law, or may create the appearance of a conflict or impropriety, he may abstain from deliberations about and voting related to the relationship.
Oh, what?
Did you hear a second on that?
I've seconded it, and I'll call the question.
All in favor?
Aye.
Aye. All opposed, like sign.
What's the vote? I didn't.
It was unanimous.
I have nothing else on section 1, and if no one else, I'll call for a vote on section 1.
All in favor of section 1, or does anybody want to talk about it anymore? Dr. Lewis? All in favor of section 1 of being approved as amended, signify by saying aye.
Aye.
Ayes have it. Section 2.
And on section 1, excuse me for interrupting, Mr. Chairman, Mr. Loftus made the motion to adopt that one, and the motion to adopt as amended.
Travis, we're moving to section 2, and for speed, I'm taking you have moved it up from section 2 as presented.
Yeah.
Does anybody have any proposed amendments to section 2?
Section 2 being chairman, vice chairman roles and responsibilities. Right. The only question I had here, and again, got them kind of late, I know I've talked with Tori about this, but, really gets to the way we put committees together, standing and ad hoc committees. it seems like as commissioners, right, and it's given to the chairman, the CIO. I don't know why we're involving staff in our committees.
Tell me what we're talking about.
2B.
Red page.
To be what?
It's on red page 374. 2B,
379.
administrative and
It's B2.
B2B.
yeah, B, yeah, B2B, I'm sorry. 2B, 2B.
I'm sorry, what red page again?
Red line 379.
I gotta do it into the budget. I gotta control the
If a future chairman wants to consult, are you saying that a future chairman who wants to consult with the CIO?
I would think the chairman would take into consideration any advice, right? I mean, the way this is written, right, it sort of excludes us and includes them, right? I would just be silent on the issue.
Well, it doesn't exclude us. Look at the very last part. It says upon consultation with the committee.
Yeah, I mean, the intent is you can consult with staff, you can consult with commission, make your recommendation.
I mean, that's why I read it. It doesn't seem important to me, that I can't conceive of the chairman acting, if not consulting with us two people. And with the
Well, I mean, this is one of those things that's, he can do it, but walk away. And then you might end up with the CIO who says, I want to talk to you about this.
Byron?
Yeah, I mean, this one I think kind of gets more layered in just our committee structures and, you know, we can come back to it, but this is one I'd like to come back to.
Would you make a motion?
Let's do it. Move on.
Right. So I'll move that we table this one.
The whole
Change it,
section?
or just strike those 4 words? Just strike those 4 words, or?
Let's just strike those words then.
Which word?
Well,
blue
I mean,
words.
this gets to a bigger issue. I mean, this gets to, how much do we want the chairman directing stuff versus stuff that the full commission, right? Voting on our committees and, our appointments and structures and numbers, right? I mean, this is a pretty powerful, section of our governance that I think deserves more discussion than I think any of us are willing to invest today. So personally, I'll take it as is. I'd like it to be revisited or tabled.
All right, I'll second the motion to table this 2B.
I would say this whole, this policy, because this has implications for other policies.
Yes,
right? I mean, this gets into our committee policies, right?
But if, Mr. Chairman, if I may, if I'm understanding you correctly, table this, and this means this policy doesn't, section 2 doesn't get adopted today at all?
That's what we have now. Just table all of section 2 and that motion's been seconded. As I understand, isn't that the motion?
Yeah.
Yes.
Anybody want to talk about that more?
I sure would like to get things approved on this committee resolved.
I would too.
One way or the other.
Alan, would you like more reasoning behind this? It was well thought out, it was discussed. The idea of what's really changing, it is actually pushing more toward the commission and less toward the chairman. So previously, the chairman, it was so that the selection of the chairman of each committee was selected by the chairman also. So that's been deleted in this section. And the reason that the CIO and the COO, which we could always amend that if that was the will of the commission. The reason that was left in was because talking with the consultant and other general counsel and folks with pension plans, they thought that helpful insight could come from these key people in, just from having worked with the commissioners maybe in the past. So I think the committee's policy takes up a lot of the things that you had comments on, but if that's the only thing that you're concerned about there, I mean, it was just a matter, and as far as the chairman being the person to appoint folks for the committees, the idea is that you have to have a gatekeeper, right? You can't just have free reign. The whole purpose of a chairman is that they would have some heightened authority to do something. So if the commission is selecting, I mean, it just sort
Yeah,
of.
but normally, I mean, like that might take the idea of a slate, right, that then gets voted on, right? Like he has proposals and they're voted and approved by the commission, right? I mean, we had a situation where literally the composition and number of people on the audit committee changed, right? In a way that I, as chairman of the audit committee, didn't like.
I think some of that will be addressed in the committee's policy. The recommendation did include the number of standing committee members required and the number of ad hoc committee members as you did, and how they would select the chairman and all that as we go further. I don't know how the best way to proceed, but I think a lot of your concerns will remedy.
In the committee.
Right. We tried to put as much as we could in the committees rather than speckle committee information throughout the policies.
Would you like to come back to section 2?
Yeah, can we come back to this one, maybe jump to that one?
Can we go to
Well,
committees?
we've got a pending motion on the floor to do that.
I withdraw the
To
motion.
table.
Can I withdraw that motion?
Well, if you withdrew it, then we'd have to consider the main motion, which is to adopt it. So it wouldn't do much good to avoid action.
Just make any motion, I may have moved to, we carry it over until after the last session.
I'll second that.
Anybody want to talk about that now? All in favor, say aye.
Aye.
Aye. All opposed? I didn't hear any opposed, so the ayes have it. 4 votes in favor. All right, so we're carrying over, that's a temporary carryover of section 2, right? Okay. All right, section 3, Mr. Chairman. What page is that?
Was it 3 what?
382.
382, thank you.
Are there any proposed amendments to section Roman numeral 3, which the committee has recommended be adopted as presented?
It was flawless. It was flawless.
Oh, great.
So it's adopted without objection by anyone? Okay, so now let's move to section 4.
Sorry.
It's on commissioner operation.
What page is that?
The 391. Page 5, subsection G, 3, comma, CNF.
Three, C and F.
You said G, Chris?
Yes, sir.
What's the number 2?
394.
Say that again. Page 394.
Agenda and item procedure.
C through F. 3, C through F.
Number 395.
I'd like to strike C through E.
C through what?
C through E.
Or there's a motion to strike C through E. Is there a second?
Can we have a minute to?
Yeah, please.
Nancy, could you comment on this too, about any law about agenda item, Doris?
Let's not get the comments till we got a second.
Okay.
Tell me what the green shading means again.
It means that we thought that they were less complex amendments. But there's no green in this section.
Red.
I thought they wanted
G, 3.
Red page 395.
I'm looking at red page 393.
395.
Oh, am I on the wrong page?
This is all about submitting in writing in advance, making motions and all this. It's not in state law, it's not in Robert's Rules of Order, and it's cumbersome, and I'd like to see stricter.
I do, on D now, if you're gonna make any amendments to your agenda, I mean, particularly given the state of the Supreme Court and Court of Appeals cases, just recently, you're gonna have to make those amendments at least in time to post it 24 hours in advance. So do not now let you, unless there's a pending case now out of Anderson, unless that changes the way, and given the comments made and some lead up to that you don't have the ability to amend your agenda too much on the fly after that 24-hour period before the meeting. So part of D, I think you're gonna have to keep.
The 24-hour part?
Yeah, you're gonna have to.
And that's just state law, right?
Well, yeah, you have to post your agenda 24 hours in advance, and they're strictly reviewing that requirement right now. So you're gonna have to keep part of that.
Number E.
We're talking about D, the 24 hours.
Paragraph E. Changes to the proposed agenda, just as Mr. Avant just said, this says should be submitted in writing at the meeting. Again, the agenda has to be posted at least 24 hours in advance prior to a meeting, and changes to that agenda, I would say, would be limited to removing something from the agenda or something very benign for which the commission would not take any action on. As an example that I've used before, perhaps a member attended an educational seminar and at the end of the meeting wanted to just provide a report. It was no action item, that would probably be okay. It seems to me that this is one of the rationales, and I don't want to speak for the committee, was to provide some structure in terms of developing an agenda.
Well, if I can just make a comment, I don't think C in practice works, right? I mean, we had these things on Tuesday, right? They weren't even posted 3 days before the meeting, right? I think C completely is a disaster.
These were posted last week, weren't
Yeah, they were, motions were posted last week.
They were updated with Tuesday's date.
They renamed them.
Huh?
I think something was renamed because the governance policies were posted all last week too. But I noticed everything was posted at the same time. It looks like it because they renamed it on the 27th.
That one letter concerning C3, C4, F5 on was posted later, but all the government policies were earlier. And I apologize they weren't on there earlier. A couple of them had some signatures.
Right, that's fine. I just, it wouldn't be as big a deal to me, but I think C just, I don't like.
I don't see the point in any of them. If all this is to give us comfort that we're going to have a structured meeting, well, think about what they did to me today. I got a 4-page censor dropped on me without any notice. So what are we talking about? If you can do that, what else can you do? All this is limits our freedom to have anything put on there. I have yet to get something on the agenda. It just doesn't happen. No matter what I do, I can have seconds. It doesn't happen. So all this does is strengthen one person's hand, the chairman's hand.
What page are we on?
395 in the red.
About the 24-hour period, that's a statutory, that's the FOIA law and all that, so it doesn't have to be in here. We made the conscious choice to take a lot of that out, which is, they've done. Yeah, and it's also in where? It's included in subsection E. G, excuse me. So I like to move these three straight.
Yeah, CD and E.
Yes, sir, CD and E.
C, D, and E of number 3. Is that what we're talking about?
And removing of David and Nancy in particular, we don't, it's still consistent with the state law.
You're gonna have to make known that you can't amend you get very limited ability to amend your agenda within 24 hours. I mean, it's just.
Do we have an FOI, I'm sorry, an FOI notice in our governance, or is it just statutory?
We incorporated that. That's been, I mean, it's from statute, but it's incorporated in there. And the idea also is with the 24 hours, if you give exactly 24 hours, that would be assuming that the chairman or the staff, whoever's distributing the notice, is by their phone or computer, wherever they have to be to get that out to the public for that window of time, you suggest something last minute, right before that 24 hours, you have to know that the staff's going to be able to turn that around if it's 11 o'clock at night too. So you're kind of just, it could be hard if you just say 24 hours. I think 3 days was just to make sure.
But the staff can't do it, they just can't do it.
It's not, well, we have to do it.
No.
We have to notice meeting, we have to have the agenda 24 hours in advance by law.
The proposal.
Right.
Well, and I would like to add, Mr. Chairman, that this, this goes for non-emergency type meetings. There is an exception under the Freedom of Information Act where agendas, et cetera, don't have to be posted within 24 hours if it's an emergency situation.
What qualifies as an emergency?
Depends on what.
Yeah.
What the nature of your public body meeting is. It'd be an emergency for this body, might not be an emergency for people.
Well, my purpose of being in favor of the 3-day rule on a written main motion is to avoid motions on the fly, which haven't been thought out, and staff's had no chance to think about it, comment on. So it seems to me to be prudent if we don't have a 3-day advance requirement in the middle of a meeting, somebody could just come up with some harebrained idea that nobody gets a real chance to think about in advance.
Just like today, with my signature, just like today. 4 pages, well thought out, typed by staff, done a lot of work, just like today. So that wasn't done 3 days in
But
advance.
it's under the proposed.
Yeah, there's a loophole.
Under the proposed change, it would be even easier to do it. Mr. Lawson.
Well, it's easier for the chairman. It wouldn't be easier for me, because I can't get anything on the motion on the floor to start with. So, you know, we
Well, I'm
talked
saying
about
that piece, other people, now, I will recognize anybody else that wants to say that. Anybody? Has there been a second to the motion?
I'll second so we can discuss it.
All right, now discuss it. So the motion that's been seconded is to strike C, D, and E from that section in its entirety, correct? Okay.
Chairman still has the ability to call somebody out of order, and she decide, provide an explanation for a ruling or motion out of order. The chairman still has considerable power, considerable authority over the meeting.
Yeah, I think there should be a clear way where commission members, if there's more than one, can get something on the agenda, right? I don't think there's a pathway to do that currently, you know, and I don't think having, you know, I understand wanting motions in writing, but you can do that in the meeting. You know, I don't know why you would limit yourself solely to those that are done, you know, in advance. That's my opinion.
Okay. Go ahead. All in favor of the motion to strike C, D, and E from the section under the policy under discussion, signify by saying aye.
Aye.
Aye. Motion carries.
I accept.
Thank you, sir.
Any other proposed
Yeah.
amendments to that?
Excuse me, Mr. Chairman, were the other votes no or just not voting?
I voted no.
And I abstain.
I'm sorry.
I abstain. So, anything else on four?
Yes, sir. In Section 4, page 5, subsection H1B. And it says the COO, CEO, CIO. That's right, Mr. Yeah. The COO will cause the minutes to be presented for the approval at the next regular commission meeting, or as soon thereafter as practicable. I would like to strike the or as soon as thereafter as practicable.
Is there a second?
I'll second.
Any discussion?
I would give you an example of why that might be necessary. The people board's required to meet monthly. In January and February, we met back to back, the last day of January and the first day of February. It would have been impossible to have the January meeting minutes ready for February. So they'll both be presented at the March meeting. So there may be a circumstance where you meet in such short order.
Yes.
That, and I just give the example of where we would have, if this would have been in our bylaws or governance policies, we'd had somebody sitting there all night in one P.
Well, even then,
writing on a
wouldn't have been
napkin what the minutes were.
It wouldn't have been practicable.
Yeah.
Of course, we meet quarterly.
Well, I was just throwing that for your
And,
consideration.
and it, you know, it's just important to have these. We had a funding issue. I didn't have minutes. You know, it's important to
We
have
had
these.
those.
And it's almost 6 months.
So you're talking about minutes of regular meeting?
Yes,
or
regular meeting.
Regular and special, regular meeting.
Oh, yes. And if we do have
Minutes of regular meeting.
the encouragement, if we do have a special meeting, it's probably not going to be a long meeting. It's going to be an issue. So you'd
But
like
it
to?
could be something like that.
Yes, sir. So we'd like to have special, after the regular or special commission meeting. Thank you, sir.
I'm just thinking about private sector experience. If somebody had to stay up all night to get the damn thing done, they'd about got to do it.
I have.
And I'm sure you have. So,
Well,
you know, I don't see.
And you'd also see a requirement, like if this were the SEC, but no case shall extend more than 30 days.
Yeah.
So I mean, you'd have something like
I don't
that.
see
I mean,
any
there'd be a
problem.
definitive timeline,
Well,
right?
you ought to verbatim transcripts and before you, so I mean, you're gonna have a hard, you know, that's not, I'm just, it doesn't matter to me.
And you're not writing the minutes either.
I've only got one.
But you're my new
I've only got one more meeting, so I'm not that stressed out.
All right, we ready to vote on that?
Did we strike it? Is it amended? What?
Somebody seconded it.
I second.
Time to vote on it.
We struck or as soon thereafter as practical, and we added regular or special.
Okay.
That was the motion. Now we need to vote on it. I didn't hear the part about adding or special meetings. I only heard the as soon as there.
Dr. Pritchard asked that we add the next regular or special commission meeting.
Well, I really was suggesting regular, but,
Oh.
I mean, I was seeing a schedule, the special one could fall in the calendar day.
Can we
Could
just-
have a special one, the very next day, got a regular. I don't know if you've done that, but.
Can we just keep it as the regular?
Right.
Is that-
Yeah.
Yes, we can just keep it as regular.
All in favor of the motion as stated, signify by saying aye. Aye. Ayes have it.
Were there any no votes?
I accept this. But after the day, Ed's still with us? Yeah, still here.
Hey. Anything else in that section of the policy?
No, sir.
All right, now it's time to vote on, somebody wants to move, or it's already been moved. Okay. Any more discussion on the policy as a whole? That's section. All in favor of adoption of section 4 as amended, signify by saying aye. Aye. Ayes have it.
Was that unanimous?
Yeah.
What page is the next section?
400, red line 400.
All right, section.
Executive staff and commission evaluation.
That section is open for anybody who wants to make a proposed amendment. Hearing none, is there any discussion about that section? All in favor of adoption of that section, signify by saying aye. Aye. All opposed? Ayes have it. What page is?
Number 6 is committees, which relates back to that section of 2, among other things.
That'll be page 404, red page 404.
All right, section Roman numeral 6, committees is up for anybody who wants to make a motion to amend any part of it.
Yes, sir. On page 3, subsection J, it says, any commission member may attend as an observer any meeting of such committee of which he or she is not a member. But the non-member commissioner will not have voting rights and may not participate in discussions unless asked by a commission member, as long as it's not a quorum.
I still haven't found it.
Page 3, subsection J1.
Actually, it says, I'm not sure if you have the latest one. It doesn't say unless asked. It reads, any commission member may attend as an observer any meeting of any such committee of which he or she is not a member, that is, a non-member commissioner. But the non-member commissioner will not have voting rights and may not participate in discussion, period. We are very, whereas Nancy, we need her. This very much relied on Nancy's interpretation of South Carolina state law. And she'll be back here soon, I'm sure.
Was the issue for quorum? Quorum is what, 4 now?
Right, so that's part of it. But then the other part, the competing part is, for example, this governance committee met and David and you were there. So should we say that unless asked, or if they are asked to speak, how do we pick between one or the other?
Well, they would have been a quorum. So you couldn't, so there would have been a quorum. Does you count toward a quorum?
We have to have 4 present.
Or a voting member, so it wouldn't be a problem.
Do I count?
You certainly
Should we
should.
double check?
But those are committee members, if you're on the committee, so.
No, I'm talking about, I think the fear is that you make a quorum of the full committee.
Yeah, that's
the full
the fear.
commission.
I'm sure that's what Nancy
Yeah,
would be.
I mean, and that's, I'm not
If you
sure
have 4
what,
voting members.
I'm not sure what the problem is, if you've already noticed it for, for a particular committee notice, and it's public anyway, I'm not sure what the problem with having 4 or 5 show up to watch it, or even chime in if it's been noticed publicly, and you stick to the agenda that's been addressed. Now, if Nancy may have some additional concerns.
Part of the concern, I think, David, is that, well, that say we have stakeholders who would be interested if we had several members of the commission, but if it was just that committee, so we would not be able to properly notice those stakeholder groups that we may have a lot of the
If you
commissioners.
took action outside of the committee's charter and outside of the notice agenda, you'd be in violation of the FOA on that front, not because you had a quorum of commissions. So it's more about sticking to the agenda than about unwittingly creating a quorum of the committee, the commission, excuse me.
And my concern highly is just letting everybody know what's going on and letting the public know and not somehow changing the type of meeting. That it's just trying
The
to
type
be
of meeting is
transparent
going to be
and
dictated by the
Excuse me a
committee's
second.
function.
It's okay, Nancy's back now.
Okay.
She's got an attorney general's opinion, she gives her some calls.
And I-
Tell us about it.
Y'all are talking about the quorum and
We're talking
meetings
about
and having a.
Whether a non-member, a commissioner who's not a member of the committee may speak, I suppose, during a committee deliberation.
October 7th, 2004, this is an opinion of the Attorney General's office. I'm just going to read the conclusion. We reaffirm our opinion of August 19, 2002. In our opinion, the court would most probably conclude that the attendance and participation by non-committee members at a committee meeting of Mount Pleasant Town Council, where there is present a quorum of the full council, constitutes a meeting of the full council. Thus, failure to comply with the notice requirements of the Freedom of Information Act could well result in a court's determination of a violation of the Freedom of Information Act. We caution that, as we noted previously, whether in a given instance the FOIA has been violated depends upon all the facts and circumstances, and only a court can determine that the FOIA has been contravened. Nevertheless, it is our opinion that any time a quorum of the full council is present and participates in discussions regarding a matter over which the council possesses jurisdiction and control, the FOIA's notice requirements relating to a meeting of the council should be followed.
And I agree 100%, and that's why we say that may not, we never talked about voting, may not participate in discussion unless asked, and may not if a quorum is present.
Yeah, or reinstate the language that's crossed out and substitute 4 for 3 if at least 4 commission members with voting privileges for the commission are present.
Yes. So that last clause would be, but the non-member commissioner will not have voting rights and may not participate in discussions unless asked and if no quorum of commissioners is present.
Okay, so it would change the read unless asked, and then also and if it wouldn't create a quorum.
Yes.
Those two requirements. You got it. You got it, Nancy. You need to read it back. Or...
I'd like for it to be read back specifically which.
Let me know when you're ready.
What page? I'm sorry.
We're on page 3 of the committee part of the government.
406, Fred.
406. J. And I believe what the motion is, after the word discussions, add unless asked, and if such participation would not create a quorum of the full commission. Is that correct?
Yes, sir.
Okay. Or is it, and no quorum of commissioners are present? Both of the commissioner and the room. You know, in other words, say there's 2-member ad hoc committee like ours was, and you got 2 voting commission, other voting commissions.
That would be a quorum. And I think your wording, the lawyer's wording is better.
Now, do you have the lawyer's wording? Lawyer?
I think Nancy wrote it down, didn't it?
Yeah.
Somebody.
Thank you one more time.
After the word discussion, add the word unless asked, and if such participation would not create a quorum of the full commission. Period. Any further discussion? All in favor of the amendment, signify by saying aye.
Aye.
Ayes have it.
Is that unanimous?
Yep. Anything else in the committee portion? Hearing no.
What was that, I'm sorry?
Anything else to amend in the committee portion?
Yes, sir. Is this Ms. Felder? Yeah. On subsection 4, excuse me, page 4, subsection L, 1D. And the committee struck, shall lead, that the Power Committee legally bind the commission or take action with respect to matters which require action by the commission, including the delegation of non-delegable fiduciary responsibilities or any other action contrary to applicable law. And so my motion is to reinsert that. That doesn't allow the committees to bind except unless it's in your charter.
Well, see, that was in conflict with the audit committee. Right, and that why they wound up getting struck.
And one time we delegated to the compensation committee the ability to make a salary decision. And we currently delegated to make salary decisions for people above 150,000.
This is a real broad power, and it allows a minority of the commission to bind the commission. And speaking for the minority of the one who's not on any committee, it takes away my ability to influence in any issues at all.
Well, what if it left in, take action with respect to matters, blah, blah. But remove that part that says legally bind the commission, because then that would give the commission the ability to delegate to the committee powers that we don't have to have a full commission to address. Like the compensation from the compensation committee or
And this was.
and the current charter of the audit committee.
Sorry, this wasn't to bestow any power to anybody, this was to prohibit a certain power. So by taking it away, you're not giving anybody any power, you're just not including in here that they can't break the law, that the commission cannot delegate something that's not delegable under the law. Does that make sense?
I understand what you're saying.
Whether it's in here or not, it's the law, so that part would be, but we can state it in here, it's just to legally bind when they're contracting. Historically, I felt like it was walking kind of close to violating that policy, and that just makes it clear that we're not with it.
And I'm not even sure exactly what the audit committee does, how they bind this. I mean, because most of that kind of overlooked this anyway. I'm not exactly sure what you guys.
We have some budgetary authority related to being able to command, in essence, resources.
There's certain powers it has that are, I don't want to forget what they are.
I don't have the charter.
As well as certain consultants.
Service providers.
Service providers that may be needed at the discretion of the audit committee due to sensitive
And certain other actions are required by audit findings, right?
That's correct.
Yeah.
I just wasn't aware what they were. Can we exempt the audit committee since they're already in it?
Here it is. The audit committee can retain independent counsel, accountants, and other specialists to advise the committee. Now, typically, right, because those are not considered proprietary, right, like to get the auditor, right, we actually have to get the state auditor's request, but we have it in the audit committee charter. So the audit committee, again, can retain counsel, accountants, and other specialists to advise the committee. So that also implies that, that has a budget impact effectively.
I would be very comfortable if we just exempted the audit committee since it has an existing charter. I think if you're not careful over some period of time, you've got two people finding over a period of time, two people could end up buying the commission.
I may be wrong, but didn't we have, isn't there something in here about the audit committee having three people?
Well, we were going to zip yes, I think it is, but we were going to exempt.
There wouldn't be two people.
Well, no, but any other committee, or an ad hoc committee, or whatever committee you have, because several committees are just two people.
You wanted to say something?
Yes, sir. As a practical matter, and what's actually happened in practice is, of course, the audit committee has a charter, compensation committee has a charter. In terms of a committee binding the commission to any action, the full commission to any action, it either has to be by virtue of the committee charter or by specific delegation by the commission anyway. A committee, unless it's actually in their charter, does not have the authority to legally bind the commission.
Now, that's
So-
what number 2 says in L, except, number 1 in L says you can't delegate. So, and I don't know, and maybe it should say you can't, nor will the commission delegate except as below. But number 2 says basically whatever the committee does is not final until it comes to the commission, unless the commission has delegated, unless it's set out in the committee chart. So, that's kind of inconsistent with the idea that they can't delegate anything till it's final. So you either need to make those congruent or match. Or you, not either, you do.
Let me ask this. The governance policy adopted by the commission, if the commission at some point in the future faced a similar situation, like when we hired the CIO, and we hadn't agreed on a salary, and about this time today, we wanted to delegate to the compensation committee the ability to set aside. Couldn't we always do a motion that says, notwithstanding the governance policy, the compensation committee shall do X, or the audit committee shall do Y, with the full power of the committee? Can't we always choose to do that?
Yes, sir, as long as you remember to always add that phrase
Always add.
notwithstanding, because we won't have the written motion.
And I think from an outside looking in standpoint, you always want to avoid having things that you are constantly having to say notwithstanding the rules, notwithstanding, you know what I mean, notwithstanding a bylaw. So you would want to, I think, draft your bylaw so you can avoid those as much as possible. You're right, the commission could change these tomorrow, next week, or next month, or next quarter, and they could do it on the fly like that, most likely. But I think you want to have policies, or particularly overarching policies, that you avoid every time you have to do something, you have to say notwithstanding our normal rules, we're going to do something different. So I would suggest that you just.
Yeah, it is easy to forget to put in the notwithstanding. All right, where do we stand? Has this motion been seconded or not?
Yes, sir.
I don't recall this. I just want to make sure everybody had a full discussion and understood the ramifications. Do we have a second? I don't
Where
hear
are we gonna accept the audit committee? I mean, in the like.
Actually, it's on I think 2 does that. I think number 2 actually does that. It doesn't say that.
Oh, okay.
Yeah, I think we're okay.
Travis, I think we got the card completely, but I have, before we do anything, we need a second.
I'm making it.
What is the motion? To strike the language, but add, with the exception of the audit committee, we can do those. Somebody needs to phrase it other.
But, but Dave just mentioned that we probably don't need that last bit because it is in there that, would you read that to me?
It's L2 that says all actions taken by the committee, any committee must be approved by the commission at commission meetings unless it's been delegated to them in the committee charter. And if it's in the audit committee's charter, well then that would be fine in line number 2. That just doesn't really jive with number 1 that says they can't delegate stuff like that. So I don't know if you want to say except as below up in number 1.
Number 1 here,
Number
D.
D,
L1 says.
as previously written, it looks like to me that D is inconsistent. This is more of a, striking D is more of a cleanup and to make everything consistent with the other existing policies.
I think this is real interesting. Lawyers talking, we're arguing over something that didn't only make sense to lawyers. Right. So I don't care.
Well, and again, we're out of whack here. I apologize for this because I was confused. I was listening in. How about that? I just think that this is important because if you don't take it, if you don't think it's important now, you end up in a situation where you've all of a sudden, over a span of time, you've got 8 or 10 things out there that 2 people or 3 people can bind a group of 6 or 7. And the charter, and I don't remember all that, and maybe it was some before my time. I accept y'all's wisdom on that. I just hate to see us go down the road of having a lot of committee action that binds the whole.
Yeah, the charter's good, standing committee, the charter's approved by the whole commission.
Okay, do I hear a motion?
Yes, sir. So, we would not strike that, but Mr. Brennan here says that we should not strike that, but then add the very last sentence, or any other action contrary to applicable law, notwithstanding the commission approved committee charter.
Again, sorry. That makes it sound like we, in a committee charter, we could approve the violation of state law, because obviously we can't.
I'll tell you what, I'm even tired of this. If y'all let me bring this up at another time, can we do that? I mean, I know I can't anyway, but I'll just scratch this whole idea, and we'll, because I think this is the only one in this section. And I'll bring it up another time. We'll think about it, I'll get more.
It's always open to be brought up at another time, but you have, we specifically will come back to another time.
So, withdrawn. Bye. That's it.
And that's it on 6, right?
Yes, sir.
We're through with this section then? We're number 6? I got my numbers mixed up. Policy 6.
It's approved as amended.
Yep. I'm gonna call the question. If I don't hear any more discussion, then the motion would be to approve policy number 6 as amended. All in favor say aye.
Aye.
All opposed? Ayes have it.
And that was unanimous with Mr. Gillespie not voting.
Right. All right, number 7, communications. Do I hear any proposed amendments to that? Hearing none, it would be in order to vote on whether to approve the motion made by the committee. All in favor, signify by saying aye. Aye. Opposed, like sign? Ayes have it.
Unanimous?
No, not unanimous, because I'll vote against it because Commissioner Gillespie. Oh, I thought we were in, yes, unanimous.
Number 8, category service provider selection. Do I hear any proposed amendments to category 8? Hearing none, it would be in order to vote on the commission recommendation. All in favor, signify by saying aye. Aye. All opposed, like sign. Ayes have it.
Now we need to come back to 2.
And I think that's all I'm in.
We need to come back to 2.
Well, Alan raised the issue, he's gone.
What's the current status of 2? Is the whole thing in abeyance or just one
No,
section?
I think we talked about one provision, I think.
I think that was his point. We had several changes. That was just one of them. I don't know what they were, we hadn't talked about it.
It seemed relatively important to Alan, so with him gone, I'd suggest,
That's a motion, I'll say.
I'd suggest we hold it over a table of what the correct terminology is, but it seemed relatively important to Alan, and it's important to Alan, it should be important to all of us.
I agree with that. What policy?
So the entire
number is it?
section, basically the entire section, 2. Section 2.
Okay, so the current status of events is, with the exception of policy number 2, everything has been approved, and on policy number 2, the governance policy under which we'll be operating is the current governance policy. Okay, good. Good work, Travis. Not a lot of us survived, but good work.
That was a lot of work, and I did a good job.
Thank all of you all, and particularly Nancy and Dory.
That being done, I don't know whether the meeting is now no longer has a duty, or whether they have a duty with respect to policy number 2. Nancy?
I would think since unless the committee has further amendments, it's now at the full commission level.
Okay. So the thing that'll be on the floor, if Mr. Gillespie wants to put on the floor, is the already pending and motion of the committee, and the committee has no further function. And we'll talk about it without your report. Thank you very much, all of you. Okay. What time is it?
3.
All right. We'll move to the AI. Well, I've got a break here written on mine. Do y'all want to take a break, or y'all want to proceed?
That was lunch.
Anybody? Okay. Well, he wanted to be called for executive session, right?
Oh, he wanted to be called right now. He said about 10 minutes.
Oh, did he? Okay. Go ahead, call.
Mr. Giovi, I'm going to have to put you on hold for a second, but we'll be right back.
All right, what are we taking? Are we taking a 5 or 10 minutes or what?
I'm going to take a personal break.
Okay.
And anybody else who wants to.
Why don't we say 4 o'clock to get all this done? Is that okay? I mean, I can't look at it.
Let's try for 5 or 4, but not
If you want to leave the phone on, that'd be best. Instead of calling out.
I'll leave it out.
We'll be in recess until 5 or 4.
I think there's plenty of coffee. I was just being try not to take too much because I figured a lot of other people would need it.
Is that there? I'm here. Okay. Ed? You might have the rest of them. Ed, Mr. Giovi? Still there? Mr. Giovi?
I can get it.
Mr. Giovi, are you there?
John, how you doing?
Good.
I hope we haven't disappointed. Was that? Yeah, we're taking a small, short break. I think.
Derek Williamson, I'm a reporter at Nations and Investments.
Did we not, at one point, get the very first approval from you to, if we have like everybody in the agency that needs to be added to a folder,
I've been covering, I've been at PNI.
put a sheet on, no, but I mean, that you agreed it was okay. Then when we do the 8416, we can do one and on the back put everybody's name when it's like everybody in the whole agency.
You know, it is weird as
I think Greg was going to
I used
just
to be
copy
married.
multiple times and stick it in everybody's
Exactly.
folder.
That's what okay. Because we had another change like that and they want us to do 8416s for everybody. And I was like, well, we already went down this road.
It doesn't really matter.
John, you do
The form over, substance over form.
Right, yeah, okay, thank you.
Just use that term on. Look, it's
Substance over form, I will put that to good use, absolutely. Hey.
How you doing?
I didn't know if you would find that.
It's just I have to give exact detail the reason I'm torturing.
Yeah, I was about to jump on that, but we got back to that. I'm very sensitive to not having information.
Let me follow it up by saying that whatever their procedures are.
Right.
Have to actually say.
Their procedures. If they want you to fill out multiple 8416s,
Well,
you can appeal it up the chain of command on that side to Lisa
all the way
or
up.
whoever.
Okay, I'll get any feedback on that.
And Herschel will either like it or he'll be obliged to present it. This is your feedback. And we'll decide what to do.
That works, okay, thank you.
And anybody who's going to have an alternate plan, if you can have it submitted the end of March.
I'll be out of town that day too.
Oh, April 30th. All right, how about April 29th? I tell you what, let's do it this way. If everybody will submit all prohibited dates in the last week of April to receive, I'll pick a date to call a special meeting based on that.
Which reminds us, Derek, you need to get us all your contact information, because I don't have, your
phone and all that sort of stuff, so we can bother you anytime we feel like it.
I think we'll have that about, but no later than this time tomorrow.
He doesn't send it out, I'll send it out.
Is that a continuing plan for everybody? Unless one week. Anybody wants to submit an alternate AIP? You said you might have comments.
No, I didn't say no. I don't have, I just made it, I'm going to be out of, I won't be available for the month of April.
I know, but I didn't want to put a deadline.
Oh, no, I've got it right in front. I'll get back within the next 2 weeks, so don't.
Okay. All right, so why don't we say 10 days before whatever date the special meeting is on? That would be almost 2 full weeks. 10 days. Definitely a full working. All right?
So that's
Now, what else you want?
that's the update. I guess the last thing I would say is my apologies is this was posted, and as I was sitting here thinking today, it'd probably been nice to have a red line version for everyone to look at the various changes. But with that said, there would be a tremendous amount of red, so it may actually make sense for me to go back through and highlight the old policy of what was kept and transfer to the new. There were a lot of sections that may actually be very similar, but when you're updating tables, you end up with a page of just all red. So to me, that just it gets very hard on the eyes. But I'll actually go back this week and deliver back to the commission the differences of the two policies.
Whatever the pleasure of the commission is, but when there's substantial changes, I prefer to look at a new, clean one and then get an executive summary of major changes. Because it gets cumbersome to do a line by line. Is that okay with them? Okay, do that. I think that makes it easier for me too.
So that was really the update for the annual plan.
Okay. Moving on. Audit committee report, the chairman is not here. If he has delegated to Andrew.
He should be on the phone, then he's
Oh,
going
you
to
on
hand
the
it off
phone,
to me.
Alan? Hello?
Is he on? If not.
Hang on, can you hear me? I had it on mute.
Oh, okay. We're ready for your report.
Okay, Andrew, I believe, has uploaded some stuff. Audit committee met. The major item was discussed in executive session related to one audit. As a result of that, we elevated it. The intention was just in the letter we sent the information we were seeking. I understand it's now forthcoming. So the audit committee has not taken action on its one motion because it is in possession or believes it's now getting the information that it was seeking. Other item, major item for audit committee, and we're having to check procurement, but as an outline of the cheapest on our audit plan, just the number of hours. We may need to seek some additional resources. We're trying to find out, the procurement policies on that, but really had to do with the amount of time available versus the work plan. There's a mismatch between hours available and hours needed to complete the work. But we're having to investigate what the procurement procedures need to be so we can secure the resources necessary to finish that up, keep them on track. Andrew, I'll turn it over to you for other items.
Okay, thank you, Mr. Gillespie. I just want to give a brief update on the Deloitte Risk Assessment Dashboard. I know you guys are quite familiar with this, but I think it's a great way to update the commission and staff on where we stand on some of these important initiatives that Deloitte raised last year. Also, another new addition to the Deloitte Risk Dashboard is now going to the Budget and Control Board on a quarterly basis. It was something that they requested. We revamped it a little bit thanks to some help from some staff. So now we have a summary page. It's not that Excel spreadsheet which is a little tedious to read. This is the summary page, and then we still do the Excel with the detail. But if anyone wants a quick glance, this will always be included as part of the audit committee packet, and it also will be included as the commission meeting packet. It's included in your material on the extranet site. So I'm just going to highlight a few of the recent updates, and if anyone has any questions, obviously I'm available. One recently completed task, which Mr. Harper touched on, was we have finalized and are now following new ongoing due diligence guidelines. I think this will help in many areas across the board, and it was a recommendation specifically of Deloitte, and the investment team has been very proactive in one, getting the procedures documented and starting to implement them there. And that is something that we will be auditing on a go-forward basis. Some of the tasks still in progress, where we actually have made some significant progress, is to develop operational infrastructure. We see that as a high priority item. Where we made progress on this is we recently have implemented the CMS system, Advent Tamale. Last week, the Advent personnel came out and trained all staff, and now everybody is live on the system, and I think it's been very good feedback. This will help in many areas. It will help improve institutional memory, it will help increase reporting capabilities, and it will help create a better audit trail, which obviously myself and my colleague Ms. Houston really appreciate. Another area of importance is we're trying to finalize a contract for Private Eye, Private Informant, and Private IQ. Such programs will give us better transparency for our private holdings and give us more detailed data to give us better reporting capabilities. Another high priority, which Mr. Harper touched on in his update, is developing a global risk management system. This is a mission critical area for our portfolio management group. Folks have been hard at work and will be issuing an RFP shortly. In the area of compliance, at the audit committee, we presented a compliance framework, which we're hard at work in implementing. Another area that we've been working with is BNY Mellon in discussing there how the compliance module, which can be used to monitor the investment guidelines of the separately managed accounts. So we're still seeing what the capabilities are, but we see that as a potentially great resource. That's all I had in regards to the dashboard. If anyone had any other specific questions, let me know.
Could we get dates on those?
What's that?
I like the dashboard. It's very helpful. But if we could have dates on those, because it's difficult to understand the chronology.
Dates as far as like?
Yeah, like implemented formal.
Oh, yeah, we can do that. Yeah, that's great.
That
Yeah.
would have a
So
context.
implement November 2012 or something like that. Yeah, I will make note and add that for the
Thank
next,
you very much.
the next meeting. So, that's it. Thank you.
Whole deal? Personal funding authorization.
It's actually Ed. Ed?
Oh, Ed.
Ed, are you with us?
Yeah, I'm here.
Okay.
Funding authorization, we've reached that item on the agenda. And you had, at the last meeting, I believe it is, you had undertaken the responsibility to get that sorted out.
I guess this has been an ongoing discussion, I think, going back to, I think, the WAMP, and I think Sarah and Bill Leidinger have attempted to rise to meet, and apparently have not been successful so far. And as I understand it, Sarah is, right now, we require two signatures of the commission to authorize incoming funds. And then there are, what we would like to do apparently is to authorize a number of other people and enlarge the amount that would be authorized for funding. And apparently we have not been able to reach agreement with the treasurer's office on that. And I was hoping that we could include that, because I was told that some time ago there was quite a large sum of money was wired into our account. However, it required signature by Herschel, and he was not available. And there was a danger that it could be could not be taken in over a weekend, and we would have lost the interest on, I believe, several $100 million. So I guess this was an attempt to try to remedy that. That situation apparently was remedied at the last moment, but it would seem almost sensible that we take whatever action is necessary to prevent anything like that happening in the future. So I would hope that the commission and whoever appropriate person is, I guess Mr. Leidinger at the treasurer's office, with them could arrive at an agreement to prevent something like that from happening in the future.
has staff prepared a motion that would accomplish what Mr. Joby requests?
There are several motions under item 11.
What page?
Well, I'm on the motion section of the extra.
Can you speak up, please?
Sure. This is Adam Ed. Reynolds asked for the page number. I was actually on the extranet. I pulled up the list of motions.
What I don't know is which one of these motions is applicable to what Ed just talked about. So somebody needs to guide the commission through.
Mr. Chairman,
Yes.
I believe I can explain
Okay,
this.
fine.
The motions before you ask for 4 different things. One of which is we do ask the commission to consider initiating standing instructions for money coming in. Right now, we have to have 2 signatures here and 2 signatures at the treasurer's office in order for us to receive money. We would like to have standing instructions in place so that we can instruct the custodian bank just simply to receive that money. I do feel like the controls are stronger with standing instructions than having other signatures, and it's also more efficient. It also handles situations where people are out of the office. This is a fairly simple situation where we're trying to receive funds. So being discreet about it, that is one thing that we would like to ask for. Another thing we'd like to ask for is to consider setting, for the commission to consider setting the authorized signer at the commission and the amounts associated with that. Right now, Herschel is the only person that can sign for any transactions over $100 million. And we do find situations in the normal course of business where Herschel does travel, where he's out of the office for vacation, sick leave, things like that. We are looking for live signatures on these things, not electronic signatures is my understanding. And so we would ask the commission for you all to consider setting your own authorized signers and the amounts associated with that. I've put suggested amounts and people in your packet. Of course, if the amounts are unpalatable to the commission, we can consider different amounts. But I believe the issue that we are trying to resolve here is just that we need a little bit more flexibility than what we have right now, with Herschel really being the only person who can sign for over $100 million.
Those motions are on.
This is incoming cash only?
I want
We're talking about
standing instructions for money coming in.
Okay.
So that would be, we wouldn't have to have anybody sign for it. We just tell the bank, when money comes in, go ahead and put it in our bank account.
My
Very
question was,
simple.
we're only talking about incoming cash, not outgoing.
The other half of what
For
you're talking about.
for standing instructions,
I'm sorry.
it's just
Thank
money
you.
coming
Okay.
in.
All right.
For us setting authorized signers and amounts, that's for money going out.
Okay.
So 2 separate issues.
What page do we go to look at that?
471. Read 471.
471?
That's the motions at the bottom.
Well, just to inject a bit of humor here, if someone was to put some money in my account, I don't sign, I just take it. And I understand the reason.
You send it back, right?
But I understand the reason it has to be signed, well, I'm kidding.
Just so they approve it,
As I said, on the dollar amounts, if we're not comfortable with the dollar amounts, we could consider other dollar amounts. But we certainly need, some relief. I think it's prudent to have more than just Herschel that can sign for $100 million.
All right, so that would be the motion that references to, all right, for incoming money, it'd be the motion that references Exhibit K, is that correct? No, that's, the incoming money motion, which one is that?
That's
Okay.
The fourth one. The fourth one is for money coming in. Fourth bullet point there.
Okay. All right, then. What Sarah's suggesting is that there be a motion made to approve standing instructions for distributions, cash which managers need to send us. Currently, we must have 4 signatures in order to receive this cash, 2 from RSIC and 2 from SDO. Standing instructions will negate the need for the 2 signatures from us. The SDO can proceed however they wish regarding authorization from the SDO. She references Exhibit M, which is on page 1.
I'm sorry, I don't have the red page number.
471 is where the motions are outlined.
I know, but there's a reference in there to Exhibit M, I don't know what
It's part of a different document.
It's the letter for signing
514.
instructions.
Red.
Yeah, that's just the actual instructions to the bank.
Oh, that's the instruction, rather. So what is the motion?
The motion is in your motions file on the internet. Read it to you.
Okay, the motion, the commission approves standing instructions for distributions which cash managers need to send to RSIC. The rest of that seems to be an explanation of the motion rather than the motion itself.
Right.
What standing instructions are you all asking us to approve?
They're actually on the 514, the form is listed.
It's really just to tell the bank, when you receive money on our behalf, that we don't have to sign for it, to go ahead and put it into our bank account.
Would somebody like to make a motion that the procedure set out on page 514 of Exhibit M be approved by the commission? I'll make a motion later on if somebody wants to second it.
Can the chairman make a motion?
Yeah. I don't hear a second, so we.
Wait, I'll second it. What, did no one second it?
Nobody yet so far. Nobody made the
I'll
motion.
second it.
Okay. Anybody want to
I'll second
discuss it? This is on receiving the money.
Yeah, you know, we've had a lot of conversation and discussion with an active RFP. There's been a lot of discovery about our customers. It's not maybe how everyone thought it would be. It's not as simple as it sounds. Little things that we've done and big things have led me to believe that it needs a lot more supervision. Little things like some things I can tell you about you wouldn't understand. These pages here are the people who have access to our account. RSIC had the ability to open and close accounts and give access to people, and they never took people off. At State Street the other day, 46% of the people on there were taken off. Another house, half of them were taken off. We have, you know, we continually worry about security and operational risk, we continue to worry about security, but with a password, you got everything you need. And we hadn't taken people off in years. What I'm trying to do is gain custody of this account. It's not fun for me to have to sign these things. I have to sign them all. It's the biggest burden here is on me. On Herschel's $300 million, whatever it was, came in, they gave us prior notice, and we handled it. There was no last minute problem. Was there a last minute problem? You were in Wampi, it was taken care of.
Well, actually, what I was informed of is the money sat at Bank of New York over the weekend.
We didn't know that. Did we know that? No, we didn't know that. We gave very specific instructions. I haven't been out of town as well. You know, she could on Thursday night. I'll get this information for you.
I believe we received the funds. We used Herschel's electronic signature in order to do that.
Yeah,
Informed your office.
And we certainly did, didn't we? So there was no troubles.
I think the big issue is not whether or not you've avoided trouble to date. It's creating efficient processes, and so you avoid troubles in the future. And I think that's what we're trying to do here with receiving cash in, so it does not remain at Bank of New York's balance sheet, because God forbid the $200 or $300 million sat on their balance sheet and they somehow went bankrupt over the weekend like Lehman Brothers. That's gone. And so I think having standing instructions where they actually sweep the money into the trust, it makes a lot of sense. And I think there could be a well-documented process here with these standing instructions that are very specific to this part of the receiving money in, and it gets swept. We could have a U.S. holiday and non-U.S. markets, international markets are open, they send money into a bank. We're not here because it's a state holiday. There was some of the potential risks that we're trying to avoid and eliminate. So having standing instructions to receive money in, that everyone can sign off on, including our office and your office, and your office then would instruct the Bank of New York. I I think makes a lot of sense. And I think the other side, the actual money going out, that I can't be the only one with certain signatory authorities for certain amounts of money, because there are very large sums of money that we deal with. And if I'm the only person that can sign for things, that basically means I cannot leave this office. And that's just not, I don't think, how you want your CIO functioning on a day-to-day basis. So I think we need to address that with different levels of signatory authority for moving money to different accounts. But that's a separate topic. We're talking about getting money in.
I'm going to ask a very naive question. And I actually have been a CO, I should know this. Mr. Treasurer, anybody coming in goes into Shakun. I know Shakun 35 years, but it goes into her account, right?
We left for India today, by the way.
Yeah, she really? So anyway, why do we as a commission have to sign off on that at all? If the money's coming in to the treasurer's account, I mean,
part of it is just, part of it is.
Why can't you just accept the money? John, let me finish. Curtis, I'm sorry, Mr. Treasurer. Under your signature, on whoever you designate, the money's coming in, you say, okay, why does the commission, or some of the commission, have to sign for money coming in? I mean, if you get tax receipts, somebody to sign for that, or anything? I mean, I don't understand, it's not a question,
I agree. It is a reasonable question, and I'm actually kind of there with you, but it is a part of the process. I would like to backtrack just a minute. With all the problems we have with risk, we're worried about a bank with $2 trillion on their asset going out of business over the weekend, and that's our risk. That's what we're concerned about right now. This is part of the process, and I'm trying to bring the process to it. I do think it's interesting that you're looking for efficiency when I'm stuck at the office because of certain documents that my staff can't read that are integral to the custody. I mean, you know, we
I appreciate your concern, but bring up reading documents versus an actual operational policy for cash management, I think are two different topics. And so I would, the commission should strongly consider receiving cash. And yes, I would have a concern of a $2 trillion bank holding trust assets on their balance sheet over the weekend. I think that would be a concern, because we know of other issues of where the bank has had some issues, and we'll bring that up.
Concerning me too, and we don't want that. But this is part of a process. The committee can vote. I mean, the commission can vote how it wants. I'm the custodian. I've got the account. A little bit odd. You come to me and say,
Can I just ask a question on this, Mr. Treasurer? Right? I mean, my custodians, if their wires coming in for us, they accept them in, right? I mean, why would your office accept them in as our custodian?
That's reasonable, Alvin, and we will.
The question, I mean, why does anyone have the commission need to sign? I mean, that should be handled out of y'all's office. If you want to have 6 signatures for money coming in, I don't know why the commission, beats someone to sign. I don't sign when wires come in from my firm or my clients.
And we won't forever either. We're just going through this big process of trying to understand exactly how this account works. And it is full of anomalies. It was set up by 3 different groups, one with very significant desires, and the account does not work like people think it does. And since I have to be there, all the time, I'm involved with it. And I am learning a tremendous amount of what goes on, and until I decide here, and it's not going to be all that much longer, until I decide it's going to stay the same.
Let me ask one question, then we need to take a break long enough without Ed, and he got cut off somehow. We need to get him back hooked up. The money comes into the treasurer's account, and it can't sit in his account, it has to go in one of our accounts.
It doesn't come to my account. It goes to we manage the custody account there, but it goes to your account.
Who decides what accounts it goes into?
I see.
If I could clarify, what happens right now is the bank takes it in, but they put it in their account, in an account in their name. We have to give instructions to move it to an account in the commission's name. And I think the only action that we're asking for is for the treasurer of the bank to consider us just doing one set of instructions here now of saying when money comes in, we don't have to tell you each time where to put it. Put it in the same account, put it in our internal cash account each time. And honestly, that it is a relatively small matter. I really thought this was low-hanging fruit and would be a win-win situation. You know, the commission had asked me, I believe in September, to deal with this administrative matter, and I haven't been able to resolve it. But it's y'all's decision. If you don't want to deal with it, that's fine. I just need to be able to, you know, I just need to report back and say that I've tried to work on it, but I haven't been able to, you know.
You mean you haven't reported back that you've tried? I mean, like at every single meeting and at every single committee meeting, and you haven't told Ursula that before? I mean, we just did this last month.
In the absence of the standing instructions to put the money in these aid accounts, it would just sit in Bank of New York. So in effect, we're making a decision to leave it with Bank of New York.
And you earn zero interest, is my understanding.
I'd still be, I would still, and we can change what aid accounts we hear about if we're concerned about the safety and soundness of anything different. Or not.
Mr. Chairman, if I may, as a former cash manager, you could set it up with every manager to have funds transferred into the concentration account of the treasurer with further instructions to go into the account of each individual manager, and nobody would have to touch it. It would be automatically handled and get into the final location without further efforts.
And that would be without any signatures from really anybody to the treasurer's office, right?
They wouldn't
They can do
have to
what-
look at it, they wouldn't know it.
Okay.
The cash manager who's monitoring the concentration account would see all funds in and out, and at the end of the day, they would manage their funds. They would set up automatic sweeps or whatever to take it down to a target balance, and that type of activity is handled automatically.
So I think this is a step to create some operational efficiency and mitigate some operational risk.
And who's going to give this order to the bank?
So I think that the commission will actually give the treasurer's office standing instructions.
Okay, so these are standing instructions to the treasurer.
I think the treasurer has commented that he would not change anything. The idea was to be able to work with the treasurer's office so that we'd all be on the same page. We could all sign this one time, and it would go to the Bank of New York. The treasurer's saying he doesn't want to do that, so I think the commission may have to, as the investment manager of these funds, give a standing instruction to the treasurer's office as custodian to automatically accept money in when it comes in.
Do we not have an omnibus account somewhere that we can, pending, let's say there are no signatories involved, they came to you, could we not have, without any signature from any of us on the commission or on your staff, it goes to an omnibus account for the commission under the authority of the state treasurer?
We have standing authorities now. I mean, we have some deadlines for some very specific actions, and this is a very, very minor action, but it dovetails with a large action. And I've tried to
I certainly don't understand the bigger concept,
Yeah.
but I mean, for this particular item, it went into the treasurer's office without any signature, and we had standing, but the treasurer had standing instructions or whatever to put it in an omnibus account for the commission or for the trust. Would that not solve the problem or not?
I think that's what we're trying to get to, is those
Yeah,
standing instructions.
that's what they're talking about, and I do have a deadline, I mean, I do have a time date for this, but it hinges on several other things, and, you know, you can vote how you want, because we know where this is going, we just continuation of this morning. Made myself clear, told the people about the deadlines, told everybody what we're trying to do with the account, rehashing it again, keep rehashing.
Well, my feeling is if you guys think this would solve the problem, I certainly don't think it would solve the problem, so I'd be favor what you guys tell me. So let's vote up and down one way or the other. Is there a second? I've heard a second, Alan's second. Any more?
What is the motion, please?
We issue standing instructions in accordance with exhibit, you know.
I'm only on 2 pages.
We will really have a problem is once the standing instructions are on, the money comes over without a signature. And what happens then? Because I'm not going to transmit it, I sign them all, so I'm going to break them in. So then we've got money piled up, which you're doing there.
So I guess that will actually be something that we'll bring back before the commission, that you are not wanting to take an investment directly from the commission.
I'm the custodian, I don't work for y'all. I'm not your contract custodian. I'm the statutory custodian of the funds, separate and apart. Custodian of university funds, DA funds, everybody's funds. We've got, so this is really community stuff, and it's just trying to prove a point, is all it is.
We are your unilateral movements to actually change how the processes work without consulting and working with staff here, actually trying to develop something
Well,
that's
I
mutually
actually did.
agreeable and workable.
Well, then
We
we'll
did.
talk about it. A lot of this came up
The
because-
idea is we're trying to create efficiency so that you can actually get a lot of work done in a low-risk environment. And
Do you still need a pause so that we get in? Let's pause a second if we could, and let's get in.
Hello, you've reached the GOD. Please give your name, number, and a brief message, and we'll call you back as soon as we can. Thanks.
So how this all started, and how I became very concerned about the account was back in January of last year. We had placed some, changed some of the regulations, tons and tons of regulations around this account. All new fundings had to come to the treasurer's office, except for the commission started calling new fundings capital calls. We sent $21 million to a group of people who had no social security numbers on file, no driver's license on file, no audited accounts on file. We didn't have a custody agreement with them. We didn't have special trust agreements with them. We didn't know who was on the signature account. It was a three-person partnership. That was $21 million. And we sent it right out the door. Y'all know about it. Nobody ever looked into it since. Nobody looked into it before. And it was just done. Now, when you buy a car in this state, if you finance it, it's $500. If you go into the title place, you got to show your driver's license. We give people $21 million without it. And it's just not interesting for anybody on this commission to even go see if what happened to the money. So, if I'm skeptical,
The commission is not the appropriate place to get lessons in elementary principles of law and the requirements set up by the Supreme Court of South Carolina. It's too late today to rehash that over and over again.
I don't have any ideas about what we're talking about is due diligence with the money of the trust. Due diligence with the money of the trust. Is there anybody here would loan $21 million without audited statements, social security numbers, and driver's license?
There's no loan involved in this.
Or send money to them, excuse me, send money to them. Is anybody who would send money to someone like that?
That's not an FDIC insured bank.
He's talking about receiving money.
Yeah. And how much money is the FDIC bank on the hook for if something were to go wrong? $250,000. So it's 21 million minus 250. So look, the problem we have here is that the custody account has not been managed properly for years. It wasn't set up properly. There are competing interests setting things up, and it's going to take me a long time to unwind. And this little small issue, Sarah, this little teeny small issue that burdens no one more than it burdens me, has been brought back here because it's the point. And the point is that this management here says nobody ever is going to impinge on anything we want to do. And that's just not what the law says. We all have responsibilities. We need to take them seriously. The custodian's account is not what it ought to be. We have 70% of our assets out of bank. I can't push a button and find out what we own or where it is. I can't explain this to people. I go to New York.
Let's limit the discussion to the.
Well, no,
to the
this is all part.
motion pending.
Well, this is about the custody
Are we going
account.
to sign the standing instructions or not? sign?
Well, this is about the custody account, and I don't care how you vote. It's just more ill will between us. It is a minor issue, and if you want to make it a big issue, then make it a big issue. That's all I got to say. And let's do vote. We have things to do. Go home. Don't.
Do you need this action?
I believe this creates efficiencies for the staff here for receiving money in, and it would mitigate risks. And I would be supportive of the commission voting in favor of this.
Unless somebody else has a comment, we'll vote on it. All in favor of the motion as submitted, signify by saying aye. Aye. Ayes have it. All opposed?
Ayes have it. Okay, the second issue. Whoops. Still trying to get it. Yes, I am.
Hello?
Hey, we're gonna join you to the conference.
Okay, thank you. Okay, that's working.
All right, Alan, are you still there?
Yeah,
I think my earpiece is dying out on me, so
Okay.
I just switched to the handset.
All right.
I mean,
All right, it looks to me like the motion relating to the signatures is the one exemplified by Exhibit L, is that correct?
Yes, Mr. Chairman.
And which of these written motions the third one? Okay, the motion would be, if somebody would make the motion, it would be that the commission adopt a recommendation from the the investment staff to officially designate individuals on the retirement system investment commission staff and/or the as authorized signatories, including the authorizing levels detailing dollar value limits and dual signature controls as set forth in the proposal presented by the staff during the meeting. And as set forth in Exhibit L, is that correct? Anybody want to make that motion? Ed, you want to make that motion?
Well, I'm a little bit of a quandary because apparently I got cut off a couple of times and I did not hear any of the discussions. But then last thing I heard was Sarah starting to speak, and then I heard nothing after that. So what exactly are we talking about?
We approved the motion to designate accounts into which incoming money should go, and now we're moving to the one relating to approving signature authorities for various commission staff members or commissioners at various levels as exemplified on Exhibit L. That was that 2 or 3 page letter.
So you approved by vote to authorize the, 2 signatures for money coming in?
No signatures for money coming in. Standing instructions for money coming
Standing
in.
instructions for money coming in.
Right.
Okay, that's approved.
Yeah.
And now the motion is to, proposed motion is what?
To designate, for the commission to designate individuals on the staff or on the commission itself to authorize, to be the signature, to have the signature power on the various accounts at month.
Oh, wasn't there some discussion about upping the amounts, or is that not?
Well, the amounts are set forth on Exhibit L.
Oh, okay, yes, I will make that motion.
I'll second. Discussion.
I guess I'm told on the commission itself. I mean, a commissioner would be able to be a signature?
All of them, as in the motion itself, I think there's 2 signatures was on it.
Okay.
And
One
the
of
individuals
which could be a commissioner.
One of which can be. I don't think it's set up, so one of which is required to be a commissioner, isn't it? Okay. The chairman and the vice chairman are on essentially the chief investment officer, the chief operating officer, and then at various other levels, the internal asset management director, the manager research director, the deputy CIO, the director of investment reporting and performance, the senior fixed income officer, operations officer, fixed income analyst. Any one of those 2, and or sort of a Chinese menu, pardon the incorrect, politically incorrect reference, but it's sort of a, depending on the funding level involved, it's a different set of 2 people might do it.
Reynolds, just clarify that for me.
Well, at a $250,000 level, anybody that I've just named, any 2 of those.
But in addition, any one of those people, but in addition has to be either the chairman, the vice chairman, or a member of the commission?
As written, it would be any 2 signatures from this list below, and dependent upon the funding level.
I see, okay.
maximum signature authority that any one staff person would have would be $2 billion. Then a commissioner, either the chairman or the vice chairman, would have to, at least one of them would have to sign up. The next break point is $500 million. Jeff Berg, the internal asset management director, would be he would be the cutoff at 500,000. Everybody at Jeff Berg's name on the list, and below 500 million, they would lose the authority at that point. And then the next cutoff point is 250 million. And the senior fixed income officer, Mike Addy, is that's the cutoff point on that group.
You essentially, Mr. Chairman, it looks like the first break point would be the chairman and vice chairman.
Yeah, going down the list, that would be the
The
first
second break point would be the CIO and the COO at $2 billion. Then the next level at $500 million would be staff directors within the various areas. And then at the 250 would be
officers.
Officer level.
Right.
At staff officer level.
That's the way I read the proposal. If I misstated it, somebody correct it.
But it would always require 2 signatures.
Always require 2, which 2 is dependent upon the dollar level.
Okay.
Mr. Chairman?
Yes.
I'd like Alan to put on this. He does this every day. Is Alan on the phone?
Are you on the phone, Alan?
Yeah, I'm here. Yeah, obviously you want at least 2. Most things are done, a lot of things are done electronically, right? I mean, back to the travel question, a lot of that stuff is done so you can actually have, audit trails and stuff like that. So to me, it seems like there's still a lot of transfers that are happening in the physical space. Sometimes those are required. I think, the other issue that you sometimes see is whether a signature needs to be stamped for large amounts. I mean, that's pretty common as well. Whether it's notarized or medallion stamped, different issues like that at different levels. So that would be the only other, sort of from a practical thing that people might consider. I do think if there's a way to eventually have some electronic stuff done, and like I said, for certain types of signatures or money movements, and some of that, is generally a custodian directive, right, of what signatures, require, say, a medallion stamp or a notary signature on it. I mean, that would be the only other thing. So, like, sometimes you'll see stuff that require 2 signatures plus a notary.
This motion as written would not address the live signature versus electronic signature question.
Yeah.
And it wouldn't address compliance with the banking requirement in the future either.
May I ask another question?
Yeah.
Suzanne, do you have any experience with regard to any of this? I mean, this is very operational. I know that's not your wheelhouse, but I just wondered.
We've got a whole division of folks that worry about custodial issues. To be honest with you, I've not run into a client where they've had this issue. I don't know, Brady, if you've run into it. It's usually has been in place for some time and is working efficiently, and we never get involved in it. But I would say definitely you want a mechanism by which, when decisions have been made, they can be effected with proper review if that's necessary, and the cash not sit uninvested. I mean, those are just 2 basic core concepts. So I wish I could give you better guidance on that.
No,
I just don't have it. We do have some other, somewhat unique structure in the way that you have different governance pools, and we do have some clients that have individual investment commissions that are separate from other boards or the treasurer of the state, and I can see if we can find any more information if that's helpful.
But I mean, I think we all know what has to be done. We know that things have to be moderated for the sake of a few weeks. Next week we'll have a crisis, because I'm not going to. I assume that the chairman's got a plan, the lawyers are ready, because any deviation from what I have, we're not going to do. We had another couple of weeks of the way we're going, and y'all decided to change early and create a crisis, and so we've got a crisis. I will remind you, Ed, when I came here, it only took 1 signature, and there were no cash controls. No written cash controls, excuse me. So we've come a long way, and it's been on my back a lot because I get in trouble about all this, but we have come a long way from one person, unlimited signature, no controls, written cash controls, to now we have people talking about dual controls and written cash policy. We've come a long way, but for the sake of a few weeks, couple of weeks, we've got to have a crisis. So next week, we're going to have a legal crisis. So, or tomorrow, I guess it is, yeah, whenever, I'm sorry, I've forgotten the date. So whenever the next one of these comes in.
That's sort of off the point of this particular.
Well, I don't think it's off the point at all, because this commission will have to meet again.
All right, well, let me just interject you. Unfortunately, I missed the discussion because I was cut off, but Curtis, I want to try very, very hard here to come to some agreement that you agree with, that we agree that we can live with, and we avoid any potential problems. Now, I would like to know, what is it you would like us to do?
Well, it would, of course, nobody from the commission have come and talked to me about it from a commission standpoint, a commissioner
I'm
standpoint.
asking you, Curtis, right now, I'm asking you.
Well, thank you, Ed, for letting me know that. I've forgotten already. These things can be handled a bit more appropriately. As I said, Ed, and you missed it, I've got a tight timetable on 3 or 4 different issues, not the least of which is the announcement of the new RFP, a new custody bank, or a new contract, I should say. So all this is happening at once. And Sarah has decided, and Herschel's decided, we have to force a crisis right now. And I imagine it's time for the General Assembly, I imagine it's time for a whole bunch of things. And that's because nothing's not. But I'm prepared for that. It amazes me, I mentioned just now, $21 million flying around with no accountability, and not one commissioner, not one staffer ever says a word. And so I have reason for pause. I have reason for pause. And so I'm putting into places over the next few weeks, the final steps that will make sure we have a best practice. I've been to visit these banks, I've been to see lawyers, I've done everything I can to make sure we have going into this new term a best practice set. It's efficient, it's safe, we have checks and balances, we know what's going on. Dave's being helpful here, he's getting us the copy of the general ledger. Custody, treasurer's office is a custodian, we've never seen the general ledger of other places. Everything was hit once, is that right? And only because he allowed us to do it. You just have to look at this holistically. The commission doesn't want to. Some people want to have a crisis. We're going to have a crisis. So next week we'll have to go back and vote, or maybe tomorrow.
Mr. Chairman. Don't say the commission doesn't want to. You and I have had some conversations, and you know that I am absolutely 150% committed to ensuring that we do not have a situation where we do not have a capital commitment. It's not, all the reasons why I feel so strongly about this. So I want to do everything under the sun possibly to avoid that. Now, I will tell you and tell everybody at the commission right now, if it is a question of simply another few days or a week, if we can have some assurance that we will come to some agreement on this, because I think it's extraordinarily important that we do not allow that to happen for all the reasons that we have discussed. I am prepared to meet you more than halfway. Now you tell us and tell me, give me some assurance that we can come to an agreement on this in a relatively short period of time to avoid any crisis situation and blow this thing up far beyond what it needs to do.
I think you may have jumped boat on us with the capital call from Warburg Pincus. I think that's the next motion. But to stay with the custody issues, I mean, we've told everybody, I've got a hard and fast date for the new custodian contract. We've been through this. But,
Jim wanted to.
That's okay. I mean, no, I'm trying to. If we voted here today to reaffirm the Warburg Pincus situation tomorrow,
I'm sorry.
If we voted to reaffirm our commitment to that and tabled the rest of these matters until you had time to work through your process, would that solve the problem? I'm concerned about the problem tomorrow. If we said, okay, we're going to vote to reaffirm Warburg Pincus, we voted on before, but we voted, if it's going to say, well, I'm happy to vote again, and then table the other motion. I mean, I think these are legitimate concerns. I had a guy in Japan steal $250,000 because he stole a Honko and he left the phony, stamped a receipt, this is true story, stamped a receipt and took the money, and we're not talking about stuff like that, but these are legitimate concerns. And so I take that to heart. But let's solve 2 or 3 problems at once here. If we reaffirm Warburg Pincus and table this other matter, because we're not going to resolve it at this table right now today, it's clear we're not going to, so why are we beating our guns together about it? If we resolve to reaffirm Warburg Pincus and then table this for a couple of weeks or whatever, I don't know, I like firm dates, but I don't care. Would that solve this issue?
Because I don't believe we can continually put it off. We apparently have, but look, I'll be very honest with you and very blunt with you. We cannot, absolutely under any circumstance, whether it's the commission or the treasurer's office, cause an event of default. I can tell you now, Jim, you were in the bond business a long time. I've been in the business a long time. And I can tell you what will happen. The consequences will be extremely negative. We're not just talking about the commission. We're not just talking about the treasurer's office or a couple of signatures. We're talking about an issue of extraordinary importance that would have dramatic repercussions, potentially. We need to be smart enough to avoid that and cut out all this petty bickering. Now, I can sit down with anybody there in that room and we'll get this solved. Now, let's just do it, okay? If you want to give suggestions, then let's take Jim's suggestion, but let's have a point effort to solve this issue.
These are simple issues. The Warburg Pincus deal.
We'll get to Warburg.
Well,
Pincus in
he's
just a
talking about
second.
Warburg, and he's talking about Warburg.
What he wants to do is set aside everything else, and let's move to Warburg. Ed said he would agree to that as long as there's a specific date for those other things that are being set aside. So let's deal with that, then we'll move straight to Warburg. Yeah, I promise. Yes, sir.
Mr. Chairman, just to be clear, this was actually a directive from the commission, I believe Ms. Corbett, to bring this back and to work with the treasurer's staff. And then Mr. Giobi said that if staff was not able to get resolution from the treasurer's staff to bring this back up. So this is one of these matters being brought back up. There's been multiple attempts to the treasurer's staff to resolve these issues and work through these issues because they are critical to how the commission operates. But there could never be a meeting. There's refusal to meet. The treasurer has mentioned that he has this grand plan, he has a timetable for many different things. I think that he should share that timetable today with the commission so the commission understands what the exact timetable would be to have these decisions made. Going back approximately 6 months, there was a discussion from the treasurer saying that he was soon to make a decision on the custodial fee, some 6, 7 months later. So I think that for us that we really need, as Mr. Powers pointed out, real firm dates of what the expectation should be, and not a couple of weeks that turns into a couple of months. So I would ask the commission to seek that timetable and specific dates of when these decisions will be made. Because even back when this issue first came up, I believe in September, Mr. Ligers had mentioned that they had just received information from Bank of New York that day that would help them make this decision. We've asked for that information, they've yet to see that information. So I would ask the commission to be very specific with request of timetables and dates.
Jim, one way to solve your problem, and I'm just talking now, it would be to move that this motion carry, unless, and subject to the vice chairman, Mr. Jody, reporting back to the commission that by a date certain he's had the discussion and they've resolved the issue, in which case the motion would come off the table, would not be effective. That would be one way to do it. I'm just saying.
I'd like to add that I did offer to go to a meeting.
No, I'm serious. I mean, I didn't.
Well, thank you, Jim. I always appreciate your good humor and your business-like approach. The problem with Warburg Pincus is that they wouldn't print the contract for them. That's what we're talking about. As a custodian, I want to see the agreement. Is that some other reason?
We're not talking about Warburg.
Well, we are.
We're on the agenda item.
I'm sorry. Okay, well, that's all right. We don't have to talk about it. In fact, let's just talk about it. Let's just vote, because I don't care. I've tried to work. We have a lot of things in this big custody issue. And I agree, again, I can't get information. and I have to deal with all the confidential information myself. And I can't do but so much. This room was full of people who can print information, who can get confidential information, who can make decisions. My office isn't. I'm it. I'm it. Ed, I send you emails. I've started sending you emails when I go to work at 3 in the morning. Are you getting them?
Yeah.
Because I'm there reading the documents that Reynolds says I can't read. So
I've never said you can't read it.
Others can't read it.
I've never
So
said that.
yes.
I've never said that other
And
documents.
an issue.
Well, can we get back to the practical and important issue at hand?
Yes.
How are we going to work together, and I say, emphasize, work together intelligently as smart human beings to avoid a potentially not only incredibly bad situation, but it's just inconceivable to me that we would be so rigid on both sides thinking whatever it is to avoid such a really terrible situation. It would be really, really bad, not only for all of us, but I think for the state. We've got higher things here to think about than just this, a couple of people on the commission or a couple of people are serving on it. And I urge you, Curtis, to please, and I beg of you, let us try to settle this to avoid what I believe would be a really potentially catastrophic situation.
Ed, it would be so easy to have an administrative assistant hit a button called print. That's all you have to do. It'll take about 10 minutes, and I'll walk over and pick up the contract.
What is it? Tell me right here now. You ought to tell everybody exactly what it is you need to avoid what we all would want to avoid.
I will tell you exactly what I said in my note to the governor, and the treasurer, comptroller general, and everybody else 30 days ago. I can't read all of those documents online. Has any commissioner read Warburg Pincus still online? Anyone? You read the whole thing online?
The contract, yeah. I'm the one who has to sign it.
Okay. Let's see here.
I mean, I don't have to answer these questions, but yeah, I
Well,
read the contract.
That's good, because the last meeting, you and Alan both said you signed the signature payments. So I'm glad you started reading them. That's excellent.
I never said that. I
Well,
said I
listen,
read what
Reynolds,
I need
please,
to
come
read.
on. Now,
I have
this-
a fiduciary obligation to do what I'm supposed to do. You raised an objection to the contract. I read the whole thing word for word.
Yeah. Well,
All
Ed,
78 or
a subsidiary
84
notion most of this is that if we have 30 days to look at these contracts and we make an objection, if the objection doesn't matter, we need to do away with that motion. There's no sense in giving people the false sense that the commission has a chance to
All
look
right,
at the
we're
contract.
off the agenda item.
So-
The pending motion is whether we adopt this or don't.
That's
adopt
yours. You can do what you want. I'm the custodian. I direct the funds, and I will direct them as I see fit. I have procedures in place. I've told folks that it's very shortly all that's going to go away as we bring things in. I don't want to go piecemeal, and no one has to feel the burden more than me. And I'm very sorry that Sarah has to inconvenience herself, but when you work the kind of hours I have to work because of the conditions this place has put on me, then you and I can commiserate. But until then, I'm not too worried about it.
Well, let's go back to what Jim said. Jim, are you still there?
Yeah, unfortunately.
Tell me again, that sounded very practical to me, so please restate that.
My thought was that, and I understand about kicking the can down the road, but, you know, we, in the public sector, you know, have learned that that's the way things work often. And that's not a criticism of anybody. My thought is, how do we avoid a situation tomorrow that none of us want to go into? So I agree with you wholeheartedly on that. So my thought would be simply that we defer these decisions with regard to signatory and all this stuff, and reaffirm the commitment to Warburg Pincus, if that would suit the treasurer, so that we could transfer the money and come back to discuss this another day. And I'm sorry, Mr. Chairman, that I'm combining two issues, but they seem to be intertwined. So my opinion is that the treasurer has spoken his position, and it seems to be relatively firm. And so I think that we should table this and vote to reaffirm Warburg Pincus to avoid an unpleasant situation for all of us. and come back and discuss this another day.
That's a motion, Jim, I'll second it.
Yeah, what I'm inclined, is second, and
Okay.
what I suggest, what I'm inclined to say is, let's do that. But what I intend to do is call a special meeting to deal with this motion that we just tabled on some date that we pick, unless Ed reports back to us that we've got it resolved. But we either go have it resolved by agreement between the treasurer's office and Ed, or I'm gonna call a special meeting so we can deal with that, just with that one isolated issue. Jim, you wanted a deadline, so we put a deadline.
Well, I suggested a deadline. I just don't want to have a situation more than none of us want. Is that agreeable to you, Mr. Treasurer? Okay.
Yeah, because we're, as staff knows, we're headed there anyway. Now, one problem though with Warburg Pincus, I cannot read that like tomorrow. I mean, I'm the custodian. Are you actually saying that I don't have to read contracts that are tens and tens of millions of dollars, the agreements? I mean, is that what we're saying here? I have a fiduciary responsibility.
The motion passed by this commission is that that thing will be reviewed for 30 days, posted on this. Every commission will have a chance for 30 days to review.
Yeah, I'm out. Y'all do it.
Opportunity to review it for 30 days.
I know. It's a power thing, and he's gonna play. And I just refuse to repudiate my fiduciary responsibilities. I'm the custodian, and I'm gonna read the contracts before I send $50 million to anybody. You let us send $21 million to people we didn't know, have any idea who they were, in fact, and I'm not gonna do that. I believe the trust, I will not squander the assets of the trust, and you can send the money wherever you want to, if you can wrest the custody of this account from me. But I'm not gonna do it. I owe to retirees to read this. And so that's just all I gotta say about it. And can I make a motion can I make a motion to adjourn? Surely somebody will be with me on that.
What are the consequences to the trust fund if the call's not made?
Well, the contract has not been executed yet, the 30 days not. If he moves to execute a contract that he knows is not gonna be funded, then he's got to deal with
When
consequences.
is the funding required?
March 4th.
So March.
That's when they call it. Sorry,
That's
Mr.
what will be
Chairman.
the first call.
First
First
call.
call's Monday.
When does the money come?
You have 10 days after.
10 days.
Sorry, Mr. Chairman.
I'd rather discuss that when that motion gets on the floor. What we do. A pending motion, I will withdraw my making of that motion. And my intention is if this matter doesn't get resolved through the good offices of Ed Jody, the vice chairman, and the treasurer's office, I will call a special meeting on or before March the 15th. Does anybody think that date's unreasonable? Okay, that motion's gone.
I don't have a contract to read, Ed, so I can't read it. So
You don't have to read a contract to deal with that motion.
Well,
Curtis, can't you just accept the fact that the commission voted on it?
no. Ed, can you not respect the fact that I'm a statewide constitutional officer that says that I am to safekeep the money by being its custodian, and I'm going to
That
read the
issue is
contract.
not on
I
the floor.
refuse to, that's what he keeps talking about. I refuse to send money to people that I have not studied the custody
I have
agreements.
withdrawn my motion. I am now calling before the body the issue of the Warburg Pincus Fund. I would like to hear a report from the chief investment officer on the Warburg Pincus Fund. And then I will entertain motions relating to this. So let's let the body have a report on the Warburg Pincus Fund.
Warburg Pincus was approved by the commission. Has gone through the 30-day review period. The documents were posted to the secure portal for commissioner access only, as these documents are confidential. And the timing to sign that is that 30-day point has passed, so the execution of those documents could take place per the 30-day review. Once those documents are signed, we have been informed by Warburg that there will be a capital call shortly following. I believe the exact date was March 4th. If those documents are executed and the capital call comes and it's not met, then there are significant repercussions of that. That we would be in default, and we would not want to be in default.
Let me report.
Have we executed anything at this point?
No, that's what I'm getting ready to report on. the documents were posted on a certain date. I don't know what the date is, but the bottom line is tomorrow is day 30. I have not received any substantive objection to the contract. The only objection I have received is the treasurer's objection, is that he doesn't have time to read it or can't read it or whatever. But anyway, it's a generalized objection to it. My intent, the document's been reviewed for legal sufficiency in accordance with the commission's motion of September, November, I'm not sure.
I believe it was September.
Of September. And if I don't have a substantive objection or recommendation that I can deal with on how, what to change or what to ask them to renegotiate, it's my intention to sign it, to sign the contract once the 30 days have passed and the chief investment officer has, and the staff has told me that it's time, that it needs time to fulfill the commitment and the decision that the commission has already made. That's my intention. What I'm seeking is a motion and a resolution from the commission authorizing, directing the treasurer to fund that investment once the commission has signed the contract to make the investment. And it's set forth in okay, so it's a motion on my page 2. I don't know where it is in the book. Somebody, I'm gonna read it, and it is in writing, and then somebody can tell me what red page is on. Motion: if the chairman has executed the necessary contract documents to close the SCRS investment in Warburg Pincus 11 LP investment, and the RSIC has received a capital call from Warburg Pincus, that the commission direct the state treasurer as the statutory custodian of funds to transfer such funds as are necessary to meet the retirement system trust fund's obligation with respect to the Warburg Pincus investment by an applicable due date as set forth in the executed contract. Period. End of motion. Where? What page? I'm sorry, Chris?
Red page 517.
Red page 517. Do I hear a motion to that effect? All right, hearing no motion. I have a commission directive from September the 17th, and after the deadline for comments expires, I'll decide what my legal obligations are. So, there being no directive, we can move on to the next agenda item, which is what? Executive session?
Yes, sir.
Okay. Do I hear a motion set forth in at the very bottom of the second page? A motion to receive the executive session to discuss investment matters relating to strategic partnership, discussion of investment matters, and discussion of personnel matters, including performance review and matters related to recruitment pursuant to SC Code and Section 9-16-80 and 9-16-80. Do I hear a motion to that effect? Is there a second?
I'll second it if we got a motion and everyone that's there is hanging in.
All right, all in favor?
I'm going to discuss it. I do not want to go into executive session. When we went last time to discuss these same issues, I asked specifically, will we get accounting and legal analysis of these very significant issues? And as far as the portal is concerned, there is no mention of legal or accounting issues. And I don't want to go back and talk about these things if we're not going to have.
Legal accounting costs?
Yes.
It's in the presentation.
But
You and I are thinking about the same issue.
Well,
You made a request and.
Yeah, I mean,
It's
for
on.
all of those issues. So if they're in there, I'll go, but otherwise I'm not.
Show it to you.
Yeah.
Show them to you on
Well,
my computer, and you can tell me if that's what you're looking to.
I don't know what y'all talking about, so let's give y'all a chance to respond.
Well, I'll defer to the people there whether we're going to go into executive session, keep the meeting going, or adjourn. So I'm fine either way. Let me know.
But right now, I don't know what you all are talking about.
Well, all thing we're talking about is supposed to go into executive session, and Mr. Loftus and Adam are trying to make sure they have a common understanding of what we're going to discuss in executive session, so he can decide how to vote.
Adam assures me the costs are there, so.
Any further discussion on this issue? All in favor of going into executive session, signify by saying aye. Aye. All opposed? Ayes have it.
Of course you do. Was that vote unanimous?
I didn't hear you.
At least we know who it's
What's the vote? What's the vote?
Go into executive session.
Yeah, I know that, but what's the vote count?
That's,
There were no objections. Did you want to go into executive session?
I will vote no because it just occurred to me, I asked for this months ago and it's just now showing up in the last few days, so, but you got to know it's wrong.
Oh, we do have one no vote from the secretary. And the chairman abstained.
So in other words, it's all just staff here.